हेलो एवरीवन, गुड मॉर्निंग टू ऑल ऑफ यू। वेलकम वंस अगेन टू दिस लाइव एनालिसिस। स्टार्ट करते हैं आज का सेशन। फिलहाल देखो, कमोडिटी मार्केट को क्रूड ऑयल नेचुरल गैस ओपन हुए हैं। एक बार रिफ्रेश कर ओके, इंडियन मार्केट भी ओपन हो गया है। इंडियन मार्केट इज ऑल्सो ओपन राइट नाउ। लेट्स सी द कमोडिटी क्या प्लान कर सकते हैं। अभी 130 न्यूयॉर्क 130 न्यूयॉर्क सेशन की ओपनिंग होगी। फिर शाम को 6:30 न्यूयॉर्क सेशन, 1:30 लंदन सेशन, 6:30 न्यूयॉर्क सेशन, 8 बजे यूएस मार्केट, 7 बजे एम्प्लॉयमेंट का डेटा, एम्प्लॉयमेंट कॉस्ट इंडेक्स का डेटा। फिर क्रूड ऑयल की इन्वेंट्री 9 बजे। फिर आएगा रात को 12:30 बजे फेडरल फंड रेट कट का डिसीजन। दैट इज ऑल्सो इम्पोर्टेंट, वेरी इंपॉर्टेंट। लेट्स सी प्लान क्या कर सकते हैं अभी फिलहाल।
On every
10-year level there, but then you take a look at the ultimate right hand of your screen. You can see that those long end yields, as Romain mentioned, have started to take off a little bit. So, of course, we're expecting to see that white line go down another tick this week. It's going to be fascinating to see what happens to that blue line, Romain.
And, of course, a lot will be dependent on where the economy goes, both here in the U.S. and around the world. Let's get some insights out of Geeta Gopinath, former chief economist at the International Monetary Fund, now a professor at Harvard University. And, Geeta, I do want to start there with the global outlook, if you will, a global outlook that has been challenged and, to a certain extent, under strain for quite some time, but one that has still held up. Does that hold up into 2026?
I believe so, Romain. I believe that 2026 will be another year where there will be both strength and risks. Strength from the fact that we still have the AI capital expenditure that's happening. You have governments around the world that are also doing much more fiscal spending. You know, the one big beautiful bill, the stimulative effect of that will play out in 2026. I think the risks come from what exactly is the Fed going to do? What is monetary policy going to be? The chart you just showed was very interesting because it is actually highly unusual for the Fed to be cutting interest rates and the 10-year yield to be higher than when they first started cutting interest rates. That is not a common occurrence.
What does that tell you, though, about what the market's view of the economic conditions are relative to some of the expectations for those rate cuts?
I think what it tells you is that it's quite uncertain what's going to happen next year in terms of both inflation, but also Fed interest rates. Markets aren't pricing in the likelihood of an interest rate increase, which is surprising given where the economy is now and given what we are heading into. So I think that is one risk that needs more attention. Secondly, it's a critical year for the Fed 2026 because there's going to be decisions on who the next Fed chair is. We're going to learn a lot more on how monetary policy gets set. And all of that uncertainty, frankly, I don't see that priced in the markets so far.
Well, let's talk about that a little bit more, that last piece there. When it comes to next year, you do have a change in leadership coming up at the Fed. You do have a lot of concerns about Fed independence. There was a really interesting Bloomberg News article over the weekend talking about that divergence that you're seeing between bond yields and the Fed's expected path. And you have some folks voicing concerns that this could reflect potentially that people are worried about whether or not we're going to have a truly independent Federal Reserve come May 2026, Geeta. And I wonder if you share those concerns.
I do share some of those concerns because what's important is that even though the chair of the Fed is one person of 12 people making the decision, ultimately the chair goes out and communicates what the path of interest rates are going to be, how do they see the outlook, what is the Fed's reaction function. And all of that needs to be conveyed with confidence. And if we're going to be in an environment where there is a lot of disagreement and dissent, that is much harder to convey. So I do worry about this, and it's one of the risks I'm paying very close attention to.
Yeah, and it'll certainly be interesting to see the scale of the dissents at this Wednesday Fed decision. But Geeta, you mentioned, when it comes to some of these concerns, you're not yet seeing that priced in the market. What would you be on the lookout for?
I think I would see some more in terms of, volatility indices, for example, the VIX. It's really sanguine at this moment. If you look at spreads, yes, they've increased some, but not that much. And we have to keep in mind where inflation is. If you look at inflation at 2.8% right now, if you took out the tariff effect, that would have been closer to 2.1%. So the tariffs in and of itself are adding about 0.7 percentage points to inflation. And I don't think that impulse is over yet. I would expect to see another 0.5 percentage point of that impulse coming through next year, on top of all the stimulative effect coming from the one big beautiful bill and the capital expenditure on AI that's going to happen. So there are lots of forces that move in the direction of keeping inflation high and maybe going higher than what we are seeing right now.
I am curious, Geeta, about the pushback to that, meaning the fight against it. And at least as to what we know right now, the relative lack of coordination amongst various governments and central banks. The idea that so many countries, including the U.S., for a variety of reasons, have more or less gone alone, basically embarked down this path based on their own individual interests within their own borders. And I'm wondering If that's okay, if that ends up being a mistake, does it matter?
I mean, firstly, I think governments around the world are in a fiscal expansionary mode. You know, if you look at Japan, they are planning to spend more. In the US, the fiscal deficits are extraordinarily high. Everywhere else, it's not coming down. So we are in this environment where you have high debt, and you have central banks who have to decide what interest rates are going to be. And obviously, there's a lot of pressure to bring interest rates down to be able to support low borrowing costs for governments. That is a tension that they're going to face. And in addition, of course, as you mentioned, governments seem to be going it alone. Frankly, 2026 year is a very, very important year to see whether the world actually finds a way of working better together. It's been chaotic, to put it simply, right now in 2025 about trade policy, controls, export controls, sanctions, and so on. If in 2026 we don't figure out a way for countries to work better together, we really are moving towards what I would call slow and silent decoupling everywhere in the world.
All right, Guido, we have to leave it there. Always great insights. Guido Gopinath, former chief economist over at the IMF, now a professor at Harvard University, kicking us off to the close here on this Monday afternoon. We focus on the public markets and we focus on the private, a shifting market there. A conversation with Andrea Auerbach, global head of private investments over at Cambridge Associates. She's going to tell us what new opportunity she's seeing out there.
And from recalibrating capital to recalibrating your sleep, we'll discuss mattress demand and sleep health tech with Linda Findley, Sleep Number's CEO, how the company is getting out of its comfort zone with its new turnaround plan.
All right, well, speaking of comfort zone, let's talk athleisure. Mark Wahlberg, remember him, the actor and co-founder of the athletic wear company Municipal. He's going to be stopping by the program as well, talking about how he has found a way to change the future of performance wear. You don't want to miss that conversation. Stick with us. This is The Close on Bloomberg. Some breaking news on a company called Medline. This is a medical supply company backed by Blackstone and Carlyle, now said to be seeking an IPO of $5.37 billion. Believe it or not, this would actually make it the biggest U.S. IPO this year. Again, that redhead just crossing the Bloomberg terminal right now. Of course, Katie Greifeld, in a year, or at least I should say a second half that's been full of IPOs and other big deals.
Absolutely. Going to keep a close eye on this story. As Romain said, that would be the biggest U.S. IPO this year. But let's get back to the Federal Reserve, which, as we know, is kicking off its two-day policy meeting tomorrow, with the majority of Wall Street expecting a 25 basis point cut. But our next guest says that rate cut probability seems a little high to him, and he believes that if the Fed does not cut rates, there will be, quote, a bit of a sell-off. Let's bring him in now. His name is Matt Rowe. He is the Managing Director of Solutions over at Man Group. Matt, great to have you with us ahead of this meeting, which it seems like Wall Street, again, the consensus there is that this is a lock, but it seems like that looks a little premature to you.
I think so. I mean, I think that's a bit of what we're seeing today is people backing off that certainty that is priced into the market for a 25 basis point cut. Just a couple of weeks ago, Powell mentioned to everybody that it's not a foregone conclusion that we're going to see this type of a cut. And my friend Torsten Slok has mentioned that if it's a data-driven approach, likely we wouldn't get a cut. So a lot of it has to do with the confluence of political motivation, expectations in the market, where risk is priced broadly. But I think it's a tug and a pull between labor markets and inflation, of course, but the data doesn't look terrible.
Well, let's talk about the market's potential reaction function here a little bit more, because, again, you look at the pricing here, the majority of the street thinks that we're going to see a rate cut. In the event that we don't, you called it a bit of a sell-off. Yeah. What does that actually mean?
Well, without getting overly precise on this, I would guess that if we don't get a 25 basis point cut tomorrow, that we see 100 to 300 basis points of take out of the S&P, because we're here almost all-time highs. No surprise that we're seeing a big company like Medline looking to IPO when equity valuations are where they are. And I think it's just a little bit of backing off what has sort of manifested itself to be a pretty strong year.
It gets to this idea, though, too, that given how strong this year has been pretty much across most asset classes, I am curious as to whether we've sort of pulled forward what would normally have been smoothed out, or say over the next year or so, or whether there is a lot more left in the tank. Yeah,
I mean, it's really, of course, very hard to say. One theme that I keep hearing about is the potential credit crisis in the market. And there's a lot of focus on private credit versus traditional lenders. You can't have a credit crisis without a repricing of equity. So as we continue to see bullishness and valuations getting pushed for potential growth and benefit particularly in U.S. markets, I think you have to take a capital structure approach and really look at where you're being best compensated for taking risk. It's one of the reasons why I think now is a good time to be rotating out of growth and momentum and moving into things that are more value oriented, moving out of U.S. into European risk assets broadly.
On that point, though, about credit markets, do you anticipate that we're going to see a crisis sometime soon or anything even close to it?
I don't think I don't think it's going to be a crisis. I think we're going to see a return to more visible defaults. And every time we have one, people will scrutinize it. They'll take a look at what went wrong in the underwriting process. Not entirely different from what used to happen when the borrower and the lender were a regional bank.
I don't want to belabor this point because, I mean, we had earlier last week, Mark Rowan over at Apollo wrote a very good column on Bloomberg defending private credit, basically saying that the credit quality is a lot higher than what people give it credit for, and then, pun intended. And then we had Dan Iveson on the Odd Lots program over at PIMCO actually saying that, in his view, he thinks credit quality is way overstated because a lot of people basically just shopped around for the best rating that they can get.
I have a lot of respect for both the individuals you just cited. The credit market is enormous, right? If you factor in real estate, both commercial and residential, all the way into CLOs and mortgage-backed securities, it's a massive market. Certain parts have spreads that look to me to be oddly tight, meaning you're not compensated for the short convexity positions that you have. And then there are other parts of private credit that look like the best thing you can put your money into. So I think it depends on where you're focused. And it's an enormous market. And the narrative could fit depending on where you're focused.
Just as an aside, it's interesting to see the equity performance of some of these publicly listed private lenders. You take a look at Apollo shares down 16% year-to-date, Blue Owl down about 28% year-to-date. But let's talk a little bit about government debt, because we were just discussing with Geeta Gopinath that you have this unusual divergence in terms of the Fed's policy rate and what we're seeing with 10-year Treasury yields. As she pointed out, that's a very unusual situation. I wonder what you make of that divergence that we're seeing and what it could potentially mean for equity markets if we see it continue to build.
So year to date, based on last night's close, roughly, the 30-year is kind of unchanged. We've seen yield curve steepening led by a drop in the front end of the curve. That's really a big part of what's been fueling equity valuations and kind of where the narrative for constructive investment has gone, especially it's lowering base rates for corporate borrowing out to the 5-year, 10-year point. We think, myself and Christina Hooper, who's our strategist at Man, share the opinion that there's a relatively high probability of stagflation and a mild recession going into next year. The argument against that is consumer spending still seems to be pretty strong. So how that plays out in the yield curve, I continue to think we're going to see steepening as people look to diversify away from U.S. assets, not in a panic, but a little bit as just a normal course of business.
Just real quick, we'll only have about 30 seconds, but on that stagflation point, we just had the president speaking at an economic meeting down in Washington. Basically says he thinks inflation will come down, but he's very specifically said we're not going into a deflationary period. And I'm curious does that change the calculus for the Fed? I mean, assuming he's right, and quite frankly, we've heard other economists echo that sense. Does that change the calculus?
It does. I think if we actually see prices come down, then that will be a very different picture. What we've been dealing with and what the visibility is on a go-forward basis now is that prices, as the consumer feels them, have been rising. As policies change and that makes its way through the market to pricing, that would definitely have an impact. But right now, we still see companies struggle to pass on these higher costs, and they are landing in the consumer's lap.
All right, got to leave it there, Matt. Always great to catch up with you. One of the best in the business, Matt Rao, Managing Director of Solutions over at Man Group, as we continue to march towards those closing bells. When we come back, we're going to talk about the story of the day. Paramount making an 11th hour bid for Warner Brothers, splashing the cash, but not everyone thinks that's going to be enough. Doug Croyt's going to be joining us from TD Cowen. Stick with us. This is The Close on Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
You have to have very clear global strategy to bring progress for humanity. Thinking from the customer point of view and taking the right decision, taking the right action, it may cost you more money in the short term, but you are creating customers for life.
Let's get right to our top calls. Big movers on the back of analyst recommendations. Lennar up first with Barclays cutting the home builder to underweight, but taking the price target slightly up to 98. Bigger picture questions around affordability, employment, and migration, dampening any benefits that could come from Fed easing. The shares down 2%. Next up, Ulta, TD Cowen boosting the beauty retailer to buy from hold, a street high target of $725, saying it can usher in a more dynamic phase of growth going forward. The share is still down 1.5%. And finally, Generac, JP Morgan upgrading the company to overweight from neutral, maintaining the $200 target, saying Generac can take advantage of the market's power needs alongside unlikely competitor Caterpillar. Those shares up 1% on the day, and those are some of our top calls. Let's get right to the big story of the day and the media merger mania heating up. Paramount Skydance making a hostile $108 billion bid for Warner Brothers Discovery in the wake of Netflix's offer to buy it itself. Joining us right now to talk a little bit more about this is Doug Kreutz, senior media and entertainment analyst over at TD Cowen. I thought Netflix's offer was a little rich, Doug, at $108 billion. How exactly are the Ellisons going to extract value from that if they were to win?
I think, look, it's a great question. Warner was trading at $12 a share 3 months ago, and we had a buy on it then. We had a price target around, I think, 16 or so. But 30 is a big number. They've said they think they can get $6 billion in synergies out of the combination of Paramount and Warner. That's another big number. I think when Warner and Discovery merged, they took out $4 billion in synergies. Those are obviously taken out. So they have to get a lot of synergies, cost synergies out of the deal. They have to figure out how to generate value from the linear networks. They have to figure out a way to merge the two streaming services without having it be 1 + 1 = 1.5. There's a lot of question marks, basically. Yeah. They clearly are very determined to land this asset.
Well, let's talk a little bit about how the cable channels are being valued, because you take a look at Bloomberg News reporting. It seems like Paramount is valuing the spinoff at $2 a share for Warner investors. But then you take a look at Bloomberg Intelligence saying that the cable channels are probably worth $4 per share in the Netflix bid. I wonder, where you fall on how much those cable channels are actually worth.
Yeah, I'd say I'm closer to $2 than $4. When you look at where comps are trading, AMC Networks is out there. They're a pure play cable network asset. I think Versant, there's a sense of where that's going to trade. I think $2 is probably closer to right than $4. A lot of it has to do with how much leverage actually winds up on those assets when they get spun out. But, I don't know whether it's 2 or 4. I don't know that you get a wildly different conclusion as to which bid feels better, given that the Paramount bid is all cash and you're getting $30. The Netflix bid, you're getting some Netflix stock, and you're getting this spun off asset that we can discuss where it should be valued. But it's a discussion. It's not a clear amount of cash.
Well, I am curious too, Doug. I mean, it's one thing to say what investors want, but this feels a little bit different in the sense that a big part of this decision is going to boil down to what Washington wants. And by Washington, I mean the White House. And by the White House, I mean Trump. Do you have any way to model that in to your outlook?
Yeah, look, I think both Netflix and Paramount have expressed that they are confident they can get this through the regulatory process. They would say that. From an outside observer perspective, it does feel like Paramount is closer to the Trump administration than Netflix is. There are some ideological benefits to the Trump admin of Paramount landing the deal, namely that they will then wind up with CNN. And clearly Paramount is charting a somewhat more conservative course for their news coverage at CBS. One would think that that would also happen at CNN. Whereas if Netflix buys the streaming and studio, then the cable networks, including CNN, get spun out, and anyone could wind up with them, or no one could wind up with them, and they could just stay out there. I wouldn't underrate, though, the importance of other regulators, including state attorney generals, especially California. Right? They're going to have an entirely different viewpoint and basis for example.
All right, Doug, unfortunately, we are up against the clock. Have to have you back soon. That is Doug Kreutz of TD Cowen. This is The Close on Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
There are very few leaders in the world that can do that and that can create those kind of companies and that kind of value. So I think people are just right now in the private markets, they have this FOMO over AI that they need to get in, that they need to be part of it. And that's going to cause a lot of young people to make a lot of mistakes.
Orlando Bravo over at Thoma Bravo speaking a little bit earlier. 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. Yeah. Really interesting comments, too, because we talk about FOMO in the context of public markets all the time. It explains a lot, certainly when you think about the past 5 years. Interesting to hear the perspective that you're seeing a little bit of it in the private markets.
And I love this conversation we've been having with seemingly for days, weeks, months on end about kind of the health of the private investment space. But a lot of it has to do with the lack of transparency, right? Mm-hmm. I mean, people are kind of guessing, trying to figure out the health of these companies, whether losses are being shielded or whether, all of the gloom and doom that you're hearing from some people is just, Pollyanna-ish and that things are okay. And it's hard to really know what's going on behind the scenes sometimes other than what, people like Orlando Bravo or Mark Rowan or some of the others tell us.
Exactly. There's this sense that, okay, you can't check the real-time information, the real-time price movement, so you're just sort of waiting for a shoe to drop if there is one. But let's keep this conversation
What if there is
going.
no shoe, Katie Greifeld?
That's the thing. There might not be a shoe at all. We might just be floating. Anyway, Andrea Auerbach, she is Global Head of Private Investments over at Cambridge Associates. She joins us now. Andrea, great to have you with us. Would love to hear you weigh in on this conversation. It's the perspective of Orlando Bravo that you take a look at private markets. There's a lot of FOMO there when it comes to AI. Are you seeing something similar?
Katie, we are. In fact, our outlook for 26, the advice that we're giving our clients and we're acting on is really looking for the value amid the hype. And that hype has a name, and it's the AI hype cycle. And so something that we are familiar with seeing, we've been investing in the private market since the 70s. So we have a lot of experience and scars and wrinkles around this exact question. And the AI hype cycle is not unfamiliar to us. We've seen it in other moments in the private markets as well.
It's interesting. I mean, you think about what FOMO, what hype cycles typically entail, again, in the public markets, and you see investors maybe go into risky or speculative sort of assets, companies that haven't exactly been proven because they don't want to miss out on the potential gains. Are you seeing any of that behavior specifically? Maybe investors getting involved in investments that perhaps they shouldn't?
Katie, I think the answer within the private markets, it's a broad space, right? So within the AI ecosystem itself, you've got infrastructure providing the electricity transmission, the grid lines, you've got the data centers, then you've got the semiconductors, and then the AI native applications, which is really the venture capital layer of the AI parfait. Then you move up into growth equity, buyout, and then credit kind of is investing and lending around this entire parfait that I'm describing. And I think what you're talking about, Katie, is that venture capital layer, which we have been watching a lot of dollars going into AI native applications. We're watching a lot of venture capital funds raising money to go right at this space. And it does feel like there's a bit of that FOMO pull that Orlando was describing earlier.
I wonder if you can talk a little bit too, Andrea, just about kind of the evolution of this industry. We're now 4 or 5 decades into this great experiment when it comes to private investments, or at least what we think of today as private investments. But there's always been this sense here that we never really sort of got our sea legs back coming out of the pandemic in 2020 and 2021. And it gets to this idea of what really is going on behind the curtain. And I'm wondering if we should be worried about some sort of reckoning that is yet to materialize.
Romaine, it's well observed, very well observed. And so we did notice that there was a bit of a boom-bust cycle coming out of the 21-22 cycle, specifically in expansion stage venture. But what we observed in early stage venture is actually the valuations at that tier of the venture capital ecosystem just kept moving up and to the right, buoyed quite a bit by the AI hype that is happening and the investment that's there. Now, what I would tell you is, what we've observed, and you know this as well, which is venture capital is a very long-lived investment strategy. The funds that are investing in AI companies or venture-backed companies can go for 15 or 17 years. So any one movement in 1 year could be considered a bit extreme. And so the advice that we're living and walking with our clients is 2026, we're going to continue to see this AI hype play through, maintain your line of sight on where you're investing, and keep a very high bar for the venture managers that you want to invest behind.
Well, this also gets to the idea that, Andrea, of some of the concerns that investors have had, particularly limited partners. And of course, now with this new crop of individual investors in theory coming into this market, a lot of concerns about liquidity. We've seen the secondary market boom this year. That's good, obviously, for business. But some people also feel that that boom in the secondary market is to a certain extent masking some of the pain that's going on behind the scenes.
I appreciate that, Romaine. And we definitely have watched secondaries start to build more momentum around that particular strategy as limited partners and general partners, the managers, are seeking ways to manufacture liquidity to get distributions back to their investors. Now, what I would also observe, though, is that secondaries are currently only just 5% of total private market activity. So there's a lot of room for that strategy to move and run. And it's also becoming popular with the evergreen and interval funds that we've been watching also pop up along the landscape to feed the individual investor with exposure.
And I do want to talk a little bit more about that individual investor, because one of the narratives around private markets, private assets, investments in general in 2025 was that one of the reasons why you saw managers try to seek out that retail bid was because, you think about the traditional fundraising sources, institutions, that was tending to slow a little bit. How do you see that sort of evolving in 2026, and whether or not we're going to see the baton continue to be passed here?
Katie, what we believe we'll be seeing in 2026 is a reinvigoration of the private markets. We believe that the markets have troughed, and so institutional fundraising is likely to continue to climb and resume its upward trajectory, and it will be augmented by more of the individual investor capital that's coming into the space. But the other thing I'd observe here is that a lot of that individual investor capital is being pursued and capably pursued by a smaller subset of managers. There are tens of thousands of private investment managers in the landscape, and we believe there's a certain cohort, a very small subset, are really positioning to take in all that capital, which create new challenges for that part of the ecosystem in the private markets.
I am curious with the size of companies. I'm talking about new investments in companies. The size of those investments. Are you still seeing, if at all, appetite for, I guess, some of the smaller companies? Because I continue to hear both from VCs as well as on the private equity side, this idea of sort of wanting to deal with more mature companies, or at least companies that have much more established cash flow and growth than maybe what we would have seen, 10 years ago.
Romaine, what we see is companies of varying sizes, and can be as little as $5 million in revenue or $3 million in revenue, all the way up to hundreds of millions, billion of revenue. So the private markets are really cover a very wide range of company ages and stages. And within the private markets, you have different managers that specialize in earning competitive returns at different segments of that market. So what you're describing, and as I'm hearing that, there are definitely certain investors that may want to diversify away from maybe growth at aggressive costs, right? And maybe seek out adding more businesses that may have more stable cash flows during what could be perceived as a more uncertain time as we roll into 2026. Now, there's other strategies that we've been talking to our clients about moving into 2026 to offset the AI, so let's say, hype cycle and the active investing that's going on in there. And we're looking at more strategies that might be diversifying and have more resilient cash flows. Think royalties, pharma, media, content, and also insurance-linked securities are also areas that we like to add more ballast to our clients' portfolios.
Andrea, always a great conversation. Great to have you. Andrea Arabach, Global Head of Private Investments over at Cambridge Associates, as we continue to count you down to the closing bells with a couple of big deals announced today. Of course, a lot of talk about the Paramount and the potential tie-up with Warner Brothers Discovery. Getting lost in the shuffle, though, is a big deal by IBM, buying Confluent for $9.3 billion. It's our stock of the hour, and it's coming up next. This is The Close on Bloomberg.
Global electricity demand is set to surge 75% by 2050. Infrastructure alone won't keep up. To power the future, we must change how energy is used, not just how it's generated. The missing link? Demand-side solutions that unlock efficiency, productivity, and resilience. The Bloomberg New Economy Energy Technology Coalition is uniting industry, innovators, and investors to scale these technologies for a future-ready energy system. Learn more at bloombergneweconomy.com/ntech.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Prime Infra is an investor, developer, and operator into socially relevant and sustainable infrastructure across three primary market segments: water, sustainable energy, and waste management. We're really about doing the hard stuff, and that is highly regulated market, significant barriers to entry, and a type of infrastructure that renders an essential service. That DNA comes from the owner, and we're built on the DNA to create a very successful company.
Our stock is of the hour today. We're taking a closer look at IBM and Confluent. IBM going to buy the data platform for about $9 billion, one of the largest deals to date, and just the latest peg in an AI flywheel. They can't seem to quit. Bloomberg's market correspondent, Nora Melinda, joining us right now. Talk a little bit, I'm not sure where that last line meant, but we talk about just sort of IBM's big push and what Ivor and Kristen has been trying to do to really assert themselves in AI. And of course, IBM would tell you they were doing AI long before it was cool. But buying Confluent, I mean, that is a huge flex here, but it's also very expensive.
Very expensive,
yeah.
But it is a big flex. I mean, of course, we do know that IBM hasn't necessarily been a leader, if we think about it, in terms of against Amazon, Google, in terms of this AI push, but they've really carved out their own niche. They're really focused on enterprise. They're focused on businesses and bringing functionalities and artificial intelligence in that sense. And so that's why you definitely see Confluent being a particularly good target here. If you think about Confluent, they're essentially a company that focuses on high-speed data pipelines. So think of it almost like a highway. They're just trying to get things to move faster here. So maybe banks are able to detect fraud at a faster pace than they would have been able to before. Or if you think about a retailer actually really digesting the data when shoppers are making these purchases so they can actually readjust prices here. That's what Confluent does, and that's exactly essentially filling a gap of what IBM really needs in this moment.
Yeah, and IBM clearly willing to pay up for that. $9.3 billion. That's one of the biggest purchases for IBM in recent history.
Absolutely. And also Confluent, they really needed this deal. I mean, this is the company that IPO'd just back in 2021. So we did see a bit of weakness after they did IPO. They've kind of been struggling. There's a lot of macro headwinds, of course, going on, but it's also major competition right now if you think about the artificial intelligence industry more broadly. But they did bring on an investment bank, and they started to get a lot of traction, a lot of attention from a lot of other companies that wanted to potentially take them over and bring them into their portfolio. So you're seeing IBM as the winner here, but it's just definitely a deal that Confluent also needed.
Are we seeing any other stocks sort of move on this? I mean, anytime you have these types of deals, everyone, of course, starts looking for who the competitors are to Confluent. Could they potentially be bought or something like that? Or is this just kind of confined to these two companies?
We've really been looking at this company specifically, but I do think what's interesting is that you also were seeing shares of IBM up in the green. And I think about a lot of companies when they're purchasing another name, it's the company they're purchasing that you start to see rally or react off of the news. But we are also seeing shares of IBM rising as well. So analysts are also thinking that this may just be broader positivity about continued deals here in the AI space outside of just the traditional data center push that we've been seeing so broadly.
International Business Machines with a big purchase. Nora Melinda, great reporting as always.
You went for like the full government name.
I love,
I think they changed their name a while ago.
But
they're just IBM now. Just rolls off the tongue.
It still stands for something though. International Business Machines. What those business machines are, I think that definition has changed since IBM has been alive.
They're machines that help to run businesses.
That's true. Anyway, coming up, we're going to take you to the closing bell with
I have to educate her every day.
McCartney. She is Managing Director of Wealth Management and Private Wealth Advisor over at UBS Alignment Partners. That conversation up next. This is The Close.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Ten minutes away from the closing bells. Romain Bostic here with Katie Greifeld. Stocks pretty much across the board, at least the major indices, with the exception of the Russell in the red on the day.
Yeah, the S&P 500 down by 0.5%. The NASDAQ 100 off by about 0.4%. We did eke out slight gains last week. We've more than reversed them so far on this Monday. It's interesting to see the Russell 2000 actually be the slight outperformer here, up about 0.1%, even though you have this sell-off in the bond market continuing here, Romain. The 10-year yield higher by about 3 basis points as we count down to that Fed meeting.
I'm curious about the Russell, too, because we've talked with a lot of analysts and strategists, and even Ed Yardeni was out with a note this morning talking about this idea of being a little bit short, or at least not overweight, the mega cap tech, and actually overweighting more in some of those smaller cyclical sectors. He wants to overweight financials, healthcare, and I think industrials were in there as well. But a lot of investors seem to have gotten that bug for a variety of reasons, and maybe that's part of the reason why you're seeing the outperformance once again by the Russell.
Yeah, it seems like the folks that we listen to, that we talk to, there is that itchiness to go long small caps.
Yeah.
But in terms of a consistent bid, it seems like it's hard to find when you have all these questions still over what the Fed is actually going to deliver in terms of its trajectory on rate cuts.
All right, well, let's get some insights out of our next guest as we move closer to these closing bells. Allie McCartney is Managing Director of Wealth Management and a Private Wealth Advisor at UBS Alignment Partners. And Allie, I do want to start there with sort of portfolio allocation into 2026 with the eye on the idea that a lot of people, assuming they were fully invested this year, are sitting on some pretty healthy gains, primarily because of the big bump up that we saw in mega cap tech stocks. Is it now time to take some of those profits and think about maybe allocating elsewhere?
So that's not only an issue from this year, right? If you think about it, that's a 3-year sort of 80 to 140% issue. But the question is, the way that I think for clients about every dollar is from an after-tax perspective, what is the best use of capital going forward? And you have to believe in order to do that, that the best use of capital is not continuing to invest in those hyperscalers with the AI trade. And having just spent all of last week at UBS's AI conference in Phoenix, it was attended by a few thousand global companies and investors. I'm fascinated by what's going on. in in the healthcare space, in the AI space, in the any space you can really think of. And so that's not really where I'm taking gains for clients. I have been a heavy investor in precious metals. I didn't expect to have the run up that we had this year, fueled by flight to quality, especially during the March and April trade tensions, waning US dollar, bids from overseas sovereigns. So that's a place. But again, you have to figure, what are you expecting going forward? And with numbers that are going to come out from an earnings perspective, probably of about somewhere between 12 and 14% this year. And we're expecting a not dissimilar number next year. I think we probably have another good equities year.
Okay, all right. Another good equities year. Is that also partly due to the potential for Fed support, or at least the perception that this market has right now, that we will see easier monetary policy into next year?
Absolutely, right? And I think you were just talking about the small caps, and that's why people are there's a lot of momentum or desire to go there, because especially not knowing what the composition of the Fed will look like. And we will have more, obviously, more clarity into that soon. But there's certainly going to be a rate cut on Wednesday. There is likely going to be a rate cut in January or the first quarter. And if we have a new Fed chair that is very aligned politically with the administration and has the same goals of, being able to continue to finance our debt, et cetera, then we get into a world where you have the Fed tailwinds in terms of decreasing interest rates. You have the tailwinds of AI, both helping to cut costs and increase revenues, so like a dual bump to profitability for not only tech companies, but also much more broadly, any company that can be more efficient. And then thirdly, you have earnings growth, that is really above average. So with those three things, absolutely, there should be a number of tailwinds. The one thing that I would caution is that the risks are real and in a sense getting better or getting bigger, but getting less priced into markets in terms of, for example, your Sharpe ratios. And the other thing is that the growth that's expected both in earnings and in GDP is likely to be front loaded next year because of a lot of the implications, both for individuals and for companies in the big, beautiful bill.
I do want to talk a little bit about Fed risks, though, because, you mentioned that we're going to have that leadership transition next year. There is the concern being worked through the bond market that, should you have a new Fed chair who is on board with the Trump administration's leanings in terms of lower interest rates, that perhaps this new Fed chair will be more dovish than what the economy actually needs. That's been pointed to as a reason for why you're seeing these elevated levels when it comes to the 10-year yield, when it comes to the 30-year yield. Ali, I wonder, how much water you put in that sort of theory.
Katie, that's a real risk, right? And you can see that the administration, and to a certain extent through the Treasury largely right now, they're concerned about that too, right? So they're trying to have more bought on the long end. They're trying to issue more on the short end, because that's really been the issue in this market. And it's been the issue for a while, both economically and politically, which is the Fed can really only affect the short end. It can't affect housing affordability or sort of the 10 to 30 year. And so when you say there's a risk of that, I think there is absolutely a risk of that we sort of use monetary policy to keep all of this going, to the extent that we create significant issues on the longer end, both in terms of the Treasury curve, but also in terms of timeliness. And, and because ultimately, the real thing that's happening here when we look at the consumer, who is clearly on the lower end facing inflation, will continue to face inflation as we see a lot of, let's say, the August tariffs play through into Q1, is that housing affordability and ability to tap equity in houses, which has been a huge source of GDP and growth for this country, is really at risk if we have 6% mortgage rates for the near future.
All right, Ali, always great to catch up with you. Ali McCartney there, Managing Director of Wealth Management over at UBS Alignment Partners, counting us down to the closing bells as you keep an eye on the markets right now. Not far off the lows of the session, but the declines today, Katie Greifeld, fractional to be sure.
Absolutely. It feels a little bit like wait and see mode, of course. We're out of the heart of earnings season. We know that consequential Fed decision is coming up in 2 days' time. And it's not just, of course, what they do on Wednesday, but what the commentary about 2026 looks like.
We do get some earnings this week. Costco. Are you a Costco person? Lululemon, you're an athleisure person, aren't you?
I am, actually.
We're going to catch up with Mark Wahlberg a little bit later, who has a way to change the future of athleisure. In the meantime, our global simulcast.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld, taking you through to that closing bell with a global simulcast. We're joined right now by Carol Masser in the radio booth alongside Tim Stenovic, who's lost a little bit of hair. Actually, it looks like Matt Miller filling in today for Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. A down day, Carol Masser here on This Money, though we should point out, probably best described as a bit more of a holding pattern as a lot of people wait for the Fed's meeting on Wednesday.
Yeah, what indications do we get in terms of rates going into 2026? I mean, basically the rate cut on Wednesday, it is definitely baked in already, but it's really the outlook, the summary of economic projections and more. But I also think, is there a point where people are like starting to dismiss what Jay Powell has to say because he will not be there for the entire year of next year?
Does it become a lame duck?
Yeah, I don't know.
It will be interesting also to see if he actually is there, because remember, he could stay at the Fed.
Wouldn't that be wild
after
if that's what
being
happens?
chair?
Yeah,
although
could happen.
I would probably just want to chill after that, after this kind of stressful.
Go fishing in Montana?
It's been
yeah, I would ski.
Okay.
It's been a trying couple of months, certainly.
Hi, Katie.
Hi, Matt. How are you?
I'm doing well. Miss you.
I miss you, too. It's so nice to be joined together on our global simulcast. I'm most interested to see what yields do on Wednesday. We've been talking about it all show, Romaine and I, how you're seeing that divergence between the Fed's policy rate, what the long end is doing, and whether or not we're going to see that gap continue to grow.
We get the closing bells here in New York. I was just saying a little while ago here that stocks were off the session lows. We should point out a couple of huge block trades just coming in across the tape right now as we get closer to the bells, and that's causing a bit of a bump higher, still in the red for the S&P, but a bump well off those lows here as we close out the session on this Monday. The Dow Jones Industrial Average down more than 200 points, or 0.4%. A similar percentage drop for the S&P 500. The NASDAQ Composite down about 0.1% here on the day. The NASDAQ 100 down about 0.25%. And the Russell 2000, that's your outperformer. It had been oscillating between gains and losses on the day. It looks like it's going to finish just basically at the waterline in the red, but only down by, it looks like, just less than 1 point.
All right. Yeah, small move there. Hey, back to the S&P 500 I go. Most names, though, in that index lower today. About 345 names losing ground on this Monday, 157 to the upside. And Katie, you've got one unchanged.
Let's take a look at the circle and take a look at the sector level, because it's broadly the same story, if not a little bit more dramatic. You do have one important slice that's green, and that is tech. NVIDIA, your biggest points contributor to that sector, up about 0.9%. But you take a look at the rest of the sector landscape, 10 sectors finishing in the red in terms of which was your worst performer today. Communication services down by 1.8%. Materials and consumer discretionary also finishing in the red as well, Carol.
All right, a lot of red there. So let's get to some of the individual gainers. No surprise, a big story today in the media sector had to do with the race to buy Warner Brothers Discovery, if you will. Warner Brothers Discovery finishing off its highs. At its highs intraday was up 8%, but it is the number one gainer in the NASDAQ 100, number two gainer in the S&P 500, finishing the day up about 4.5% here. You know the story. Paramount Skydance launching a hostile takeover bid for Warner Brothers Discovery, $30 a share in cash, and that's just days after the company agreed to a deal with Netflix, the offer valuing Warner Brothers at $108.4 billion, including debt. I mean, the race is on, the bidding is on. We'll see where this one lands. Paramount Skydance, that was your number one gainer in the S&P 500. That stock up 9% in today's session.
The differential between what Netflix is offering and what Paramount is offering is phenomenal to me. And I'm trying to think of the last time we saw a major merger and acquisition deal where you had two bidders that far apart in terms of what they were offering.
It's interesting. I'm sure you talked to Geetha Ranganathan today. I talked to her as well. She points out that the Netflix bid at $27.75 also includes the spin-off of the cable assets, which they valued about $4.
Right.
So that's actually a $32 bid.
Yeah.
A little bit more than what you're getting from Paramount at 30 even. But if this deal is quashed and then Netflix has to fork over the $5.8 billion breakup fee, then gets the Paramount deal, it's far more money.
Yep, a lot of
for
moving-
Warner Brothers,
a
for
lot of moving
Zaslav.
parts. And it ain't done yet, so we'll continue to keep an eye on that one. Hey, Katie mentioned NVIDIA, certainly some help in terms of supporting the equity trade. That one finishing off its highs of the day, but still with a 1.7% gain. We did see Semaphore coming out, citing a person with knowledge of this, that NVIDIA will soon be allowed to export its H200 chips to China. U.S. Commerce Secretary Howard Lutnick said to support the plan again, according to Semaphore. So some outperformance in that name. And just one more chip name I want to mention, Broadcom. AVGO is the ticker. It's the number 4 gainer in the NASDAQ 100. Saw some reporting on this that Broadcom was up on a disputed report that Microsoft is in talks to move its custom chip business. Information reported late Friday that Microsoft is in discussions with Broadcom to design future custom chips, which would be a move away from its alliance with Marvell. Marvell?
But a disputed report.
A disputed report. So anyway, but Broadcom shares up about 2.8% today.
We should point out Broadcom expected to report earnings this Thursday.
Yeah, it's up about 73% year to date as well. Yeah.
All right, here are some of the losers. Netflix obviously is down again today. This is a puzzler to me, and I don't know if you guys have figured it out, but when Netflix put in its official bid last week, it was down. And in fact, it's been down every day for 4 trading sessions in a row. When Paramount comes out with a hostile offer, it's up.
Yeah.
So it's like Paramount investors want them to spend over $100 billion, please. And Netflix bidders are like, or investors are like, that's maybe too much.
We were actually just talking about this. We didn't land on a conclusion, but Romain did point out that you take a look at Paramount shares last week, just what they were doing on Friday, Thursday. They haven't exactly climbed out of this hole, but I do also think it's curious, Matt, that you are seeing shares rise 7% on a hostile bid, but go figure.
So Air Products is another one off today. Air Products down after it said it's working with Yara International out of Norway to establish a long-term partnership on a pair of ammonia projects in the U.S. and Saudi Arabia. Potentially a sale in the works there, and that's what has investors selling the shares. Procter & Gamble shares, not a huge drop in P&G, but a couple of different analysts at Barclays and at Deutsche Bank said that they've met with executives at P&G recently, and they were encouraged to bring their estimates down, so that's not great news. And then Marvell Technology, those shares getting decimated today after a benchmark company cut its recommendation to a hold from a buy on expected lost business from Amazon. Also, they're being pressured after the company was not included in the newest additions to the S&P 500 index, and we love those rotation trades.
Absolutely here, and also looking, it was interesting too to see quite a few of the retailers down here on the day as well as some of the holiday spending data continues to come through. I do want to draw our viewers' attention real quickly to PepsiCo. We had a headline across the Bloomberg terminal that PepsiCo was telling its North American employees to work remotely this week, and that it's anticipating changes that, in its words, could, quote, affect some roles. The Wall Street Journal now out with a report seemingly tying this to that activist campaign by Elliott Investment Management, an activist campaign that Bloomberg has been reporting on quite frequently. And it does appear that some of these cost cuts are going to be tied to that, about 20% cost cutting across the board. Not quite sure exactly how that stacks up in terms of the number of employees or the potential cost savings, but we're going to try to dig a little bit deeper, guys, and get you some more information on that.
Yeah, right now we're seeing, as you mentioned, PepsiCo unchanged here in the aftermarket. All right, we'll keep an eye on that. Hey, one of the things that Matt and I think we're keeping an eye on, although he might.
Why are you two staring at each other?
He might go rogue on me.
Did you guys talk about this?
He might go rogue. No, we didn't.
Oh.
We didn't. So we're going to get to what is one of the most read stories on the Bloomberg. I think it's in the top 20. But it was
in the top 20.
It was a red
K-pop Demon Hunters?
It was a red sticky when it crossed.
Mark Wahlberg?
All right. No, we're not doing.
Oh, I can't wait. Is that Just 20 minutes time until Mark Wahlberg comes on.
Stop.
4:50 actually. So
Jimmy Kimmel extending his deal with Walt Disney's ABC for at least a year. So they're
Jimmy
bringing
Kimmel? I thought he was canceled.
No.
Surprise.
Oh.
No, remember that whole,
I don't,
snafu, and he was off the air, and then he was brought back, and certainly the White House watching.
What was the snafu? Explain it to me.
No, I'm not going to do it.
Oh,
Just go to the Bloomberg and read it. Okay, but anyway, Walt Disney's going to bring him back for at least one more year under a new one-year deal with the ABC network.
It's interesting to look at the details here. Apparently, Kimmel and Disney agreed on this extension months ago, but they delayed announcing their plans out of respect for fellow late-night host Stephen Colbert, who personally I love, one of my favorite comedians. But we know that CBS announced in July that the Late Show with Stephen Colbert will end in May of 2026, which is also when Fed Chair Jerome Powell will, step away from being Fed Chair.
Maybe they'll do something together.
I would love that.
Powell and Colbert. I don't get
That
like
would
the
be
whole
great.
late night thing. Is that still a thing? They don't make money. Do people really watch it? Do they bring guests in? Is it important for a network? Kimmel was hilarious when he was taking kids' Halloween candy away. But since then?
Yeah, I don't know if it works as, a live program, but certainly, you think about SNL as well. A lot of people find those clips on YouTube after the fact or on TikTok.
What should they run at night, Matt?
What should they?
Late night?
Should they just go back to like bars on the screen or play the national anthem like when we were
exactly.
kids?
When I was a
It's 10
kid,
PM. Do you know where your
TV
kids
just
are?
ended at a certain time, and then there was static or bars.
No one knows the struggle, Matt.
All right.
Yeah, there was nothing to do at night.
But no, now we stream stuff, right? Now I'm watching YouTube all night, so there's no need for live broadcast.
Yeah.
I think their commentary has
What
some
YouTube
value.
videos are you watching? Let me guess. I assume it's a lot of car.
That's right.
All right, we got to go.
I'm watching car videos.
Finley says we got to go. We got to go. So
Which is the most important
Zip it.
generation of the 997 911? Is it 991.2 or 991.1?
Watch this
We gotta
45-minute
go.
video.
Katie and I
Does
were just
everybody-
having that debate right before the
All
show
right,
today.
does everybody understand what wrap means, Finley? I'm trying. All right, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Romaine and Katie continuing there on the close. Matt and I continuing right here on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
All right, the year is almost over. We're going to discuss some of the big moves in S&P targets and where the markets go next. Adrian Helfert, CIO of Multi-Asset Strategies at Westwood. He's joining the big program in a second. Stick with us. This is Bloomberg.
The countdown.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
At Virginia Housing, our mission is to help Virginians attain quality, affordable housing. We're one of the top housing finance agencies across the United States. Having a partner like Wells Fargo that is consistent, that we can rely upon, is so important, and it enables us to try and test things that some organizations frankly can't do. Together, we're serving the community. We're serving businesses when they want to come to the Commonwealth. We're serving the future of Virginia.
Is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. An interesting start to the week, a Fed week, we should point out. A big decision scheduled for Wednesday. And that actually had the market in a little bit of a holding pattern. Not so much just trying to decide what the Fed does on Wednesday, but more importantly, about what it does next. The S&P pulled back just a tad here on the day, down about 3 to 0.4%. You saw a similar move lower for most of the other indices, so we did see continued outperformance by the small and mid caps. Russell 2000 basically flatlined on the day, coming off that record high that it set on Thursday. But keep an eye on the bond sell-off, a global bond sell-off, and it continues here despite the expectations that the Fed rates are going to go down. We should point out Treasury rates, Katie Greifeld, have been going up, basically going up for 6 of the past 7 sessions now, above, believe it or not, where we were when the Fed started cutting rates back in September.
Getting some deja vu to September 2024, but there's a lot of red on that screen, so I put a lot of green on mine in terms of the individual movers on this Monday. Paramount Skydance, as we've been talking about all show, soaring about 9%, making that hostile bid for Warner Brothers. You can see certainly shareholders deciding to reward that. Carvana also getting the nod late on Friday that it will be included in the S&P 500. That is good for a 12% rise. And NVIDIA, no specific news, but it did rise by 1.7% on a points basis. That was your biggest contributor to the S&P 500 today. But let's get to our top story this hour, and that is Wall Street's biggest bulls getting even more bullish. John Stoltzfus and the team over at Oppenheimer expecting the S&P 500 to rise 18% in 2026. That is a street high of 8,100. Now, Stoltzfus citing persistent resilience in U.S. economic data and corporate results, expecting that to deliver big gains once again to the big benchmark, Romaine.
Absolutely. Let's bring Adrian Helfert into the conversation, CIO of multi-asset strategies at Westwood Management. And Adrian, you've apparently turned a little bit more, I guess, I don't know if bullish is the word, but certainly a little bit more positive on equities heading into 2026?
More positive, and you might say more bullish. And certainly that 18% you just mentioned is not out of context with the last 13, 14 years that we have seen an average and a median on the S&P 500 return around 16.5%. So a significant rise in the past. We're looking at big change from technological innovation, certainly AI, the spending train still continuing. So we are looking at a significant rise in the equity market next year. And we've got a release in things like tax refunds that we'll see from both the corporate and the consumer side. So there are some drivers there that will give a lift to markets next year, we believe.
How much, if at all, does the Fed matter?
The Fed still matters, certainly. I often tell investors that something about the December really gives us the excitement of, are they going to cut? How much are they going to cut? What is it going to mean? The reality is focus on the fact that they can. We have that stimulus in the environment to suppress volatility when it rears its ugly head, number one. Number two, we know where we're going. We're going to a lower rate, to a neutral rate that is below where we are now. And one might even say, actually, the neutral rate is likely to move lower, just given the fact that we've got increasing amounts of dovishness opined on the Fed. We've got, in May 2026, a new Fed governor, new Fed chairman that will lead those conversations and likely mean the new neutral is an easing-oriented policy.
Do you think that the economy and specifically inflation will cooperate with that? Clearly, the desire for lower rates is there when you take a look at the Trump administration and likely the next chairman of the Federal Reserve. But in terms of actually lowering rates and resetting that neutral rate lower, how do price pressures come into the picture?
Very good question. I think that's the elephant in the room of what's going to happen with price pressures. Two things on that. Number one, it's interesting that we've recently seen this conversation move towards affordability from inflation. And with the president now doing a roadshow around the nation talking about bettering affordability measures rather than talking about inflation metrics, that's going to be a push on one area. The second thing is, of course, it's a dual mandate Fed. It's labor and inflation or stable prices and full employment. We've increasingly pushed on full employment as the target metric with inflation, even though core PCE is at 2.9%. We seem to say that's okay as long as it's not moving. Let's make sure employment is safe. Employment is a growth-oriented target. So a push on that over inflation will lead to better easing.
Yeah, absolutely. That focus on the labor market, definitely don't want to forget that. Let's talk a little bit about valuations, because Romaine asked the question, how much does the Fed matter? How much do valuations matter, especially when you take a look at the hottest areas of the market? That has been big tech, that has been AI. How does that evolve in 2026?
We believe that we can remain stable at valuation as long as we continue to see the capital expenditure train continue. Now, we may see a diversification between those that are the haves and have-nots, or the large cap and the mid and small cap, i.e., do we see that broadening in the environment? When we look at the average forward PE multiples, it's about 10 points higher on the top 10 stocks right now than we see on the other 490 stocks in the S&P 500. Both are still relatively high to history. but we could see that continue. We could see, as we see capital expenditure increase, as we see potential productivity gains, as we see a release of consumer stimulus, we could see that multiple remain the same while we see earnings go up.
There have been several strategists, as they sort of plot out 2026, Adrian, that have talked about this idea of allocating a little bit more money outside the U.S. Are you in that camp?
I am in that camp, more in emerging markets than international markets. I think the S&P 500, the United States market, still provides leadership as we stand. And it'll be an interesting week, both this week and next week, with the number of central banks, not just the United States, that are probably going to be a little bit more in the tightening mode, if you will. And Japan is going to lead the way on that, certainly. So with the possibility of that happening, that could mean the U.S. could continue to lead the way, as it has for the last decade, on equity markets. Emerging markets are an interesting area where if we see this growth broaden, if we see the need for commodities and copper increase, then emerging markets are often the number one beneficiary of that. The US dollar then, of course, plays into the game on that. Of if we see a difference between international rates and US rates, it's likely to push the US dollar down further, which puts the emerging markets in a better spot as well in order to facilitate growth. So we like emerging markets better than we like non-US international, but we still think the US is in leadership mode.
Let's talk about the dollar a little bit more directly because, I mean, you think about the year that the dollar has had, certainly one of the biggest losers in terms of an asset perspective, but it seems like the slide was really halted midsummer thereabouts, and the dollar, as measured by the Bloomberg Dollar Spot Index, that is, has pretty much been stable since then. So, I mean, you think about 2026 for the greenback, would you expect more of the same, this sort of stability that we've seen emerge, or would you expect maybe that weakness to resume?
I think we'll see the weakness resume. Now, the first half of the year with the US dollar, the narrative was a little bit different around whether or not the US dollar was potentially losing its status as a safe haven currency. I don't buy into that. That is a much longer paradigm. We're now much more looking at what would be interest rate parity, of the possibility that the US, to say the neutral rate, is more of an easing rate for the foreseeable future, whereas our international partners potentially are in tightening mode. That difference in interest rates will drive potentially the US dollar lower from where we are.
All right, so returning to rate differentials, Adrian, great to get some time with you. That is Adrian Helfert. He is CIO of Multi-Asset Strategies over at Westwood Management. Now, coming up, we're getting more details on who will lead Warren Buffett's Berkshire Hathaway after he retires. The new era begins actually in just a few weeks. That conversation up next. This is The Close.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The stock rally presses pause while the bond market sell-off hits the gas. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. And as Romaine said, not a pretty picture behind me. The S&P 500 down about 0.5%, same level of decline if you take a look at the NASDAQ 100. It's a merger Monday, it's Fed week, and we're starting off certainly on a sour note. I did want to highlight small caps catching the barest of bids. The Russell 2000 higher by about 0.1%. But you take a look at the declines in the big benchmarks, not getting any sort of haven bid into the bond market right now. Taking a look at 10-year Treasury yields higher by 3 basis points. We are at 4.16, almost 4.17 on your 10-year Treasury yield, Romaine. That is the highest level since September.
Another interesting day for the price action. A busy merger Monday, failing to really lift the mood on Wall Street. Equities, which remember last week were doggy paddling toward fresh record highs, now struggling just to tread water. Traders on edge despite another solid earnings season, despite the continued boom in AI investment, and despite conviction the Fed will cut rates this week for a third consecutive meeting.
There's a question of how much is appropriate to cut. What you see at the long end is this risk that inflation stays elevated. The dissents are healthy and a good thing. I think the market's going to deal with it just fine.
All right, and if we unpack that last one just a bit here, because despite those rate cut expectations, Treasury yields have drifted higher, not lower, up for 6 of the 7 sessions since Thanksgiving. In fact, at 4.17% on the 10-year and roughly 3.6% on the 2-year, Treasury yields they're higher today than where they were in September when the Fed began its easing campaign. Curious on one hand, but on the other, go and look at the recent labor market data, or go look at the sticky inflation numbers, or go take a look at the Treasury liquidity that has been sapped by that deluge of corporate bond sales, and you get your answer. Throw in the idea that most asset managers have a relatively optimistic outlook for the U.S. economy into 2026, and you can start to see the reason why that yield steepener trade has become as flat as a pancake. In fact, most Wall Street strategists see a greater case for risk assets next year.
4.15%. Last week, we saw the biggest increase going back to April of 12 basis points in the 10-year. And Brent crude just slightly lower. Coming up this hour, Christian Nolting of Deutsche Bank Private Bank with stocks on the brink of record highs. Victoria Fernandez of Crossmark Global Investments, and why markets may reprice future rate cuts, and Robert Fishman of MoffettNathanson as President Trump pumps the brakes on the Netflix Warner Brothers deal. We begin this hour with stocks rising as traders increase risk appetite ahead of the Fed's rate decision. Christian Nolting of Deutsche Bank Private Bank writing, given the positive macro environment, we expect 2026 to be another constructive year, albeit with continuing market volatility. Christian joins us now. Christian, wonderful to see you. Thank you so much. So let's talk about 2026. Yes, continued volatility. Is there a sea change in where the leadership comes from, akin to what we heard from Ed Yardeni, where suddenly big tech doesn't cut it for leadership? Everyone is a tech company.
Well, I would say we still count on tech, and that tech delivers earnings. We do, though, expect that earnings growth is coming down a little bit, which I think is really healthy. But of course, earnings will be very important, and those companies won't deliver earnings in 2026 will certainly get, say, punished, and that could cause volatility in the market. It's, by the way, one of the reasons why we are saying probably for 2026, let's not be complacent and just expect the same really positive performance we've seen so far this year and likely to get into year end, I hope. So from that perspective, that's something to watch. But I still think that AI is not a bubble. I think it's still a boom and a structural change. And that's why we are constructive for next year as well.
Do you think that the United States is still the epicenter of that constructive change? That was also a big part of Ed Yardeni's call, is that the U.S. has benefited disproportionately to this point, and that is poised to change.
Well, I still look very easily at productivity, and that's the highest in the U.S. And honestly, I don't think that's massively changing next year. Look at Europe, for example. Productivity is far behind the U.S. Hopefully, that's getting better with fiscal policy here. But to be seen, but I think to catch up on the U.S. productivity is very, very tricky, at least in the short term. So longer term, maybe, but it's a long way to go. And from that perspective, I think we have seen this year the 5, but then with the investments coming in, I would say that's continuing.
You make a good note in your research about how the government stimulus we're going to get from the United States when it comes to the One Big Beautiful Bill is going to be timed after 3 Fed interest rate cuts. So, Christian, looking at next year, do you think the Fed needs to cut any more?
Well, I think if you look at the absolute level, I wouldn't be surprised if we see 3 cuts. So starting probably this week with the first, and then 2 more into next year if you look at a 12-month time horizon. I think that could be justified because although there is fiscal spending, yes, and increasing, but I would say at this point in time, and you rightly said we don't have all data yet, but I think the US is a bit in a weaker spot. On the other hand, something I think very important we also say in the outlook is inflation. So if you look at the 10-year US Treasuries, we think they could be 4.15, like exactly where we are right now in 12 months' time, because inflation remains a topic. So we don't see inflation to substantially come down, but even go up slightly from 2.8 to 2.9. That's our forecast.
You also think that policy will deliver a cyclical impulse in Europe. What kind of policies are you looking at? Because Europe at the moment, especially seeing the data out of China, is struggling.
That's correct. But of course, I look at the largest economy, Germany, not because I'm obviously in Germany at this point in time, but so far it was roughly not growing, so 0%. And I do think it could go to 1.3 to 1.5 next year because not of monetary policy of the ECB. There we do expect the ECB to stay steady at 2% for the whole year next 2026. But it's fiscal policy, and that's why we see that government spending, which is coming now. It was a bit delayed, I have to say, but now we see that really happening, which is good news.
Christian, how much is your constructive outlook next year really predicated on this idea of fiscal and monetary support from the United States in particular, but also globally?
Well, it's a major source of growth, absolutely. In the US, we do see Germany especially doing something. It's a lot of fiscal policy, but then the central banks as well. I think Bank of Japan, of course, is different. We expect 2 hikes there. But otherwise, if you look at monetary policy, we counted more than potentially 80 cuts of global central banks. I think that's quite a constructive environment per se, I would say.
Which is probably the reason why, if anyone has a deal to announce, let's announce it. That seems to be the mood of the morning, the mood of the week, and the mood of the month. We've certainly seen that from the likes of Netflix and Warner Brothers. We've seen that with the debt issuance from the likes of Oracle, which reports earnings this week, as well as Meta, as well as a whole host of the other tech names. I'm just wondering at what point you think that it's going to become too much for debt markets to finance, given some of the concerns about the structural changes in this industry.
Yeah, I think there's a lot of discussion about this, but I think it's a normal development. We've seen this in other major structural trend shifts that companies started at one point in time to use also debt because free cash flow was not always enough. I think I've not seen really some bond auctions struggling at this point in time. There's a lot of demand, and I think given all the discussion about sovereign debt, which is there because of all the fiscal policy, people look at also corporate bonds. And if there's an attractive yield, of course, they will go for this, especially if it's investment grade, which we still recommend, although spreads are quite low. So if I don't see a recession, which with all the fiscal policy is quite unlikely, I think then it's still an interesting investment. And again, I've not seen any bond auction struggling at this point in time. But of course, it's something to be watched.
Just heading into next year, Christian, what's your highest conviction trade?
I would still say it's gold on the one hand, to be very honest. On the other hand, what I just said, corporate bonds looks very interesting. On the equity side, with all that fiscal policy, I would say could also be constructive, but don't expect the same double-digit performance. I would be okay if it's like single-digit, high single-digit, say 8 to 9%. That would rather be our forecast.
Christian Nolting of Deutsche Bank, thank you so much for being with us with a gold call. As people continue to look to the precious metal, even though they are bullish on risk, it normally goes the other way around.
Well, also the PBOC just increased their holdings of gold in November, 30,000 ounces. So 13 straight months you see China continuing to amp up their holdings of gold. And what this year has taught us is that risk on, individuals buy gold. Risk off, individuals buy gold. This is something that people continuously want to put in their portfolio.
Especially due to some of the concerns about the fiscal monetization that we're seeing in a number of places. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vanke Quinn. Vanke.
Lisa, good morning. Thank you. President Donald Trump raising significant antitrust concerns over Netflix's planned acquisition of Warner Brothers Discovery. The president warning the deal, which would combine the dominant streaming service with HBO Max, creates a market share that, quote, could be a problem. The comments escalate pressure on regulators, signaling a potential lengthy Justice Department review. JP Morgan CEO Jamie Dimon issuing a warning for Europe in an interview with Bloomberg's Carolyn Hyde over the weekend. Dimon saying bureaucracy is weighing on the continent's growth.
Europe has a problem. I think they accomplished an unbelievable thing, but it got bogged down. It takes 27 nations, to make a decision. They have some wonderful things, but they've gone from 90% of the GDP of America to 65. That's not because America did anything bad to them. It's their own bureaucracy, their own cost. I think the leadership, Merz, Macron, Maloney, Starmer, I think they know. I just think politics is really, really hard.
Dimon adding the risks could have implications for the United States. And after a 15-year-long bet on tech, Wall Street veteran Ed Yardeni is going underweight the Magnificent Seven. Yardeni Research is now expecting a significant shift in earnings growth, suggesting that tech is evolving. Yardeni argues that the rest of the S&P 500 will see improved productivity and profits because, quote, every company is becoming a tech company. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vanke. Up next, affordability front and center.
We are now seeing this affordability problem, and I think next year we're going to move on to prosperity. Now we are working on inflation, and I expect inflation to roll down strongly next year.
Former House Financial Services Committee Chair Patrick McHenry joins us next. Right now, stocks inflecting higher after a weekly gain on both the NASDAQ and the S&P. This is Bloomberg Surveillance. Good morning. Pushing back toward record highs once again, climbing into the end of the year. A real Santa Claus rally potentially reasserting itself, up about 0.1% on the S&P. As you do get a sense of dollar weakness also coming back into the fray, we have seen that sort of steady weakening as you have seen long end yields grind higher. 4.15 on the 10-year. It has climbed 12 basis points last week alone, which is the biggest monthly sell-off in the 10-year going back to April. And copper at a new record, with everyone buying, China buying, the United States buying a build-out of AI. Under surveillance this morning as prices rise in some of the commodity sectors, affordability front and center.
What we're not going to do is say that Americans don't know what they're feeling. We've been working on it every day. Democrats created scarcity, whether it was in energy or overregulation, that we are now seeing this affordability problem. And I think next year we're going to move on to prosperity. Now we are working on inflation, and I expect inflation to roll down strongly next year.
Here's the latest. The White House ramping up its affordability push, eyeing options to bring down beef prices and address anti-competitive food prices ahead of President Trump's trip to Pennsylvania tomorrow. Bloomberg's Tyler Kendall returns to us. Tyler, great to see you once again. What are we expected to hear from President Trump tomorrow?
Yeah, hey, Lisa, good morning. Well, we know that this White House is trying to recenter its messaging on domestic issues, including affordability. And we are expecting President Trump to tout some of the recent actions that he's taken, including over the weekend signing that executive order that's directing the Department of Justice as well as the Federal Trade Commission to look into anti-competitive practices or alleged price gouging, all in a bid, of course, to bring down food prices. We do know the DOJ has launched at least one investigation into one key sector. You mentioned beef. That investigation is looking into meat packers as the price of beef has climbed really steadily since the start of the pandemic. In fact, the Treasury Secretary Scott Bessent was asked about this and how it actually sort of continues a similar policy under the Biden administration, where we saw that administration launch and continue similar anti-competitive investigations. The Treasury Secretary alleged that that investigation was mishandled, but I did speak to one FTC commissioner over the weekend who told me that some of these probes may face some pushback, considering that we've seen these agencies significantly streamlined in a bid to reduce the workforce. Now, Lisa, we also got some reporting from the Wall Street Journal over the weekend that the administration is looking at some policy shifts. This includes potentially reopening the southern border to Mexican cattle imports amid a current ban that is in place in a bid to try to stem the migration of a parasite that has been impacting herds. But Lisa, at the end of the day, it is all about trying to get supply up, particularly when it does come to beef, in a bid to lower those prices for consumers.
Tyler, when it comes to affordability, one thing that continues to come up is also health care prices. Are we going to get a vote this week when it comes to those enhanced subsidies in Congress?
Well, Anne-Marie, it looks like we're heading towards that because, as you well know, Congress is only in session for about 2 more weeks before they break for that holiday recess. And there is a big push to get something over the finish line, considering that those enhanced Affordable Care Act premium tax subsidies are set to expire at the end of the year. And that is setting up a really big political fight. We've seen some different proposals put on the table. We are expecting the Senate to vote on the Democrats' proposal, which would be for a 3-year clean extension. That is not expected to reach that 60-vote threshold. But there are some other ideas brewing, including on the House side, potentially for a bipartisan compromise that would extend those premium tax subsidies for 2 years with some structural changes, such as a different income cap. We'll have to see where this lands. Anne-Marie, as you well know, we're watching really closely in the Senate. Bill Cassidy, a Republican from Louisiana, the chair of the Senate Help Committee, he has been shepherding forward a different proposal completely that would put more money in health saving accounts in a bid to try to help Americans with higher out-of-pocket costs. We're going to watch closely how that proposal evolves, but at this point, it's an open game.
Tyler Kendall, thank you so much for that. It's great to have you back. Welcome back to the show. Joining us now is Patrick McHenry, a former House Financial Services Committee Chair. Patrick, great to have you. Thank you so much for being with us. What do you make of some of the noises coming from inside the White House about some controversy about how to message affordability issues?
Well, it is the driving issue. It's the driving issue that brought President Trump back to the White House 1 year ago, and it's a driving issue for voters at the last election. That message is very clear to the White House, and they have their best economic messenger, Scott Bessent, out there delivering what is a distinct message for this administration. They're going to address it. They believe that they can conquer it, and they can actually get to a prosperity message rather than just conquering the price of things. but it's going to be a tough effort because the stickiness of inflation has impacted Fed policy. It obviously impacted, and the last administration was unable to do anything in substance about it. But the president believes they have a very good economic message. They have to just deliver on the regulatory relief and the tariff negotiations that are foremost with this administration.
Do you think the president himself needs to really look at the words he uses when he talks about affordability? There's this Wall Street Journal article that a lot of aides told him he needs to calibrate his message because, remember, during the Biden administration, they would tell you the economy was doing so well, but people weren't feeling it because of how high prices were.
Well, look, the Biden administration was, don't believe your lying eyes. The economy is fantastic. Do not believe what you actually feel. That is not a winning message. It's a very bad message for politicians at every level to tell the voters that they're dumb and they don't know what they're thinking. So you see a few things that the president floated, that this was a really partisan initiative to talk about affordability. It was coming from the left. I think you're going to see that dialed in the coming weeks and coming months. And I think the clear message here came from Scott Bessent this weekend, going out with really what is a honed economic message that they have deeply contemplated.
Patrick, with all due respect, you say that it was a losing message from the Biden administration. Do you think that affordability is a hoax, a winning message coming from the White House currently?
No, not at all. And so what I'm saying is the president is going to hone a message that is distinct, as he does. And we're all going to watch. His aides are going to watch how he hones it. But no one's going to control his message. They didn't do it the first term. They're not doing it the second term. But when Scott Bessent is out with a very honed, very focused economic message, that's the person we have to dial to. We'll see what Kevin Hassett does this week and whether or not they've doubled down on the Bessent message. That is actually a much more winning message than what President Trump rolled out, which was an echo of what Biden did in his final year or two.
Patrick, do you think that messaging is enough? Or do you think that it's sort of imperative on this administration to deliver $2,000 checks or deliver other kinds of more significant measures that make people feel immediately like they are getting some sort of immediate benefits?
No, the immediate benefit has to come from the regulatory relief they're driving the agencies, which takes time for it to be felt. The tax bill that was signed into law in record speed, 6 months earlier than they did it in the first term, those things will have effects. But the big driver here and the big drag on the economy are tariffs. The cost of things coming in the United States are more expensive because of tariffs. That does have an impact on the economy. It does have impact on people's lived experience. Getting that right is the biggest economic delivery this administration could have. That is far better than any word that any politician can utter.
Patrick, do you think we're going to see some sort of reconciliation from Democrats and Republicans on what to do when it comes to health care? This week, we should have a Senate vote on the enhanced Obamacare subsidies. And I'm just wondering if we're barreling once again, maybe on January 30th, to another government shutdown.
I think that's the most likely scenario, is that we're barreling towards no extension of healthcare policy. And then brinksmanship when it comes to government funding. These things have not been resolved. The Democratic Party has offered not what they said they would offer, which was a one-year extension. They're asking for a 3-year extension of policy. They're unserious. Republicans have had this problem for a very long time on healthcare policy. It's not that they lack a plan. It's that they have too many plans. And so we're seeing this offering on the Senate floor this week, where you have multiple Republican proposals, none of which will get 60 votes. And then we see a unified Democratic Party on a singular approach, which is continuing subsidies. I think this is headed for a train wreck rather than a compromise.
Former House Financial Services Committee Chair Patrick McHenry, thank you so much for those insights. And if Delta and United and American Air executives were listening to this, they're hiding under their desks saying, please don't. Come on, we just experienced these losses.
And if you're a Fed official, potentially you're also hiding under your desk, because what does a government shutdown mean? It means that you don't have the essential workers going out there collecting data. And how controversial already is the data thus far? Because individuals are talking about, well, the government was shut down. How credible is this data going to be? It's so delayed. The Fed's not even going to have the most up-to-date data when they meet next week. Can you imagine we repeat this entire conversation again the start of next year? It'll be another Washington self-inflicted, induced crisis.
Well, especially given the fact that there are real questions about what revenues are coming in, as Patrick McHenry was just talking about, a real pushback now with some of the tariffs. We haven't even gotten that IPO ruling. That could come early next year.
That can come early next year, and then that would potentially put a lot of corporate America in this awkward situation. Do we go and try to get a refund? Do we wait because we know they're going to use other tariff avenues to make sure tariffs stay? There's still some uncertainty in 2026, even though a lot of people think we're past peak tariff.
Well, it's going to be a lot of fun. Everyone's very excited for that right now. We're seeing markets pretty sanguine ahead of the open. Coming up, Victoria Fernandez of Crossmark navigating shifting trends in the market. Plus, Danny Berger with your morning movers. Carvana among the names jumping with new additions to the S&P.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Seems to be countdown to the Fed as futures pointed upward once again, potentially a third consecutive week of gains on the S&P, on the NASDAQ. You're seeing about 0.1% gain on the S&P 500, although fading just a bit throughout the morning. NASDAQ outperforming up almost 0.2%. The Russell 2000 banking on those Fed rate cuts up 0.4% after a tremendous outperformance over the past couple of weeks. When you take a look at 2s, 10s, and 30s, last week we saw the biggest sell-off in 10-year yields, 12 basis points in 1 week that we've seen going back to April, continuing that move up 2 basis points, 4.15% on the 2-year, under 3.6%, still 93% chance of a Fed rate cut. And then that 30-year yield, watch Japan, watch Europe, 4.8%. How much are we seeing this inflection higher due to Fed policy? How much is it a global phenomenon? And when it comes to the global phenomenon, it is in natural resources. Copper hitting a new all-time high, given the fact that everyone is stockpiling copper. Dr. Copper used to be a read on the economy. If this is giving any kind of read, it is that everyone is building out everything all at once. And you certainly are seeing that this morning with copper traded on the London Metals Exchange, 3 hours away from the cash open. Here are your morning movers with Danny Berger. Danny.
Hey, Lisa. It's the deal that continues to be the drama saga, and it is Warner Brothers Discovery, the latest of which our reporting suggested that Netflix CEO Ted Sarandos met with Donald Trump, the president, in order to, get his blessing on this deal. Trump was asked about it at the Kennedy Center. He not only confirmed it, but said he had some serious concerns because it would be a large market share, and that could be a problem. Because of that, and considering Netflix was considered the lead investor in Warner Brothers Discovery, at least the lead in the running, Warner Brothers falls 1%, Netflix gains 1.5%. Next up, some different changes of the composition of the S&P 500. We're getting, Broadcom shares. We'll get to that in a moment. There we go, the magic of TV. These are the shares that are being added to the S&P 500. And this always gets a big rally for these companies just because of all the passive flow that goes into the S&P. So you have Carvana, CRH, Comfort Systems, Carvana up as much as 9%. There's a lot of front running of this, so sometimes the gain isn't as big. In the case of Comfort Systems, those shares up 1.8%. Got a little teaser of it before. It is Broadcom. Those shares are up 1.7% this morning. It's a story from the information that Microsoft has tapped Broadcom to make custom chips for it. Broadcom seen as one of the bigger rivals to NVIDIA, not completely there yet. Even so, those shares up in the pre-market, Lisa.
Thank you so much, Danny. On our radar this morning, Ukrainian President Volodymyr Zelensky saying negotiators are divided over territory in the U.S. peace plan. This coming as President Donald Trump expressed disappointment in Kyiv's handling of the deal. Some new comments coming out this morning, Anne-Marie, from Volodymyr Zelensky as these negotiations and meetings continue to take place in Europe.
Right. He made these comments actually to our colleagues at Bloomberg News. He says there are visions of the U.S., Russia, and Ukraine, and we don't have a unified view on Donbass. Of course, when it comes to Donbass, there was this proposal, and definitely what Russia wants to see is Ukrainian troops being completely withdrawn from Donbass. The Ukrainians say, we are there. This has been our territory. We are not going to leave what we have left of this territory behind. Zelensky also says this, and it makes it a bit more interesting after Trump's comments last night. He says there's one question I and all Ukrainians want to get an answer to. If Russia again starts the war, what will our partners do? He really wants these security guarantees at the end of the day. And it's very unclear where exactly the U.S. is going to line up on that. But it is very clear where Europe is. And I think that's really where he's leaning on right now for that support.
Because that is the consistent support that he's gotten. And it's interesting, in light of some of that, J.P. Morgan, Jamie Dimon coming out over the weekend and saying that a weak Europe is bad for the U.S. Europe has a real problem, talking about the bureaucracy, a real tension, and it seems to have to do with corporate policies in addition to some of the international strength that people are wondering how much Europe really plays into it.
Right. And when it comes to Ukraine, Zelensky is on his way to London. So he's going to be sitting down with a host of European leaders. This is something that we do know that Brussels and Washington do want an agreement at the end of the day, but they do want to make sure that it's putting Ukraine with an upper hand and not all the work that they had in terms of sanctions, freezing assets, has gone to waste.
Yeah. Meanwhile, President Donald Trump raising antitrust concerns over Netflix's planned acquisition of Warner Brothers Discovery. The president warning the deal creates a market share that, quote, could be a problem, signaling a potential lengthy Justice Department review. And you do see an increasing skepticism priced into market expectations of this deal going through this morning. Meanwhile, after a 15-year-long bet on tech, Wall Street veteran Ed Yardeni is going underweight on the Magnificent Seven stocks.
There's a lot of competition. The profit margins have been awfully high for the Magnificent Seven. That usually invites a lot of competition, and that's exactly what's happening.
Yardeni also seeing little reason to continue overweighting the United States, citing the large market size and cheaper valuations among global peers. Let's stick with that story. Victoria Fernandez of Crossmark sharing the cautious sentiment, writing, for now, the bullish narrative can be found, although the pinball movement of risk on and risk off sentiment tells us to be selective. Victoria joins us now for more. Victoria, wonderful to see you in person.
Pleasure to be here.
It's great to have you. I'm just curious what you think about what selective means. Do you think that it is sort of similar to Ed Yardeni's point, which is moving away from some of the highest flyers and looking elsewhere for potentially more upside?
Yeah, I think you have to look somewhere else right now. And we've actually been a little bit short the Mag 7 names for a while. We felt the valuations were too high. There was too much hype around these. We were concerned around some of that cyclical financing and things we've seen. So we've been short for a while on those names. So that makes sense to do that, trim some of those names and look somewhere else. It's those rotations in the market where you really want to look, and we're just now starting to see them. Healthcare has been trending for a little bit, but now you're starting to see it, like you said, in the metals, right? And copper and aluminum and zinc. And you're seeing that globally. You're starting to see it in transports. Global autos are doing a lot better. You're even starting to see it in home builders. So I think you have to start looking at some of these areas where trends are starting to change internally. That's where you want to invest.
And just to be clear, when you say short Magnificent Seven, you mean underweight, not necessarily.
I do mean underweight.
Okay,
I'm
so
sorry.
Just make sure that people don't take that and say, okay,
yeah,
the next Michael Burry.
No,
yeah, I don't
poor
think
Bob
so.
Dahl, our
yeah,
CIO,
right.
was probably having a heart attack.
That's why I wanted to help you out here.
Yes, we were underweight Mag 7. Okay. They are still actually, Microsoft's still our largest holding in our portfolio.
Okay.
Yes.
Well, when you talk about a rotation, how much is that predicated on a reacceleration in the U.S. economy that has to come with more fiscal accommodation, with more monetary policy accommodation? How much is that sort of quintessential in the ongoing rotation that we have seen over the past few weeks?
It's important that we continue to have that rotation happening. I think we're seeing it a little bit. You're seeing these green shoots start to come out a little bit. There was so much concern for a while, labor market weakening, ISM manufacturing is not good. We had Jamie Dimon come out and talk about the cockroaches and all of these things, right? But we are seeing these elements. Weekly jobless claims earnings really aren't going as high as what people thought they would. You're starting to see some strength in areas. Spreads are contracting again. There's this element that maybe things could be better, and you have a lot of stimulus coming at the beginning of next year. Not just from the one big beautiful bill. There's the tax components and the R&D components there, but you also have from the consumer side, you have elements coming in. And you have the World Cup. I know the announcement was made over the weekend. $17 billion they're saying it's going to bring into the economy, and the equivalent of 175,000 full-time jobs. So if that comes in, then I think it gives you a little bit of a boost in the first quarter of next year when we might start to see things slowing in the labor market.
And we may be renaming soccer football in the United States of America, which I think a lot of Europeans were very excited about the president's comments. You sound very bullish about 2026, but then you view like the ADP numbers.
Yes.
And those were incredibly weak. What are you looking at in terms of data now, given we have a very difficult, precarious situation given the government shutdown?
It's difficult because you can look at either side of the coin on so much of the data that's out here, and you could either be bullish or bearish. And jobless claims and ADP, I think, that's one element of that. Yes, it's very weak on ADP. You look at the WARN report where companies have to give notifications of any kind of worker adjustment, any kind of layoffs. That's rising, so that tells you that could be something that's going to kind of foresee lower and weakness in the future. Let's see what jobless claims are this Friday. It's the first time we're going to get that in a while. We'll see what that tells us. But remember, it's all about consumption. And consumption is dependent on compensation for the lower income consumer, where we are seeing some weakness, but it's wealth effect for the higher income consumer. That's stock market, that's housing prices. Those are looking stronger for that element, which is where I think you're going to get the support.
If you think there's going to be a rotation, and a lot of people have agreed with you and we're seeing some of it, it feels like deja vu of this time last year. What makes it different?
I think you have to look at earnings. I know there was a lot of concern going towards the end of last year at what earnings was going to look like. Now we've got this really strong picture going forward. For the next 4 quarters, we're looking at double-digit earnings growth. You're looking at revenue growth, 6-7%. Earnings is what's going to drive the bullish case of this narrative. And I think you've got support there. You're even seeing on small caps, starting to see the expectations come up there. They reached their peak in 2022 and we're nowhere near that level. But you're starting to see that growth in small cap earnings could actually be larger than that in the large cap. If all of that happens, that's your support.
At the same time, you have to wonder if you have earnings that are continuing to accelerate, you have an economy that's doing well, you have a consumer that's continuing to spend, and you have real capital investment. Well, doesn't inflation come back, especially given the fact that we're talking about potential fiscal stimulus? How much does that kind of make you tepid on the debt space?
I think that's exactly the key, and it's probably the reason that if I was sitting on the Fed, and not that they're asking my opinion at all, but if they were,
but we are,
I probably wouldn't cut at this meeting this week because inflation is a concern for me. If you tell me our target is going to be between 2.5% and 3%, I say, okay, we'll give it another 25 basis point cut. We'll see what happens. But it's not. They're saying it's 2%, and I don't see us getting back to 2% anytime soon. I see that inflation pressure being sticky. And so if that's going to be the case, then I think you have that element there that you're talking about.
We do have auctions this week. We have 10-year auctions coming on Tuesday. We have 30-year auctions coming on Thursday at the same time that we have a host of other debt sales trying to get packed in before the end of the year, and we have M&A announcement. When will the market get exhausted, right? I mean, what are you looking for in terms of people saying, no mas, we got it, thanks, cheers, see you next year?
I'm kind of exhausted with the market right now of where we've been. The end of the year, it's been a long year. I think you've got a little bit more to go. I think you've got a lot of companies, and not just tech companies. We've talked about that, right? With the Microsoft, the Alphabet, Oracle, what's been going on with credit in that space. I think that could tire out somewhat soon because of the whole credit story around CapEx with AI. But you've got companies that want to get in there. They want to issue debt before they anticipate rates could go higher, which I think you're going to see maybe not as many cuts, especially when you get the dot plot this week, as people were anticipating for 2026. That means you're going to see yields go higher.
It is wonderful to see you, Victoria.
It's a
Thank you so
pleasure
much
to be
for
here.
being with
Thanks,
us.
ladies.
Victoria Fernandez of Crossmark here, and for that discussion on capital markets, Kevin Foley, Global Head of Capital Markets at JP Morgan, will be joining us at 8 a.m. Eastern. Don't miss that conversation. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vanke Quinn. Vanke.
Lisa, thank you. Ukrainian President Volodymyr Zelensky says negotiators discussing the U.S.-brokered peace initiative remain divided over territory. This comes as President Donald Trump has expressed disappointment in Kyiv's handling of the deal, which he says Russia is okay with. European leaders are meeting with Zelensky today to discuss U.S. efforts to reach a peace deal. The Wall Street Journal is reporting IBM is in negotiations to acquire data infrastructure firm Confluent for around $11 billion. The deal, which would mark one of IBM's biggest acquisitions in recent years, could be announced as early as today. Confluent is valued at about $8 billion and specializes in managing data essential to developing AI. The Trump administration plans to unveil a farm aid package offering $12 billion in assistance to farmers hit hard by low crop prices and the impact of the president's tariff policies. The aid will include up to $11 billion in one-time payments to crop farmers. It all comes amid rising frustration among farmers on the slow pace of Chinese agricultural purchases. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, Netflix's deal starting to buffer.
Well, that's got to go through a process, and we'll see what happens. But it is a big market share. There's no question about it. It could be a problem.
Robert Fishman of MoffettNathanson will not be buffering. He will join us next. I sometimes feel like I am buffering. But here we are on this Monday, heading into the end of the year with gains on futures, poised for potentially a third straight week of gains. This is Bloomberg Surveillance.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Our ultimate goal was to turn the fridge from a storage box to a smart kitchen manager that helps the users.
That comes down to finding the optimal location for our camera.
I am most proud of our image matching algorithm. The entire user experience has to be fast and seamless. When it worked like we expected, it was really a breakthrough.
Inflecting higher ahead of the potential Fed meeting where they are going to potentially cut rates, 93% chance priced into markets right now. A little bit of a lift after 2 straight weeks of gains, seeing almost 0.1% gain on the S&P, outperformance from both the NASDAQ and the Russell 2000, seeing a little dollar weakness. 10-year yields inflecting higher. Watch this space, especially with that 10-year auction coming out tomorrow, given the fact that we saw the biggest month of bond yield rises last week, going back to April, and copper reaching an all-time high under surveillance this morning. Netflix's deal starting to buffer.
Well, that's got to go through a process, and we'll see what happens. Netflix is a great company, and they've done a phenomenal job. Ted is a fantastic man. I have a lot of respect for him, but it's a lot of market share. He's done one of the greatest jobs in the history of movies and other things. And he's got a lot of interesting things happening, but it is a big market share. There's no question about it. It could be a problem.
Here's the latest. President Trump weighing in on Netflix's $72 billion deal to buy Warner Brothers Discovery, saying it could face difficulty being approved due to antitrust worries. Joining us now is Geetha Ranganathan of Bloomberg Intelligence. Geetha, we talked about this last week. This was going to be an albatross to get through the regulatory hurdles. How much bigger do they get over the weekend?
It definitely got a whole lot bigger with President Trump. I mean, there was first the scoop from Lucas Shaw, which seemed to suggest that Netflix had, Ted Sarandos had actually met with President Trump before the deal. And then, of course, you have him kind of weighing in This is going to be a very, very long road, Lisa. There is no doubt about it. We're going to get a whole lot of noise. There is the constant question looming about the two services, the Netflix platform with over 300 million subscribers, HBO Max with over 100 to 130 million subscribers. I mean, that pretty much makes up over half the market. And so, the question is going to be whether Netflix is going to be forced to divest HBO Max down the road. But expect a lot of noise, and that's kind of reflected in the $5.8 billion termination fee, one of the biggest fees that we've seen so far in the history of media deals.
Yeah, and a question of how this is all going to get financed. Geetha Ranganathan of Bloomberg Intelligence, stay close. We'll be catching up with you throughout the day and week ahead. Robert Fishman of MoffettNathanson writing, ultimately, we think the likelihood of approval comes down to how successful Netflix will be in defining the market beyond the traditional media landscape. Robert joins us now. Robert, this is one of the most fascinating deals because it's at the cross-section of politics and, frankly, a deep transformation of the media space. How do you expect Netflix to spin this to indicate that they're not quite as dominant as the potential 450 million subscribers might suggest?
Yeah, thank you. So when you look at the market, it really comes down to how you define it. And when you look at the streaming market, Netflix is actually number 2 right now to YouTube. That's something that not a lot of people really know out there. So when you think about YouTube and the size and scale of a free platform, that's how Netflix is thinking about this in terms of the share that they get on the total streaming, not just streaming, but the total viewing platform. And that doesn't even include other short form content like TikTok and Instagram. And so really when you define what the marketplace is, that's how Netflix is going to look to take this to the regulatory approval process.
I think most people think that they're just going to talk about Amazon's Prime, Walt Disney when it comes to streaming. So the likes of TikTok and YouTube make this a little bit more interesting. Do you think it's going to work with the regulators?
I mean, time will tell, but I do think Netflix clearly has a point, right? When thinking about who they're competing against and what the long-term view of the media landscape looks like. YouTube is that biggest media player out there. That's what my colleague Michael Nathanson has been writing for a long time now. So we can't ignore YouTube and thinking about Alphabet and these other large digital players when defining the market. So yes, within streaming and subscription streaming, I should say, Netflix clearly has dominated and won that war. But when you think about the broader market overall, I think you have to factor in these other players.
I think we also have to factor in what the President of the United States said last night, Robert. He said that this would be a big market share. It could be a problem after our colleague, Lucas Shaw, reported that the co-CEO of Netflix left the White House. And apparently Trump had said Warner Brothers should just sell to the highest bidder. Do you think the President of the United States getting intimately involved in this deal could potentially mean problems?
Yeah, I mean, there's a lot to still play out here. I think something that we're quietly, very focused on right now is Paramount Skydance really done? And so I think that there's a lot more noise that could come within this whole bidding war. Clearly, Netflix has won in terms of the announcement and moving forward with this regulatory process. But what we're most interested right now is Paramount Skydance going to come back with a either more aggressive bid, or are they going to take their bid and go hostile towards the shareholders?
Robert, this feels existential, and I'm not sure who it's more existential for. It was thought to be more existential for Paramount Skydance, but suddenly there's a real question that maybe for Netflix, it's equally existential. What do you think? I mean, who sort of has the bigger motivation to make this happen?
So I think Netflix has looked at this as an opportunistic, rare opportunity. I think what was their words they used in terms of what this asset and these multiple assets and all of the premium IP that comes with it. Thinking about the Warner Brothers studio, both theatrical, TV studio, and of course, let's not forget HBO and all of the premium content that comes out of that. So from Netflix's standpoint, they also have a lot of amazing data that they've gotten from Warner Brothers Discovery over the years of licensing that content and seeing how it performs on their platform. So for them, they see this as clearly a very unique opportunity that they have to monetize this content, increase engagement, and really, grow the asset in some direction that they think that they could do a much better job of under their own platform than Warner Brothers Discovery could do with a subscale platform. Yes, it's clearly a big platform compared to some of the other competitors, but Netflix just takes it to a different level. For the other guys, and you mentioned Paramount Skydance and even Comcast and what they're looking to do for Peacock, it does become some sort of an existential question because those are the platforms that need this content, we would argue, even more to really help fix and define where their future is going in terms of how they're looking to compete with the Netflixes, Disneys, Amazons of the world. So for them, we do think that ultimately they need it more than Netflix does.
Just quickly here, Robert, was looking at Cinemark shares on Friday, down 8%, AMC down almost 3%. Are movies dead in the movie theater?
I definitely wouldn't call them dead, but this is a new threat that they've been through definitely some difficult years and have gotten through a lot of that and most of that on the other side. This is a new one. And in terms of what this means for theatrical releases, Netflix has already indicated that they plan to keep the business operations, as it currently stands today. That means theatrical releases for Warner Brothers Discovery, but clearly, given Netflix's own strategy with theatrical releases, it raises questions in terms of what that ultimately means for how long the window is going to be for the Warner Brothers Discovery releases, the Warner Brothers releases, and what Netflix will look to do with that with their own content. So lots of questions that this raises. So far, Netflix is saying status quo, but I think investors, as you point out, have some skepticism around that.
Robert Fishman of MoffettNathanson, thank you so much for the insight. Definitely Hollywood, not exactly excited about this particular deal.
Oh, yeah. Front page Variety this weekend. Is Netflix trying to buy Warner Brothers or kill it? This is huge trepidation across Hollywood on what a streamer wants to do with their massive catalog and their massive studio. This is a icon in Hollywood. But of course, at this moment, can Netflix really say they want to really shake it up, as they know that the main hurdle ahead of them is getting this through the DOJ antitrust committee?
Yeah, and it comes at a time of a lot of deals. We're going to be talking about some other deals in the tech space in addition to that behemoth in the media. Coming up next, Anastasia Amoroso of Partners Group, Henrietta Trey's of Veda Partners, Jordan Rochester of Mizuho, and Kathy Jones of Charles Schwab. This is Bloomberg Surveillance. Good morning.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
The economy seems to be really solid.
There's going to be a lot of noise in the first and second quarter in the data.
I don't think the trajectory of Fed policy is dramatically different over the next 12 months.
Almost regardless of who sits in that new Fed chair seat, we're moving into this era of fiscal dominance.
You can pick and choose whatever economic data you want to fit the narrative you want to tell.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Another Monday. Good morning. Welcome to Bloomberg Surveillance. Looking ahead to a key Fed decision with traders positioning for more rate cuts, 93% chance priced in. Oracle earnings on deck with Eddie Ardeni underweighting big tech for the first time in 15 years. And deals abounding. The latest in Netflix's big offer setting reverberations through Hollywood. Trump casting a shadow of doubt. Other deals really coming to the fore. A question here, though, about antitrust and potential political implications.
Well, and the president is putting himself right in the middle of that. He's saying he is going to be part of this, even though historically presidents don't really get involved in this. This would be the antitrust portion of the DOJ that's going to have a very long process, because it will be, to the president's point, a big market share, which is why it's so interesting the way Netflix is approaching this. They're not just going after the fact that they're saying, look, we want to compete with Walt Disney and streamers like Amazon Prime. They're talking about the fact that they also want to compete within this more nuanced, newer media space. Think of TikTok and all the content that's coming out of ByteDance TikTok and things like YouTube. Interesting if that's going to land at the DOJ.
Meanwhile, there are lots of deals, right? So this is sort of piles onto other questions around how much the debt markets, how much just stock markets in general are going to accommodate the ongoing deals. Overnight, the Wall Street Journal announcing that IBM is planning to buy Confluent for about $11 billion. This is a tech deal. The interest here is it is related to artificial intelligence and data managing. It also goes to the question of how much is size the only weapon you have in a battle that is heating up and, frankly, facing a lot of questions about how long it can continue with respect to AI dominance.
Well, these 4 years during the Trump administration, everyone was talking about how now is the time to get deals done. There's going to be this deregulatory push, maybe a lighter regulatory touch in Washington, D.C. But of course, when it comes to anything touching AI, the question still remains, and a big one into 2026. You look at this, the Bank of America survey on credit, is this idea of the circular financing. How much trouble is actually AI in? And in 2026, are we actually going to see the companies that are benefiting from AI, not just the massive players like NVIDIA, basically, Microsoft and the likes?
Yeah, everyone's a tech company in Ed Yardeni's mind, which is the reason why he is going to underweight big tech for the first time in 15 years. Meanwhile, people are overweighting the chance of a Fed rate cut, 93% chance priced into the market right now, with Fed Chair Powell in a very lame duck meeting on Wednesday, where he's going to get out, give some signals, and the market will have to take it as it is, really looking toward that decision as the hallmark event. But we're also getting data, JOLTS data coming out tomorrow, job openings. On Wednesday, we get the employment cost index, which is going to be key to understanding the inflationary pressures. We also get Oracle earnings, jobless claims, Broadcom earnings. That's all coming out on Thursday, with a smattering of bond auctions thrown in for good measure. In markets, we are seeing an inflection upward, sort of lift to the spirits of people hoping for some sort of Santa rally heading into year end, up about 0.1% in the S&P following 2 straight weeks of gains. We had seen the outperformance coming from the Russell 2000. We continue seeing that outperformance this morning, given that expectation for the Federal Reserve. Euro dollar seeing that dollar weakness just continuing to mount, almost at 117 on the euro dollar cross. 10-year yields inflecting upward once again after the biggest increase in yields in 1 week, going back to April last week, and copper reaching an all-time high. It is copper's world. We're all just living in it. Coming up this hour, Anastasia Amoroso of Partners Group. As Wall Street looks for another winning week, Henrietta Trey's of Veda Partners as the Trump administration prepares to unveil billions of dollars in aid for U.S. farmers. And Kathy Jones of Schwab, with investors keeping a close eye on the Federal Reserve. We begin this hour with stocks hovering near record highs after weeks of fluctuation. It hasn't been a straight ride up. Anastasia Amoroso of Partners Group writing, higher highs may still lie ahead, and should volatility return in 2026, we are prepared to seize the opportunities it brings. In other words, buy the dip. Anastasia joins us for more. Great to see you. Thank you for being here.
Good morning, Lisa.
So there is a different feeling, though, heading into next year, that maybe the leadership is going to be different. Is there anything in terms of the opportunities that you pick up, the volatility that you want to buy, that indicates a shift in terms of who is going to lead 2026?
Yeah, that's right. I think the air does feel a little bit different because we are starting with, pretty elevated valuations, very tight credit spreads, and sort of this abundance of concerns, whether it's about AI valuations or the AI exuberance or, private credit even. So I do think we have to go into the year saying, look, the backdrop for markets is supportive. The tailwinds from policy are still there, but we have to be more selective. We have to be more discerning. And so, for example, at Partners Group, as we think about underwriting transactions, we have to think about, can this company work its way through an entire business cycle? If there is a turn in the economy, can it withstand it? We also have to think about what multiple are we actually paying and what is the exit multiple likely to be? Will it actually be higher from where it is today? So those are the types of considerations that you have to have when you're investing at high altitude. And, I would say also when we think about within our private equity business, for example, control investments versus secondaries. We do have a preference towards control investments, for example, because, multiple is one thing, but the ability to control the outcome of, operational value improvement or the earnings growth is another. And we prefer to have that control. While the secondaries discounts, for example, have closed in, they're at a 13% discount for private equity for secondaries and somewhere closer to 6% on the index level. So that's how the preferences have changed.
It's fascinating to hear the way that you talk about this, because on one hand, when you talk about opportunities and we hear a lot of the optimism around Wall Street for 2026, it comes with this expectation of a reacceleration of the U.S. economy.
Yeah.
What you're talking about is trying to be independent of the economic cycle. Can you sort of explain why that is crucial now, given that everyone expects fiscal and monetary support to lift all tides in 2026?
Right, that's right. Well, that is consensus expectation. We expect the tax cuts to benefit the economy. We expect the rate cuts to benefit the economy. And I also think the midterms kind of mindset should also benefit the economy. But that is consensus. And, there's nothing wrong with consensus. But when you couple that with those high valuations, that's why we have to kind of think a little bit differently. And so once again, we do develop a variety of stress test scenarios where, it might be base case growth, it might be stagflation, it might be a productivity boost, and we want to invest in companies that can kind of persevere through a variety of those.
You asked a question in your note, what could sustain progress towards new highs in 2026? And it's policy once again. Besides the fiscal impulse, which already pretty much is baked in because that happened in 2025, in terms of we are expecting that, what else do you think we can get in terms of policy?
So I would say three things to that. So first of all, yes, the rate cuts are baked in as far as the yield curve, shows you, but they're not actually baked in as far as the economic impact. And so we are expecting the Fed to cut rates again this Wednesday. So 75 basis points all in, but 75 basis points is on a $11 trillion of floating rate debt that has to reset lower in the U.S. economy. It's starting to reset lower, but not all of it has reset just yet. The other side of that coin is you do have fixed rate maturities and the refinancings of those that have to take place. So, for example, there's about $1 trillion of corporate maturities that have to be refinanced. So as that happens, that's the impact that will be actually delivered to the U.S. economy. So that's the first thing. The second thing is the tax cuts. Once again, is consensus, but whether it's getting larger refunds that we've been accustomed to or paying less in taxes, and also corporations benefiting from some of those enhanced R&D expensing, all of that is still to come in 2026. And the last thing, Anne-Marie, I think you'll appreciate this, kind of looking at the political spectrum, we're heading into the midterm elections. And if you are a Republican voter, you feel great. If you are a Democratic voter, you feel not at all great. And if you're an independent, you felt pretty okay coming into the year, but that confidence has slumped throughout the course of 2025. So I do think the administration is going to try to do something to shore up consumer confidence, specifically of that independent cohort going into the midterms.
I'm glad you brought that up. University of Michigan, we always joke, is very partisan, but in January, it had a 70 reading.
Right.
Now it's at 53. It's better than last month, but it's still pretty weak. Do you think everything you just discussed is actually going to change how the American consumer feels next year?
I think the administration is going to try, likely to make moves to change that, because you can't go into the midterm election year with, basically record low consumer confidence and expect a good outcome. So I think that's why we're starting to hear some of those measures, maybe rolling back some tariffs on certain line items, maybe, providing that $12 billion slight stimulus to the farming industry. So I do think in 2026, we will see more measures that are designed to shore up that confidence.
A lot of that people have pointed to for the weakening in the dollar. A lot of that people have pointed to for the steepening in the yield curve, although other people might argue that it's a global phenomenon. How much does that change your desire to buy U.S. assets over international ones based on this question of what type of stimulus will ultimately drive inflation, will then drive some sort of monetization of the debt, and then will drive some sort of shift away from the dollar?
Right. Well, first of all, I was never personally in the end of U.S. exceptionalism camp. And, part of the reason for that is U.S. still has one of the lowest corporate tax rates that's out there amongst developed market economies. We still have a solid consumer foundation, and now we have this economic stimulus that's coming. So it's hard to avoid that, despite currency fluctuations. So I think we have to have presence in the U.S. Oh, and by the way, it has the AI trade and innovation. But at the same time, I think, Lisa, what's changed is this notion of localization of supply chains and this notion of fragmentation. That is different, and that is here to stay. It's not only here because of the current administration and the trade policy, it is here because of COVID as well. So what that tells me as an investor, I can't just buy a U.S. company that's multinational and expect that to sort of check all the boxes. That's why we are big believers in regional diversification. And, on our platform, we have probably 40% exposure to Europe, for example, because there's a different set of economic stimulus that we expect coming out of Europe. We do think the ECB has scope to cut rates 1 or 2 more times in 2026. And at the same time, Germany went from running a budget surplus to running a budget deficit. So that should shore up the European economy as well. So to us, it's not a matter of one or the other, but it's a matter of making sure you have exposure to both to capture that growth.
Are you stockpiling copper in your basement?
No, not recently. No.
Are you? We'll check back. Not yet, but I've thought about it.
Remember when they were trying to get you, Tom and John were trying to get you to buy
oil
when it was -0?
Yeah, a bit of a question with the Children's Administrative Services when I tried to put it in their room. It's Anastasia Amoroso of Partners Group. Thank you so much for being with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief. President Donald Trump raising antitrust concerns over Netflix's planned acquisition of Warner Brothers Discovery. The president warning the deal creates a market share that, quote, could be a problem. The comments escalate pressure on federal regulators. Meanwhile, Unilever's Magnum ice cream starts trading today in Amsterdam, London, and New York. The spinoff was valued at over $9 billion. The company, which owns Ben & Jerry's and Cornetto brands, is debuting a month later than initially planned after the listing was delayed by the U.S. government shutdown. Do you have Magnum a lot? I don't know. I'm usually a Haagen-Dazs person.
So.
Oh, yeah, there you go. All right, so going with some soy latte stuff. French President Emmanuel Macron warning the EU may take strong measures against China, including tariffs, if Beijing fails to address its trade imbalance with the bloc. Macron says it's a, quote, question of life or death for European industry. And that is your Bloomberg Brief. Up next, a bridge for farmers.
If everything's fine, then why do farmers need a bridge payment from the Agricultural Department?
Because these prices haven't come in, because the Chinese actually used our soybean farmers as pawns in the trade negotiations, and we are going to create this bridge.
Henrietta Trey's of Veda Partners joins us next. This is Bloomberg Surveillance.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Coming into a new week with new gains ahead of that Fed meeting on Tuesday and then into Wednesday when we get the rate decision and the press conference afterwards. Right now, futures inflecting higher, up 0.1%, led by the Russell 2000 once again. Can we get that rotation back underway, up 0.4%? The NASDAQ also doing better than the S&P, up 0.2%. A real question of how much the Russell 2000 can keep outperforming without the participation of a rally in the bond space. Right now in the bond market, you are seeing a lift to yields across the board, priced down, led by the mid section, right? The 10-year yields, which saw a huge sell-off last week, continuing that grind higher in terms of yields, price lower, 4.15% on that 10-year, ahead of a key slate of auctions this week. We've got $39 billion of 10-year notes being sold tomorrow. We have $59 billion of 2-year notes being sold later today. A question about the appetite here, especially given discussion of more fiscal stimulus. Under surveillance this morning, a bridge for farmers.
If everything's fine, then why do farmers need a bridge payment from the Agricultural Department?
Because these prices haven't come in, because the Chinese actually used our soybean farmers as pawns in the trade negotiations, and we are going to create this bridge because, again, agriculture is all about the future. You've got to start financing for planning next year, when things will be very good.
Here's the latest. The Trump administration planning to release a farm aid package today, offering $12 billion in assistance as farmers feel the impact of tariffs and low crop prices. Bloomberg's Tyler Kendall joins us now. Tyler, this was widely expected for a while. Do we have a sense of the details of this plan?
Yeah. Hey, Lisa. Good morning. And you're exactly right. A USDA official does tell me that the administration has been working on this for months and that it was initially delayed due to the government shutdown. But this is long-awaited aid for a key support group for this White House. Bloomberg News is reporting that it will include one-time payments to crop farmers under the Department of Agriculture's newly designed Farmer Bridge Assistance Program. About $11 billion is going to go to what we typically think of as crop farmers, and then the remainder amount of that money is going to go to those not typically covered under this program, such as specialty products. Of course, though, this is going to include soybean farmers, which have been hit particularly hard by the trade tensions with China, even as China does gradually resume its purchases after that agreement was reached between President Trump and Chinese President Xi Jinping in October. And since then, we have seen a run-up in soybean futures, yet prices still remain near some of their lowest levels since 2020. And at this point, if we look at the data, China has only made good on about a quarter of its purchase commitments to the U.S. when it comes to soybeans for this harvest season, though, of course, Beijing does still have until February. Just for context, of course, this does continue a policy that we saw under the first Trump administration, which gave about $28 billion to farmers between 2018 and 2019. Lisa, we will get fuller details later today at 2 p.m. Eastern. President Trump is holding a roundtable at the White House with farmers where he's expected to announce this package alongside the Treasury Secretary Scott Bessent and the Agriculture Secretary Brooke Rollins.
Tyler Kendall, thank you so much for the details. They will be catching up with you throughout the day and week. Henrietta Trey's of Veda Partners joins us now for more. Henrietta, what's your takeaway from the approach of the administration when people are starting to feel the pain? You plug the gaps with some sort of aid package or cash infusion.
Yeah, it's a replay of the Trump 1.0 playbook, which is, trade wars are political. So if China is getting hammered by U.S. tariffs, their retaliation function is to go after U.S. farmers. So I believe we did this exact same bailout package 3 times in the president's first term, that it took him 11 months to roll it out in his second term is surprising. But as Tyler pointed out, it was mostly due to that government shutdown. They couldn't get the CCC under the USDA funded with the backlog of cash that they could then siphon off to farmers. So now the government's reopened, they can get that aid flowing. Given China is well below its purchase commitment for 2025, we're probably going to see at least 2 more of these bailout packages emerge in 2026. And that's something that Republicans on Capitol Hill will have to, explain to farmers is, a trade-off for the president's immigration policies, for the tariff policies, higher fertilizer costs and all those components that will persist into 2026.
We also have potentially one plan regarding beef prices about potentially letting more cattle from Mexico come in. Henrietta, do you think the administration is going to take that approach? This was some Wall Street Journal reporting.
As cost for consumers remains at the foreground and if we go into a 2026 midterm election cycle, your grocery price issues are going to be front and center all day, every day, along with electricity, beef, milk, eggs, all those things that consumers are buying every single day. So this is another strategy where the administration can go after the meat packers, try to include more trade with other nations. Brazil was one that got the cattlemen ranchers really worked up and move into Mexico makes sense given we're going to renegotiate the USMCA over the next year. There's a lot of moving parts, but the White House needs to get this affordability narrative under control, and they're going to have to cover all their bases.
Well, on Saturday, they called for the DOJ and the FTC to look into potentially really anti-competitive behavior that exists in corporate America. This is very reminiscent of 2023, 2024 Biden administration when they were talking about price gouging and shrinkflation. It didn't work for Biden. Do they think it's going to work for Trump?
It's really just about getting a message out here. I think you're making it exactly the right point, and the administration tries to do it all the time. Consumers are getting smoked from all ends, whether it's healthcare, housing, groceries, apparel, industrial, anything that they want to buy, from a car to a refrigerator. all those prices are up and elevated, and they have not come down from the Biden administration or at the end of COVID under the first Trump term. So that persistent issue of inflation and prices is perennially number 1 and 2 issues of every American voter poll that's taken from every pollster, whether it's Fox News or The Economist. Everybody's seeing that the number 1 issues for the U.S. consumer are inflation and prices. So tackling all these components through whatever means they can, and just even the appearance of trying is sometimes the most you can do from the White House. So it's no surprise that they're repeating what the Biden administration did as a way to just try to say that they're focused on affordability.
Well, what's Congress's role going to be in this? We just had the longest government shutdown in history, and then potentially, and Patrick McHenry, the former Finance Committee chair, was talking about how he's expecting another government shutdown come January 30th.
Yeah, unfortunately, I had to raise my odds from 20 to 25% that we shut down on January 30th as well, mostly because they're not going to find a fix to the ACA subsidies issue. And this is on the healthcare front. You're looking at price increases for 22 million Americans of between $200 and $920 per person, depending on your age. So there are these price hikes coming through, along with higher electricity bills and continued tariff authority, and all these issues that are facing the U.S. consumer that keep inflation front and center, prices front and center. So getting the government functioning to the point where you could even pass legislation to help them out is really basically a 10% or less scenario, in my opinion. The fact that they are probably going to, potentially going to shut the government down again at the end of January just speaks to the dysfunction in D.C. There's so many retirements. There's so much, incompatibility and anger between the two parties and even intra-parties sometimes. I don't see a lot of ways to get things moving from D.C. going into next year.
Well, Henrietta, just to pick up on that point, I am wondering how much the president is losing his clutch over the Republican Party, given the fact that there is increasing pushback, not just with respect to the messaging over affordability, but also with respect to the handling of Defense Department leader that we've heard over the past couple of weeks over the signal issues, as well as what happened off the coast of Venezuela. I'm just wondering, do you see increasingly hardened divisions between President Trump and the rest of the Republican Party?
I think there's a couple things here. One, you're seeing about 24 Republicans announce that they're going to retire rather than run for re-election. You can redistrict all you want, but it's not netting out for a winning scenario for the Republican conference when one party controls all of D.C. So now we have 3 major states, Tennessee, New Jersey, Virginia, that have held elections since Trump got elected, and Democrats are winning by anywhere between 12 and 22 points. That suggests a wave election year, which is normal for any year when, one party controls all 3 chambers of Congress. So as we head into 2026, what you're starting to see are losses. And that means that we're already talking about 2028. We're already in sort of a lame duck session for the president, and that's going to become more of the narrative. That makes it harder for President Trump to exert, material control on his voting members, who are going to now pivot from getting through a primary election cycle into a general election cycle, where their challenger is not, a far right or moderate Republican, but now a Democrat, and they have to moderate themselves. And that creates fissures within the party. And you'll see that throughout 2026. It's only going to build.
Henrietta Treyz of Veda Partners, thank you so much for being with us. The idea of another government shutdown, I'm sure, sends chills down the backs of everyone who's ever in transportation, as well as, frankly, looking for government data.
Also, those that are federal workers, and potentially they're not going to get another paycheck. Henrietta is talking about what we're seeing in polling. I think we should note. Polling, people are saying high prices, still a problem. It's been a problem since COVID. It was a massive problem under the Biden administration, and it's still lingering. But some of the data, especially out on the heels of Black Friday, show the American consumer still has been resilient. They are still going out and spending. Wall Street Journal says, you know what? They're just cranky, not choiceful. They're cranky.
Well, and this is the reason why people have some more optimistic views for next year. Coming up next, Jordan Rochester of Mizuho on the potential market game changers in 2026. Plus, Danny Berger with your morning movers. Tesla shares sliding on the back of an analyst downgrade. Those shares down by 1.3%. Good morning.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Global electricity demand is set to surge 75% by 2050. Infrastructure alone won't keep up. To power the future, we must change how energy is used, not just how it's generated. The missing link? Demand-side solutions that unlock efficiency, productivity, and resilience. The Bloomberg New Economy Energy Technology Coalition is uniting industry, innovators, and investors to scale these technologies for a future-ready energy system. Learn more at bloombergneweconomy.com/ntech.
So maybe it really is going to be the Santa Claus rally December that people were expecting. We did see 2 straight weeks of gains, although just now climbing back toward all-time highs, up about 0.1% on the S&P, just grinding higher, but staying around that level throughout the morning. A bit of dollar weakness. Watch the space. The Bloomberg Dollar Index has been slowly grinding weaker over the past few weeks, continuing that trend this morning, 116.49 on the euro-dollar cross. 10-year yields continuing to climb before that auction on Tuesday, tomorrow. 10-year yields 4.15%, and copper at an all-time high, 2 hours away from the cash open. Here are your morning movers with Danny Berger. Danny.
Hey, Lisa, we start with the deal of the day, the month, the year, perhaps, and it is the drama over Warner Brothers Discovery. Over the weekend, President Trump at the Kennedy Center telling reporters that he has looked at the deal and the giant amount of market share if Netflix buys Warner Brothers Discovery could be a problem. In his words, we know Ted Sarandos of Netflix went to the president to try to get his blessing. Most of the losses have eased off. Warner Brothers Discovery now only down 0.7%. Netflix rallies again just up 0.5%. Elsewhere, in terms of moves that we are seeing this morning, Tesla shares falling 1.4%. Morgan Stanley downgrading from overweight to equal weight. We also have a new analyst taking over from the longtime Tesla analyst and issuing this new call, basically saying all the non-auto related news that it's already priced into the stock, so it just lessens the upside. So again, Tesla trading at 448 this morning. Finally, wrapping things up with CoreWeave moments ago announcing that they are issuing $2 billion worth of convertible bonds. A couple things going on here. One, it's just a dilutive event, so shares tend to fall. But again, it's this concern about growing debt piles by tech giants in order to fund some of the AI spending they're doing. So CoreWeave shares down 5.2%, Lisa.
Thank you so much, Danny. Just crossing about a half an hour ago, JP Morgan tapping Berkshire Hathaway's Todd Combs to head its strategic investment group. At Berkshire, Combs helped oversee parts of the company's $283 billion equity portfolio alongside Warren Buffett and Ted Weschler. The move comes amid a shakeup at Buffett's firm as the company prepares for his retirement, and it really goes among a whole host of departures that we've seen at Berkshire Hathaway. Two sides of the story. On one hand, with a Berkshire Hathaway going forward, post Warren Buffett, as he does enter a quiet period ahead of his retirement. But then a real question around the strategic initiative over at JP Morgan that Jamie Dimon announced. Todd Combs will be reporting directly to Jamie Dimon with a key initiative that really does seem to be a linchpin for the bank strategy going forward.
They've been talking about these economic security concerns. They want to put $1.5 trillion into these industries that is critical to the United States. You think of things like rare earths, building out data centers. Individuals that sit on this committee within Jamie Dimon are individuals like Condoleezza Rice, former Secretary of State, former Defense Secretary Gates, individuals like Jeff Bezos. They are going all in on this, and they clearly see, especially with him reporting directly to Jamie Dimon, as being a pillar when it comes to these investments.
Yeah, and it comes, just to put this in perspective, Tom Combs is leaving Berkshire Hathaway after not getting the CEO position. And he was thought to be a successor. So this kind of shifting in the sands we're seeing across a whole host of Wall Street firms as we do see people stepping down and paving the way to new leadership. Meanwhile, under radar, President Trump raising potential antitrust concerns around Netflix's planned acquisition of Warner Brothers.
Well, that's got to go through a process, and we'll see what happens. Netflix is a great company. They've done a phenomenal job. Ted is a fantastic man. I have a lot of respect for him. But it is a big market share. There's no question about it. It could be a problem.
The Justice Department will be conducting a lengthy review of the $72 billion deal, and we are seeing in Polymarket the odds of this deal going through now 25% down from 60% on Friday.
Because the president, that last line at the very end, he was pretty much fine until he said it could be a problem. So everyone is thinking, potentially, is there going to be this White House that puts up a little bit more of a hurdle when it comes to regulatory process, which the president normally would never get involved in? This is going to be for the DOJ to decide if this really is anti-competitive behavior. And Netflix is starting to get a bit more creative. It's not just the normal streamers like Walt Disney. They're looking at making a case. Look at where the media environment right now is, which is why this is so interesting. You have to think of things like TikTok, things like YouTube. And on that space, they're saying this is how we can remain and be competitive.
Yeah, Merger Monday, meanwhile, making a comeback. And this really has been a theme throughout the second half of 2025. The Wall Street Journal reporting IBM is in negotiations to acquire data infrastructure firm Confluent for around $11 billion. The deal, which would mark one of IBM's biggest acquisitions in recent years, could be announced as soon as today. Confluent is valued at about $8 billion. Confluent shares absolutely surging, IBM flat, but really goes to an existential race among the tech players to get enough data capabilities, to get enough AI prowess, and frankly, power in order to remain dominant and remain relevant heading into the next chapter.
Especially for IBM, because they're also putting an emphasis on quantum computing. But I think you're exactly right. This just also goes to show, because there's that need right now, you're going to see a tremendous amount of consolidation in this space.
And you already have seen quite a bit year to date. Turning to 2026, Wall Street predicting a number of market scenarios for next year. Mizuho is out with its Gray Swan report. The team writing, these are low probability, high impact events that sit outside the usual base case and consensus risk scenarios. Joining us now is Jordan Rochester of Mizuho with his Gray Swans. Before we get into the Gray Swans, let's talk about the really obvious sun in front of us. What are sort of the base case that you see as most likely heading into 2026?
Well, I think next year is going to be a year where the consensus has gone into it thinking that the Fed's going to cut rates thanks to a new Fed chair, and that everything will be fine. We'll get to a 3% terminal rate. The one-year pricing is roughly around that sort of level. Let's imagine it's Kevin Hassett, and he'll sway all of the committee to become dovish. But what if the data doesn't turn that way? I guess is the sort of main risk for next year. For us, I think the first quarter and the second quarter, before the new Fed chair arrives, the problem for the market might be that the outgoing Fed chair, Jerome Powell, doesn't cut rates, and as a sort of goodbye to markets. That might be the story for Q1 and Q2. So
let's talk about what the ramifications of that could be. If, let's say, there are 4 dissents for cutting rates at the meeting on Wednesday, and 5 that go for this idea of keeping them where they are, or if it's some sort of mix of the two, how much do you see markets seeing a massive rebound that they don't or massive drawdown that they don't recover from?
Well, I'm sure they'll recover from it. What's been the case for the past 2 or 3 years now is that rates markets have been extremely range-bound. They're big ranges, very tradable ranges, but we haven't really been able to escape the idea of 3% neutral. That's the sort of floor for US rates, up to around 4 or 5% in terms of the highs that we last saw not too long ago. That's a big trading range, so fair enough. But I think the markets are still in this sort of financial conditions loop where the data is so focused, the Fed is so focused on the data itself that the sort of volatility we get in economic surprises keeps us in this scenario where good data equals hawkish Fed, bad data equals dovish Fed. But the problem is data is very cyclical. It's like a sine wave. So in answer to your question, I think the worst case scenario is that we could see US rates getting to sort of 4.8. And that's the sort of level that typically people tend to, I'm talking about the 10-year here, tend to start receiving.
When it comes to potentially these gray swan events, low probability, high impact, also fantastic cartoons, Jordan, which ones do you think is the most believable? Because some of these seem like potentially not exactly what is on people's radar, like Germany overheating.
Yes, indeed. The grey swan is the close cousin of the black swan. A black swan is something that's truly unforeseeable. The grey swan is actually something that you can foresee, but it's perhaps a low probability, high sort of impact. And a few of them are actually quite likely. Some you might even argue should be your base case. It's just a risk for next year we need to be aware of, which is the UK. I think that stands out as possibly one of the most likely ones in our list, which is that the UK replaces Keir Starmer as Prime Minister, and Chancellor Rachel Reeves would also be out the door as well. And that the Labour Party would go through an internal sort of fight for the direction of policy. Does it turn left, even further left of centre, or do the centrists win? And that would be a big problem for the UK gilt market. So I'd say of the list of 10 that we have, that's probably the most likely one to watch out for.
You also talk about cockroaches in the woodwork, private credit cracks emerge. Haven't we already seen that? How concerned are you about really that metastasizing, though, into 2026?
Personally, I'm not that concerned about it. I'm not an expert on the credit market, though. You have to ask the credit analysts. But if you look at the sort of impact from it, when Jamie Dimon made his comments about cockroaches in the woodwork, I mean, the news count went through the roof on the topic. The big impacts for private credit, if you look at the sort of indices that track it, or regional banks in the US, which are also hit, they've pretty much recovered back to where they were. So the market's saying, actually, it's not too big of a risk for now, but it's definitely got to be on your radar.
How about the idea of this peace deal between Ukraine and Russia? We've been hearing mixed messages this morning. There are these meetings ongoing between Volodymyr Zelensky and European peers. I'm just curious how much you think that the market is discounting the chance that there will be no peace, there will be no resolution between these two countries.
I think by this year end, the market's got very low expectations. Luckily for us, we have the poly market numbers to work with. It's roughly 50-50 whether we get a deal by the end of next year. And it would matter a lot for Europe because you'd see the market start to price in sanction relief for Russia down the line, even though it probably wouldn't be immediate. So natural gas prices, which are already falling quite a lot in Europe, by the way, whilst they're rising very rapidly in America, you'd see natural gas prices come down, oil prices come down, the euro would appreciate. We could be talking 125, 130 in the euro dollar rate because the terms of trade would improve. And reconstruction as well. It's not just Ukrainian fixed income that's trading off the back of this, but you could see the likes of Poland and Hungary outperform, and as well as Germany, as countries that will be helping to support that reconstruction effort.
Jordan Rochester of Mizuho, thank you so much for being with us this morning as you look ahead to the gray swans, the unexpected events. There are many, I'm sure. It should be another exciting year. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief. Wall Street veteran Ed Yardeni is going underweight on Mag 7 stocks after a 15-year bet on tech. Yardeni Research now expecting a shift in earnings growth, suggesting that tech is evolving. Yardeni argues that the rest of the S&P 500 will see improved profits because, quote, every company is becoming a tech company. Meanwhile, China's trade surplus exceeding $1 trillion for the first time, despite a plunge in U.S. shipments, risking a backlash from markets flooded by goods from the world's biggest manufacturer. Chinese exports rising nearly 6% from a year earlier. The surplus shows Beijing's struggle to rebalance its economy away from dependence on foreign demand, and frankly, the rest of the world's struggle with this imbalance. And Southwest Airlines is off the hook for a Biden-era fine. The Trump administration is waiving an $11 million penalty over its 2022's holiday meltdown. The fine was issued after it canceled nearly 17,000 flights and failed to provide fast customer service and refunds. That's your Bloomberg Brief. I have to say, what do you expect if you get delayed on the tarmac for 3 hours, or if you, say, get stranded for 6 hours and then have to spend the night at a hotel? What do you need to make yourself feel whole?
Well, I'm always very annoyed when I'm stranded. I hate spending time in the tarmac. But yeah, I think you want your money back. We should note the entirety of this civil penalty was $140 million. So it's the last tranche that's going to the Treasury Department that they're waiving. But I think consumers hate this and they just want their money back, or maybe some more. I don't think $5 to spend at the terminal for some meal and water is going to cut
at least some string cheese. Up next, an unbalanced economy.
We look at the economy, right, and it's kind of running on a two-legged stool. I think there's almost as good of a chance that they don't cut as they cut, 50.
Kathy Jones of Schwab Center for Financial Research joining next. This is Bloomberg Surveillance.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Indonesia holds 40% of the world's geothermal potential, but has tapped just 9% of its reserves. It's like an inexhaustible battery that never gets plugged in. Geothermal delivers clean power 24/7. It's essential as Indonesia strives to realize its net zero ambitions. Barito Renewables is unlocking this resource with continued investment. Soon it was past 1 gigawatt of capacity, helping anchor Indonesia's clean energy future.
Bleeding higher ahead of the Fed decision on Wednesday, as well as a key set of data that actually gives some more real-time sense of the jobs market as well as jobless claims. Right now, you're seeing a gain, a lift to the market near session highs. S&P futures up more than 0.1%. Russell 2000 nearing about 0.5% gain. Meanwhile, in the 2s, 10s, and 30s space, you do see a bit of a decline in price, increase in yields, although back from earlier highs in terms of how much the yields have risen. 10-year yields in particular. Watch this space. After last week, we saw a 12 basis point increase, which is the most since April, continuing that move, although less than 2 basis points, 4.15%. Watch this auction coming out tomorrow. $39 billion of 10-year notes being sold amid a host of other supply in the corporate space as well. And Anne-Marie, check out what's going on in copper. Dr. Copper was supposed to indicate that things are going really well in the economy if it's going up and really poorly if it's going down. Right now, we're seeing copper up 33% year to date at record highs and continuing to build momentum.
Absolutely. Last week, the story really was about people front loading ahead of potential tariffs from the U.S. administration. Today, it's all about China. China once again saying domestic growth is a top economic priority. Well, if that really is going to be the case for China, then that means things like copper are going to do really, really well.
And everybody seems to want to pile into metals that could be used in the build out of artificial intelligence. Under surveillance this morning, an unbalanced economy.
We look at the economy, right, and it's kind of running on a two-legged stool. I think there's almost as good of a chance that they don't cut as they cut, 50. The U.S. economy is on some, weak footing. So you could be in a situation at any point in the next 6 to 12 months where you do get a leg lower in the job market and in the economy. And in that case, the Fed's not going to cut twice. Right? They'll probably cut 4 times.
Here's the latest. Markets expecting a divided Fed to cut interest rates this week by 0.25 point, despite growing inflation concerns. Kathy Jones of Schwab writing, we expect 2026 to be another good year for fixed income investors. However, yields that are lower and less room for rate cuts will mean less robust returns. Kathy joins us now. Sounds like a coupon clipping kind of year. Kath, thank you for being with us. I'm just wondering what the limit right now for the Fed really is. Peter Scheer over the weekend was talking about how maybe the Fed has a lot more room to cut than people think because of some of the new personnel on the central bank. Do you disagree?
Well, I think the issue is, Lisa, that you can cut aggressively at the short end of the yield curve, but you can't make 10-year or 30-year yields go lower if the market doesn't believe that that's the appropriate policy. And so I think that's one reason we're seeing the yield curve continue to stay steep and steepen a bit from here, because there's a question of how much is appropriate to cut, whether you have people who are biased to cut or not. The market's going to decide whether that's the right decision or not.
At this point, do you think that the increase that we've seen at the longer end of the yield curve is because of rate cut expectations, or do you think it's because of the global dynamics with what's going on the Bank of Japan side of things, for example?
Well, I think they're all contributing factors. Japan is helping to kind of pull long-term yields up on a global basis. And obviously, we know Japanese investors are big investors in U.S. Treasuries. So that is a factor to consider. We've had a weaker dollar. And then we have this sort of mixed data where, you have sort of a two-tier economy where higher income consumers continue to drive consumption, keeping the economy moving along. We're going to have some fiscal stimulus coming in with the expensing that will boost probably corporate investment, some tax cuts for some part of the economy, but then you have lower end consumers who are getting hit with higher prices and, cut back in benefits. So you kind of toss it all in. And I think what you see at the long end is this risk that inflation stays elevated or just a higher term premium to account for all the risks that are out there.
Do you think that this is a term premium issue, or do you think that this is a supply issue? The idea that not only is the Treasury selling a whole host of debt, but you also are getting incredible corporate issuance at the same time.
Yeah, it's a lot for the market to absorb. So again, I don't think it's an either or. I think there's two things going on here. Term premium, accounting for all those risks. And then you do have the prospect, not just of supply right now, but long-term supply because of rising fiscal deficits and very little attention to addressing that. And so the market is just increasingly building in a risk premium in terms of higher yields to account for all of those factors.
Kathy, what about the fact we're going to have this changing of the guard at the Fed? Last week, the Financial Times had a story that the Treasury Department went out, talked to bond investors, and bond investors were lukewarm or downright concerned about a Kevin Hassett chairmanship. Do you think the bond market's going to actually get a vote?
I don't know. That's a good question, Anne-Marie. I think the bond market is important in terms of how the Fed proceeds. If there's not a lot of confidence in the new chair or in the composition of the entire board, then the bond market is going to rebel. And I think we're sort of on the edge of that. So it's not probably even about Kevin Hassett per se. It's more about appointing someone who seems to whose sole purpose for being appointed is to lower interest rates. That's not how, the market likes to view the Fed chair or any member of the Fed. They like to view them as people who are going to make decisions based on the data, not just to please the administration. And so whoever's put forward under the belief that their qualification is that they're in favor of rate cuts is going to get a lukewarm reception. And then we have the story that they're talking about changing the rules around Fed presidents, and if that would open the door to changing who's on the board of governors and who will be voting members coming up. So all of that's in the mix, and I think the bond market's kind of nervous about it.
Given what you just outlined, and also the fact that we have seen dissents at prior Fed meetings, it's a deliberative body, but we have seen dissents. Do you think it's going to be much harder for the market to digest what the Federal Reserve will be doing next year?
I think the dissents are healthy and a good thing, and probably though creates more uncertainty than we've had for a while in terms of policy setting. But I think the market's going to deal with it just fine. We'll probably see a bit more volatility because we are seeing more dispersion of views at the Fed. But I think the market's fine with that as long as it's well explained, well signaled to the market that, we have some members who think there no more rate cuts are appropriate till inflation comes down. You have some members who think we should be going to 3% or below. It's okay as long as it's well communicated and well signaled.
So, Kathy, when you talk to clients about what to expect for 2026, how much does it go something like expect to clip coupons, stay neutral, stay mid part of the curve, and just sort of stay the course until you get some more clarity?
Yeah, I mean, it's a kind of a boring message, but I always tell our clients the bond allocation is supposed to be kind of boring, right? It's primarily there to generate income as sort of an offset to the potential volatility in equities and other asset classes. As long as it's doing its job and delivering solid income, then and not putting you too much at risk on either kind of tail risk, then it's doing its job and it's a good thing.
Kathy Jones of Schwab Center for Financial Research. Thank you so much for being with us this morning and talking about just doing your job, some changing of the guard on Wall Street this morning that we did want to get back to. JP Morgan has hired Berkshire Hathaway's Todd Combs as the head of its strategic investment group, as well as an advisor to some of the strategic investments of the bank, reporting directly to Jamie Dimon. He previously had been on the board of directors of JP Morgan. He has stepped down from that committee commitment. It just highlights how some of these companies on Wall Street are seeing a real shifting in the guards as the leaders, as the founders step down. We have, of course, Warren Buffett, who is planning to retire. It really does highlight, though, how important the Strategic Investment Group is for JP Morgan at a time where they're looking for ways to invest in real earths, real minerals, and defense capabilities of the United States.
So the numbers that Jamie Dimon had outlined about this initiative is $1.5 trillion into these industries in the next 10 years. He's saying that's 50% more than they had expected. And this individual, of course, Todd Combs, is going to be a part of that. They're talking about defense, aerospace, healthcare, energy, everything that you see basically play out right now in the financial markets, everyone that's overweight. And these stories that are going to continue, Jamie Dimon clearly making a huge push. And I think it's so interesting, the mix of people that sit on this board. It's not just individuals that are veterans in Wall Street in the business space. It's also individuals like Condoleezza Rice that can really identify what the national security concerns, risks are globally, and where to invest in the United States to fend off those concerns.
Yeah, Succession meets West Wing, and this seems to be where we are at right now. Coming up in the next hour, don't miss this, Kevin Foley of JP Morgan, who leads that capital markets group as he talks about M&A, Pittsburgh Airport CEO Christina Casadas and Savita Subramaniam of Bank of America as we see a lift ahead of a key Fed decision later this week. This is Bloomberg Surveillance. Good morning.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Indonesia holds 40% of the world's geothermal potential. It's essential as Indonesia strives to realize its net zero ambitions. Barito Renewables is unlocking these resources with continued investment.
Financial conditions are easy. I mean, the stock market is hitting new highs almost every day.
We prefer to take our risk in the large cap space. We just want to be where the earnings are.
We're going to see a broadening out. We think that more boats are going to be rising. We see another year of above average earnings growth next year for the S&P 500.
The U.S. bond market has been the envy of the world.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance with stocks inching back toward record highs with traders anticipating a Fed rate cut on Wednesday. Still some key employment data coming up. It's Merger Monday once again, potentially with a tech move. And of course, that big Netflix announcement that's roiling both Hollywood and Washington, D.C. And a key question of affordability with President Trump speaking in Pennsylvania tomorrow with markets clearly anticipating more fiscal stimulus. This, to me, is the question. How much is this the bet heading into 2026? The sort of sweet combination of Fed rate cuts, fiscal stimulus with affordability front and focus.
Well, that's what the bulls on Wall Street are really banking on. We do know that some of that fiscal impulse is going to happen when the one big beautiful bill, tax refunds, that will come down the pipe. It's those extras that this administration is focused on right now because they're so concerned with the midterm elections. His advisors, according to the Wall Street Journal, having this almost come to Jesus moment with the president. The way you talk about affordability, you need to start to recalibrate. You don't want to make the same mistakes that the Biden administration do. They had a great quote from former Senator Joe Manchin basically saying, you can't tell the American people it's sunny and it's roses when it's pouring raining outside.
We were just talking about how it's Merger Monday or Deals Monday. We just got the official confirmation that IBM is planning to buy Confluent for $31 per share in cash. It's for about $11 billion valuation. The Wall Street Journal had reported that IBM was planning to buy this data manager related to artificial intelligence, as we do see the ongoing tie-up in the tech space, in the media space, in the materials space. And this is ongoing. And we have an amazing guest to talk about all of that coming up in just a minute. Right now, we are looking ahead to a week full of data. We get JOLTS job openings tomorrow. We get job auctions in terms of the Treasury Department, Treasury auctions coming out today and tomorrow, and then again on Thursday. And then, of course, we get jobless claims on Thursday after that Fed meeting. Coming up this hour, we've got Kevin Foley of JP Morgan Securities with stocks looking to build on back-to-back weeks of gains. Pittsburgh Airport CEO Christina Casadas following following the debut of their new terminal in Civita Subramaniam of Bank of America, expecting tepid returns in 2026. We begin this hour with stocks steady, inching higher, heading into a pivotal week for the Fed, with more M&A announcements pouring out, the latest being the IBM announcement. Kevin Foley, Global Head of Capital Markets at JP Morgan Securities, joins us now. Kevin, so good to have you in studio. Thank you for being here.
No, good morning. Thank you for having me.
It is quite the deals Monday, and it has been over the past number of weeks. And I want to get your take. Are we building up, or is this the crescendo, right? Is this something that's heading into a year that is going to be massive, or are people getting in for a small window that they see is a good, positive one for them?
We think it's the start of a ramp. We've seen the activity building throughout the course of the year. It has showing no signs of letting up. In fact, it feels like we're sprinting to the finish, as you point out, and I refer to that as December 31st. But as we get into January, we don't think the fundamentals of what's driving this have changed. We continue to have a resilient economy. We certainly have the secular drivers of AI. You continue to have money readily available to finance these deals. And there's just increased confidence of wanting to put capital to work from both the buy side as well as when you look in the boardrooms. The willingness to do strategic things, as we've seen, we expect that's going to continue.
Why? Why now? I mean, we saw this, for example, earlier this year. Also, still credit financing was pretty loose. All of a sudden now, everyone's rushing to market over the past 2 months.
Well, earlier this year, we had a level of uncertainty out there, whether it's geopolitical picture, changing in policy in Washington. There's increased confidence and comfort around that. You put that with the healthy balance sheets and continue to see robustness in earnings, as well as you have strategic things that have to be done. We've been quiet for several years. It feels like that is a environment now that wanting to address some of the strategic issues that companies are facing.
Do you think that the debt market is more fertile land for fundraising, or the equity market?
I'd say both, right? Both are very strong. We continue to see the same fundamentals that are driving both the debt and equity markets are what supporting this M&A environment. You continue to have monetary policy that's accommodative. You have fiscal policy that is accommodative. You're looking at several years within the debt markets where we've had heavy refinancing activity. So we've been recycling a lot of capital. And then in the IPO market, we've had a dearth of activity. It has been building, certainly in the back half of this year. We're going to be up 25-30% year over year. We expect that's going to continue into 2026.
Do you think there's been a rush because there was an emphasis on this administration when it comes to deregulation?
It's certainly been a boost. Would I say it's a rush? But it's been a boost. That is a impetus for sure. You have a pro-business administration out of Washington. And I think that as we came into the year, I remember hearing one CEO said, hey, anything's possible. We're looking at a lot of different things right now.
Anything's possible. We've been talking all morning about Netflix and Warner Brothers. The president himself saying it might be a problem. The DOJ, of course, is going to look at it. But do you see the M&A landscape changing next year in terms of which industries and sectors?
I think it's going to be pretty broad-based. I mean, certainly with what you have happening in the technology space with the AI, that's going to continue to be a driver. We expect healthcare to be active. But we are seeing that broaden out. When you look at the focus on supply chains and manufacturing, it expect more activity there. And we're even seeing increased activity levels in the consumer space. So we think it's going to be broad-based. But you definitely have some core secular trends that are going to be drivers.
How important is it for your corporate clients to see exactly what antitrust regulators do with a deal like Netflix bid to buy Warner Brothers to get a sense of how they're going to position going forward?
You're always taking a gauge of what the antitrust environment is like. But like any deal, it's going to go through its regulatory approval. You look at each of those outcomes and you use that as a temperature check. But we expect the environment from that standpoint continue to be supportive.
How much do you see debt investors on the other side starting to push back? Not necessarily with respect to the Netflix deal, because that hasn't necessarily been financed through that market yet, just the bridge loan, but really in the AI space in particular. The fact that there have been these glut of sales that have just overwhelmed the market, things have been pretty good so far. Have you seen any kind of pushback at all?
We haven't seen pushback yet, but there's certainly caution, right? You've got a shifting landscape, and we're all trying to figure out how AI is not only going to, it's certainly going to change the world, but who are going to be the winners in that, right? And trying to understand who are going to be the leaders in that, what technology is going to win out. how it is going to form itself, how a revenue model is going to come out of it. The key question any investor, whether debt or equity, is going to have right now is, are the efficiency gains and the growth in the sector going to happen as quickly as expected? Right now, there's a lot of optimism around that, but there's certainly some out there having some caution around it.
A lot of people liken this period of time to the telecom debt boom, to the energy boom, to some of the other booms, the physical world that was financed by debt markets. And some people would say this is what the debt markets are for, right? This is what they have grown up to do. So it's not necessarily a negative. It's really the function. At the same time, there always is the aftermath, and it always is painful. I mean, at what point are you advising clients on how to avoid that period of time when you do have changing technologies and you do have inevitably overinvestment?
Well, depending on who you're advising, from a client who's an issuer or a borrower, you're certainly going to say take money while it's there and take advantage of a positive backdrop. When you compare it to earlier secular trends, right, in terms of whether the fiber or energy, this one is interesting because you have a lot of robust players in the space who have got very healthy balance sheets. And while they're using the debt markets to finance this stuff, they don't necessarily need to, right, given the cash on their balance sheet. So this one's a little different than what we've seen historically, but we think the debt markets are going to continue to be there. And as with any emerging trend, they're going to continue to be suspect about how technology is going to develop and who are going to be the players in that.
You sound so bullish in this space and for next year. What is your biggest risk, though?
Biggest risks are, one, the efficiencies and the growth in AI doesn't happen as quickly as expected, right? We are certainly optimistic about that, but that is to be determined. You certainly could see a situation where inflation's stickier than expected, and we don't see the same support out of monetary policy the markets expect. And then certainly geopolitical, while we've seen progress on that front, there's still a level of uncertainty on that. And then I always like to note the known unknowns. Right? It's usually something that we don't have fully on our radar screen that derails us. And that's the thing you want to worry about the most.
When you look at inflation, it has been, especially in some areas, sticky. Do you think that this trend, this M&A trend, the work you're doing can continue, which is hovering at 3%?
Yes, it can continue. I think that the capital is out there. When you look at the amount of capital that is in the system, liquidity, I go back to the debt markets. You look at, we've had elevated activities the past couple of years, but 75% of that activity has been refinancing driven. So we've been recycling a lot of that capital. So from a liquidity standpoint, it's there. And certainly there's a lot of strategic needs to be doing things.
Kevin, JP Morgan's making a lot of big headlines this morning, in particular with a big hire, Todd Combs, who is formerly one of the leaders over at Berkshire Hathaway, thought to be a potential successor to Warren Buffett as he retires. He is heading over to head the strategic investment group. And it, I'm sure, works closely with your group as well, because this is going to be a key aspect of how you deploy capital. How do you expect this group to be really evolving and Todd Combs coming to the bank?
Well, first, we're ecstatic to have Todd coming aboard. I mean, have someone of his caliber, in addition to the external advisory council that's been formed. As Jamie has noted in our announcement, this is an incredibly strategic importance for us as an institution as well as a country. So, when you look at where we're going to focus on aerospace and defense, energy, frontier and strategic technology, supply chains, manufacturing. So a lot of the things that we've been talking about, what are going to drive M&A activity, where it's going to be also be driving the investment opportunities. So there's going to be an emphasis on those things. It's going to present a lot of opportunities for us. The response even prior to today has been amazing. We've been amazed at the amount of inbounds we have. We expect we're going to be very busy, and we're certainly prepared to commit a lot of capital.
Do you think that the $1.5 trillion is underballing the actual amount?
Could be.
Kevin Foley of JP Morgan Securities, thank you so much for being with us this morning. We really appreciate it. It does seem like a really key moment. And frankly, the M&A pipeline is just off the hook from everyone who we speak to. And we're certainly seeing that into year end.
And that 1.5 is 50% increase from what they already said they were expecting to spend. So if it's going to be more than 1.5, but again, it is over 10 years, it's a lot of capital going to these really critical industries: defense, healthcare, AI.
TBD. Yeah, exactly. Right now, let's get you an update on stories elsewhere this morning. Here are your Bloomberg briefs. IBM set to acquire data infrastructure firm Confluent for $31 a share, totaling around $11 billion. The company putting out a statement saying the deal will be funded by available cash on hand. Confluent is valued at about $8 billion and specializes in managing the data essential to developing AI. Confluent shares up 27% this morning in pre-market trading. President Donald Trump raising antitrust concerns over Netflix's planned acquisition of Warner Brothers Discovery. The president warning the deal creates a market share that, quote, could be a problem. The comments escalate pressure on federal regulators. And President Trump's top advisors have been tasked to find a way to lower beef prices. This, according to the Wall Street Journal. This is steak and ground beef have hit record highs this year, and the administration tries to bring down the cost of food. That's your Bloomberg brief. Coming up next, the morning calls, plus Pittsburgh Airport CEO Christina Casades on a new era for air travel. Hopefully it does not include more government shutdowns. That's my editorializing. That's next. This is Bloomberg Surveillance.
It's those rotations in the market where you really want to look, and we're just now starting to see them. Healthcare has been trending for a little bit, but now you're starting to see it, like you said, in the metals, right? And copper and aluminum and zinc, and you're seeing that globally. You have to start looking at some of these areas where trends are starting to change internally. That's where you want to invest.
That was Victoria Fernandez of Crossmark as we look ahead to potentially a volatile 2026, but nonetheless one that a lot of people are optimistic on. The optimism building this morning as we do see futures higher pretty much across the board, led by the Russell 2000. That rotation continuing to build steam, at least this morning, up about 0.5%, almost 0.2% gain on the S&P. 210s and 30s seeing a different story, a sell-off in the bond space taking hold, particularly after what we saw last week, although backing away from some of the earlier losses, but down unchanged 30-year, 10-year yields were almost 4.16, now 4.14, up less than 1 basis point. Time now for the morning calls. First up, Wedbush raising its price target on Apple to $350, expecting 2026 to be the year it enters the, quote, AI revolution. Those shares lower by just about 0.1%. Up next, Benchmark downgrading Marvel to hold, saying it lost to Amazon's Trainium designs to its Taiwanese competitor. Those shares lower by 7%. And finally, Morgan Stanley downgrading Tesla to equal weight, saying its non-auto catalyst path is already priced in. Those shares lower 1.4% ahead of the market open. Sticking with transportation, Pittsburgh International Airport's brand new $1.7 billion terminal receiving major attention with its full-scale overhaul, transforming a number of features from passenger experience to security to energy independence that many say could become a case study for modernizing airport design. We are all excited about that. Joining us now is Pittsburgh International Airport CEO Christina Casades. Christina, thank you so much for being with us.
Thank you for having me.
And I know that we all are excited about renovations, especially as we await what's going to happen at JFK here in New York City.
Fingers crossed.
Yeah, fingers crossed
airport,
that we actually can get an Uber
Yep.
without having to take a train. I am curious from your perspective how difficult it is to really get a renovation underway, given this sort of cost, the labor, the difficulty and disruption in terms of some of the passengers coming in and out.
Well, first of all, it is. I appreciate you pointing that out. It's not easy, and when you are, as we say, operating on the live patient, you have to make sure that everything is going to work. So, operating an airport while you're building a new one is incredibly complex. We are really lucky in Pittsburgh. We have an amazing labor force, and we actually hit the beginning of the airport right as they were coming off building the Shell cracker plant. So we had a workforce ready to go for work. But it's a lot of work. I mean, design, planning, contracting, and the volatility for us, we were doing it right during COVID. So it made it a little trickier to make sure that we were able to get everything we needed when we needed it.
Having gone through this, and Lisa's point to JFK, what's the benefits of just rebuilding a brand new structure over retrofitting old terminals?
It depends on what you have for space. We sit on 8,800 acres. We had the room to be able to create a new landside terminal while we operated, and we didn't really interfere the existing passenger operation. We were able to take construction vehicles and put them onto actually a taxiway, which we repurposed, so we didn't have any construction vehicles on our roadways. It's a lot of moving parts, and I would say that it's a challenge. If you can start from scratch, it's always easier. Always.
As a traveler, what has changed about this airport than, say, older airports that were built pre-9/11, some of them pre-smartphone? So much of how we travel has changed. When you walk through this, what will it actually feel like?
Like a completely different facility. So we were built as a hub, and there were two separate buildings separated by a half-mile train. That's gone now. So we had two separate security checkpoints. Now we have one, much faster. We had two separate baggage systems and 8 miles of bag belt connecting the two terminals. Customs and Border Protection was in an odd location. It just makes a lot more sense. It looks fantastic. It represents the region in a much more impactful way, as opposed to sort of thinking, oh, God, what happened here? When you come to the airport, it feels like, wow, I wonder what else is beyond this. So that's what we were going for, was stable costs for the airlines and building Pittsburgh's airport.
This is an important conversation because there are $151 billion, I believe, in capital needs for U.S. airports that are going to be necessary over the next couple of years. And it also comes in a bigger conversation. Everyone who we've had on the show talks about building infrastructure, about investing in physical materials, and the need for people to actually put shovels in the ground. I'm just wondering how difficult you think some of the plans are going to be on this scope and scale, given the limited supplies, given the limited workforce. Maybe Pittsburgh has a good, ready-to-go workforce. A lot of places don't have that. I mean, how long do you think this is going to take, or feasible are some of these plans?
I think that first of all, it's critical. We have airports that were built in the 50s and 60s that haven't been renovated since. So, to your point, technology has changed so much, and the way that we even move through facilities requires different wiring. Right. It just requires different space to be able to administer services and for people to move around. So I think it's going to be tough, but I think it's necessary, and we better start, because if we don't, we continue to kick the can down the road.
And there's an issue of financing. How much is going to come from local and federal governments, and how much is going to come from private investors that actually want to get a piece of this, and what's going to be feasible given some of the political interference and discussions? I mean, how difficult was that for you to figure out some sort of palatable mix to the public, as well as that just made sense fiscally?
Right. So no local taxpayer, no state taxpayer money are in airports. I mean, we are required by the FAA to be financially self-sustaining. So we floated bonds, and really the airlines back those bonds. So the critical stakeholder group here is, do the airlines believe in your plan? Are they willing to support it? And are they willing to guarantee with their revenue that they will fill in for any operating cost deficit? And that's the key. So if you run well, then it should work. That said, I think that there's, in some airports that are huge, the needs are just greater than even the bonding capacity may require, and you may see more private investment. We certainly see that in the New York markets.
You also tapped the bipartisan federal infrastructure bill. How much did you have to use from that? Were you able to use?
I think we got about $80 million in discretionary grants. I mean, we were encouraged to apply because we had shovel-ready projects, and our timing was really perfect for that. So, we competed just like every other airport in the country did. There was a block of money set aside for medium-sized airports, and we would compete for that every year.
The changing of the guard in Washington, Biden administration, now you're finishing this project under the Trump administration. Have you seen any changes in how you deal with politicians and leaders in D.C.?
The day before the election, both candidates were in Pittsburgh. So we are ground zero for bipartisan working together, and we go right down the middle.
The president's going to Pennsylvania tomorrow.
I'm not surprised. We're a swing state. We're a really important state. We take it really seriously that we are able to make sure we can work in Washington at all times, because we have to. I mean, we have a really diverse population, and we've got to make sure everybody's getting taken care of at all times at both airports.
Are you excited about the potential for another government shutdown come January?
I'm not sure excited is the word I would use. Prepared. I would say prepared.
Yeah? What kind of preparation?
Well, we make sure that we are taking care of our federal partners to the extent that we can. We did not have many call-offs. We have really an extraordinary workforce in Pittsburgh, and between TSA, ATC, and CBP, really, we did not see any major disruptions, and I give them a lot of credit for that.
Christina Casotis, thank you so much for being with us this morning. Christina Casotis, the CEO of the Pittsburgh Airport, talking about the huge capital needs. Really, this to me is the key question. How much are we talking about AI data centers, and how much is it the roads and the airports and the other things that need to get financed at a time where there already is a pretty big fiscal overhang and there already is a lot of pushback when it comes to individuals and how much they're paying?
And to Christina's point, she had shovel-ready projects able to tap some of that legislation in Washington, D.C. If you weren't prepared, how much harder potentially is that going to be? Also, Pittsburgh needs to prepare one huge event next year. It's crazy, I know this, given I'm not a football fan. They have the NFL draft next year. So you have this brand new airport in time for, all the stars to come through.
I just want to say that you always say that you don't talk football. And in the past 2 weeks, you've talked more about football than I've ever had on this show.
Twitter, people say
exactly. Then you just sort of pick it up in the ether. And the baseball stadium is pretty awesome, too, in Pittsburgh. Coming up is going to be Savita Subramanian of Bank of America, looking ahead to 2026 with the firm expecting tepid gains in the next year. Plus, Danny Berger with your morning movers. Confluent surging after landing a sale to IBM. Those shares up 29% in pre-market trading after making the announcement official. More broadly, you are seeing gains in futures across the board to start off a new week. This is Bloomberg Surveillance. This does seem like we're possibly getting the Santa Claus rally with futures inflected upward after 2 straight weeks of gains. Now 0.2% gain on the S&P. You are seeing a bit of dollar weakening on the heels of some of the expectation for the Federal Reserve later this week on Wednesday. 93% chance that they will cut rates. We're seeing 116 on the euro dollar cross. Yields just a little bit higher, but off earlier highs, 4.14% on the 10-year, and copper continuing to move higher to new records, up 0.4% on the London Metals Exchange. 1 hour away from the cash open, here are your morning movers with Danny Berger. Danny.
Hey, Lisa, a little bit of deal news to bring you this morning. Just about an hour ago, IBM confirming that it indeed will be buying Confluent. It's an $11 billion deal. Confluent, they do something called data streaming. It essentially allows AI models to bring in data live rather than clunkier, like shipping it in one-off. So it's the kind of systems that enterprises would need in order to really run AI systems. Confluent up 29%. The share price is going to be $31 that IBM is buying it for. So we're trading just under that premium. Another kind of deal story this morning that Microsoft will be getting, or at least is working with Broadcom to get custom chips. So those shares are up 3%. Microsoft previously was working with Marvell Technologies for custom chips. So that switch means Marvell falling by 6.3%. Staying in tech and AI this morning, CoreWeave, those shares are down 4% this morning in the last hour, reporting that they are putting out $2 billion of a convertible bond note. For one, it's a dilutive event, and for two, it's this concern about the big tech players in AI issuing more debt. So those shares fall in the pre-market, Lisa.
Thank you so much, Danny. Pointing to that CoreWeave, this idea of how much will the debt markets be willing to finance not just the big tech players, but also some of the more peripheral and lower rated ones. Turning to the Federal Reserve, the final FOMC meeting of the year kicking off tomorrow. Bloomberg's Michael McKee joins us now with what to expect. Mike, division, sort of the key central word heading into this meeting.
Yeah, the Fed's more divided than they have been in years, but of course the issues are tougher than they have been in years, with both sides of their mandate missing. Which way do they go? We're going to be watching that. But before we get there, there are some other data points worth mentioning. I put the Supreme Court FTC on there because they're hearing arguments about whether the president can fire the chair of the Federal Trade Commission. That will have implications for Fed Governor Lisa Cook, whose case will be heard next month. They both fall sort of under the same presidential claim that he has power to fire anybody in the administration. Tuesday, we get October jolts. Now, we don't get the jobs report report till next week. So at this point, that may be the best we've got in terms of government data on employment. And then Wednesday, the ECI. Kevin Hassett, who may be the next Fed chair, was just on the other channel talking about the fact that the inflation numbers are up, but you can offset that by rising incomes. So our income's rising. We'll find out what happened in the third quarter. And as you mentioned, we get the Fed decision. Thursday, jobless claims and trade data. And Friday, they're back. The blackout period's over, and we're going to start hearing from Fed officials again. One other data point I wanted to note today, and that was the Chinese trade figures came out, and China had a blowout November. They crossed $1 trillion in trade surplus for the year, which is a record for them. Exports to the U.S. with the trade war fell 29%, but to the rest of the world, they were up 5.9%. They're not selling here. They're dumping it everywhere else. Bad news for everyone else. And the records show China's bought 2.25 million tons of U.S. soybeans, but in their agreement with the president, they committed to buying 12 million by the end of the year. So they either got a lot of buying to do or they're not going to live up to it. Those are all the things we're watching this week. But of course, as you say, the Fed is the story.
Michael McKee, thank you so much for being with us. As always, and we'll be catching up with you throughout the week. And the last time that we saw 4 Fed officials on the FOMC dissent was 30 years ago. So definitely interesting to see whether we're going to see something similar. Turning back to the markets, the team at Bank of America expecting the S&P 500 rally to fizzle out in 2026 with a year-end target of 7,100. It seems extremely low considering some of the other projections coming out of Wall Street houses. Savita Subramanian of Bank of America writing, we expect double-digit earnings growth versus tepid price returns in 2026. We're bullish on CapEx versus more worried about consumption. Savita joins us now. Savita, wonderful to see you. Thank you for being here.
Great to be here.
So how much pushback do you get for not being bullish enough?
Well, I think it's hard to get a lot of buy-in on a less optimistic message when the market continues to move higher. Clients that we speak to tell us, the ones that are more bullish than we are, which are most of our clients, tell us that, liquidity is still ample. We've got this Fed cutting interest rates. The consumer's fine. And I guess on all of those factors, right now, everything looks okay. But I think the direction of travel next year is worse rather than better on all of those factors, except for maybe CapEx. I think CapEx could actually pick up demonstrably from here and broaden out beyond just tech. But in other areas, I'm worried about, if AI is so amazing, isn't it going to take a bunch of jobs? And what does that do to that middle income consumer cohort, which has been the engine of growth? So lots of things swirling around. But I think net, I think the direction of travel from here to the end of next year is worse rather than better in terms of liquidity provisions from central banks across the world. I mean, think about it. This year we had over 100 cuts from central banks. Next year we're slated to have something like 80. Still high, but not as good. And when you think about just, tech companies, we're heading into a little bit of an air pocket when you think about actually monetizing AI spend. So I think that this just gets harder to see great gains coming from the S&P.
When you look at AI, it almost sounds like doom for you. We're doomed if it's a bubble. We're also doomed if it's so good, because that means there's going to be huge issues for the labor market.
Well, yeah, I think something's got to give, right? I mean, you can't have everything. And for the last 5 years, we've had a really strong, surprisingly resilient consumer. And we've had this tech, theme running the market. And today it seems like those two bullish themes are fighting with each other. And I don't know which wins, but I think this year it's going to be hard to see real monetization of AI, tools, because power is the bottleneck, and it's going to take a while for that to come online, right? I mean, this isn't just like turn it on. Yeah, so there's a mismatch. And then in the meantime, companies are sort of stalling in hiring because we're waiting to see how great these tools will be. We have, we're sort of fully staffed. So I think there is a little bit of a period of time where we're just sort of sitting there waiting to see what happens. And in that period, the most insecure consumer cohort is that younger professional white-collar services employee that has been the driver of consumption growth for the last 30 years or so.
But the consumer has still been resilient. It's been tough, and we even see this administration wanting to pivot to talk a lot about affordability.
Yes,
starting
absolutely.
Tomorrow.
Yeah,
and they're trying to do maybe potentially some policy maneuvers.
So this is where it gets interesting. You're right. I think where we could see strength in the consumer is in that lower income cohort, which is really kind of a consensus short at this point. If you think about consumer staples as a sector, it's been a pretty rough place to be for the last couple of years. But now we've got this, this administration that's really focused on, the midterm elections are coming up. We've got, a still kind of a not great lower income consumer cohort. So I think that if anything, we see policy that help that spending segment of the market, which is great in terms of numbers. But that segment of the market is a smaller contribution to overall consumption.
This is fascinating, and it kind of speaks to what we're seeing right now, which is the Russell 2000 outperforming. I mean, ultimately, how much does this lead to a number of smaller companies, whether it's the Dollar Trees or the Dollar Generals that are doing better than a lot of people had expected? How much do you see that as a durable trend based on the political backdrop for next year? In addition to a shift away from the Magnificent Seven, akin to what Ed Yardeni was talking about in his latest note.
Oh, yeah. I think that small caps could do quite well. I mean, again, you got to be selective because there are a decent chunk of small caps that are just sort of sitting in the Russell 2000 because they couldn't hack it in a 5% interest rate environment. So I think those are the ones that you want to kind of think hard about. But in terms of smaller industrials, maybe even smaller consumer stocks that haven't had a bid in a very long time, we're actually seeing some interesting things. We actually made a big sector change that almost everyone disagrees with us on, which is we downgraded consumer discretionary and upgraded consumer staples. And it's kind of along the lines of what's going to happen next for the consumer. Policy is going to be more bullish for that lower income cohort. Fed cuts are more bullish for lower income, whereas middle and upper income, the assets that matter, housing, stock market, financial gains, are all priced on the long end of the curve. So that's where I think you got to be more careful in thinking what happens at the long end and how do asset returns, how do home prices continue to drive that wealth effect that we've seen, really contributing to a healthy consumer.
Meanwhile, as we watch the potential Fed easing, albeit maybe not as much as this year, there has been a huge issuance of debt to finance mergers and acquisitions, to finance all sorts of expansions.
Yeah.
Does that bolster or hinder the S&P 500?
Look, I think the number one driver of a higher equity risk premium, or said differently, a lower multiple, is leverage. And what we're seeing is that companies, especially these sort of perfect tech companies with great balance sheets, are now starting to raise capital. They're starting to get more levered rather than less levered. So again, the direction of travel, things look great right now. Tech companies, healthy balance sheets, but on the margin, they're getting worse rather than better.
So you think that going into 2026, even with debt markets wide open, even with companies able to finance themselves, you don't see that elevating their valuations in a material way?
No, I don't. Even if you look at tech capital intensity right now, so just how much of their operating cash flow are they spending on CapEx? Tech companies are now equivalent to or worse than oil majors, which is weird, right? I mean, we think of oil majors like these are, big oil companies spend a lot of money. Now tech companies are spending as much or more of their operating cash flow on building out capacity. And I think that's a new theme that's generally accompanied by multiple compression. So that's where we see this sort of handoff between other sectors. That's not to say there are lots of, bullish themes within the S&P 500. And in fact, I like energy. I like financials. I like consumer staples, healthcare. I think there are a lot of places to go within the S&P 500, but it's a pretty different set of stocks than what's worked so far.
Would you feel unnerved, or would it be a risk if these tech companies weren't spending at that level, given what everyone projects is needed for the AI rollout?
Well, that's the other thing is that, in 2023, we got through a hiking cycle and tech companies were able to get less capital intensive. So they cut CapEx, cut heads did a huge buyback. It was great, right? They supported their stock price. Whereas today, I think they have less options because we're in this arms race with other countries to build out AI, to get that power bottleneck resolved. And there aren't as many options for these companies. They're more levered. They can't necessarily cut CapEx as easily. So to your point, I mean, I think it would be potentially negative if they cut CapEx. But on the flip side, the fact that they can't is even more negative. It cuts into their optionality.
Are we entering a new phase of equity market gains over the next 5 to 10 years where they just are less than they have been because there is less money going into the financial system and more into the real world in terms of actually building out the infrastructure that we need for all of these things? Are we entering that in 2026?
I think we might be. I mean, it's hard to call for these like massive dislocations, but if you look at where we are today, it looks a little bit more like the 80s or 90s, right? I mean, it's like we're much less global. We are focused on productivity, which is great. That's a great source of returns and margin stability. But there aren't as many levers. I suppose if we go back to QE and zero rates, we could see a replay of 2010, but I think that would be negative for the equity risk premium. I think that would introduce a whole lot of uncertainty. So, yeah, I do think we're in an environment where the drivers could be shifting from just consumption and services in the U.S. to more making stuff and manufacturing, which is, you know, again, something we haven't necessarily experienced in our investing careers.
Savita, wonderful to see you. Thank you so much for being with us this morning. Savita Subramanian of Bank of America here in New York. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Briefs. President Trump posting on Truth Social that he'll sign an executive order on AI regulation this week. Trump writing, there must be only one rule book if we are going to continue to lead in AI. That won't last long if we are going to have 50 states, many of them bad actors, involved in rules and the approval process. A lot of people trying to figure out the meaning behind it, hoping for more details later this morning. Meanwhile, J.P. Morgan tapping Berkshire Hathaway's Todd Combs to head its strategic investment group. At Berkshire, Combs helped to oversee parts of the company's $283 billion equity portfolio alongside Warren Buffett and Ted Weschler. The move comes after a shakeup at Buffett's firm as the company prepares for his retirement. In sports, the Kansas City Chiefs have lost 4 of 5 games after falling to the Houston Texans. Elsewhere, the Green Bay Packers beat the Chicago Bears to halt their win streak, while the Pittsburgh Steelers upset the Baltimore Ravens 27-22 to reclaim the division lead. And here with us, our football expert, Anne-Marie Hordern, who always talks about how little she knows, but yet has been following all of this.
Well, I just know because people like Muhammad Al-Arian and my dad, and sorry about the Jets.
Okay, thank you. Thank you for that PSA. It was very sweet and noted. Up next, setting you up for the day ahead. Plus, Bloomberg's Ed Ludlow as IBM is set to acquire data infrastructure firm Confluent. Those shares surging almost 30%, while IBM lower by about 0.8% in pre-market trading. This is Bloomberg Surveillance.
Liquidity is still ample. We've got this Fed cutting interest rates. You know, the consumer's fine. And I guess on all of those factors, right now, everything looks okay. But I think the direction of travel next year is worse rather than better on all of those factors, except for maybe CapEx. Net, I think the direction of travel from here to the end of next year is worse rather than better.
That was Savita Subramanian of Bank of America with a 7,100 call on the S&P 500 for the end of next year. Looks like we're trying to get there by the end of this year, with futures positive, climbing toward new all-time highs at 68.88 on the S&P. Futures up about 0.1%, almost 0.2%. Looking at a little bit of dollar softness, yields inflected higher, 10-year 4.15% in terms of rounding up, and copper at an all-time high and continuing to climb, counting down to the opening bell. Here is the trading diary for the week ahead. Today, sources telling us here at Bloomberg that President Trump will unveil a $12 billion farm aid package tomorrow. JOLTS data on Wednesday, an FOMC rate decision followed by Fed Chair Jay Powell's press conference, plus earnings from Oracle Thursday, another round of jobless claims Friday. Fed speak returns. We'll hear from Paulson, Hammock, and Goolsbee. Right now, though, in markets, all eyes on big tech for a variety of reasons. The latest deal, IBM announcing to acquire data infrastructure firm Confluent for $31 per share, valuing the company at $11 billion. This is the biggest deal in IBM's recent history as it pivots toward AI demands. Bloomberg's Ed Ludlow joining us now from San Francisco with more. Ed, does this come as a surprise, or is this just building on a slew of deals that we've seen from IBM in particular over the past couple of years?
Yeah, IBM's used M&A a lot to kind of reposition the company for the AI era. It's a surprise for what it is. It's an enterprise and data-focused company, and a lot of the M&A that we've seen is focused on the physical, on data center infrastructure. Confluent's really interesting. I'm trying to think of an analogy that kind of would make this accessible to the surveillance audience, but think of it as like the plumbing for data, real-time data. So if you are a heavy industries company or even a software company, the issue that we found recently with these like very, very large frontier models is that they're not relevant to the companies that want to use them. They have hundreds of billions of parameters, but the data sets they're trained on don't make them that useful. And so IBM has this platform, watsonx, which basically allows you to build or make use of existing smaller models. And the Confluent piece just allows you in real time to pipe data in. Think sensor data in a factory that will allow you to do something of use. $9 billion deal, $11 billion enterprise value, including debt. Not the biggest in IBM's history, but it is the biggest, as you say, in most recent history. And it's kind of where the market's looking right now. Useful data.
There are a couple of sides of the AI story that are kind of percolating into the end of the year. On one hand, you have, of course, just the mergers and acquisitions, and this question of the race to acquire the greatest volume of both clients and energy to power your sources. On the other hand, there's the government and how much the government's going to get involved.
Yes.
President Trump truthing this morning, saying there must be only one rule book if we are going to continue to lead in artificial intelligence. I will be doing a one rule executive order this week, talking about the issue with getting different approvals from each state. What do we know about what this could be referring to?
We don't know a lot. I've already had a few conversations with sources that basically private industry, especially those that are around and engaged with the president, are very much in favor of this. One set of rules. That's obvious, right, that the private sector would support this. If you go back to November 18th, there was a Bloomberg report on an executive order being considered by the president that would allow for the Department of Justice to go and take action against states who had state AI policy that the administration deemed unconstitutional. That was an interesting precursor to what we assume will be some kind of EO for a blanket federal framework for AI rules. Much of what this administration has done so far in the realm of AI has been a national strategy to deregulate, to allow the companies involved to move faster, particularly on data center infrastructure. That's very different from a set of rules that allows a software company in particular to put its AI technology into the real world. But that is, clearly what's at the focus here of this White House.
Ed, who do you think is leading the charge in the tech space when it comes to pushing the administration to adopt a framework like this? I mean, we should note that Congress has yet to agree on a regulatory framework when it comes to AI.
Correct. Well, there are those in the immediate orbit, Shri Ramkrishnan and David Sachs, the AI advisors to the president, and I'm sure that they will be having a role. There was the confirmed reporting that Anthropic CEO Dario Amodei met with the president very recently, or with the White House at least, and discussed these kind of broader issues. As you know, AMH, like the access of industry to the president, you tell me is unprecedented in some respects. I would note that if you go back to my November 18th example, the report on an EO that would give the DOJ a remit to go after state legislation or state rules that the White House felt unconstitutional, there have been very vocal Republican voices at the state level, Republican governors, that actually don't want this White House to do that. They think it's important that there is some state power in oversight of AI. So politically, it's not universal, particularly within the Republican Party.
So that should be interesting what we hear today, potentially alongside other announcements from President Trump. Ed Ludlow, thank you so much for being with us this morning. Really appreciate that reporting and context. And Anne-Marie, this is the reason why people are curious exactly how this is going to get articulated given the disagreements even within the Republican Party.
Potentially, and what it means for Congress and their regulatory framework and what it means for individual states. This is going to set up a huge fight between the federal government and some specific states. And to Ed's point, there's Republican governors who are against this because they have state sovereignty. You know, I remember a point when it was Republicans who used to continuously talk about the fact that we should leave more power up to the states and not to the federal government in Washington, D.C.
Definitely a pivot point for both parties in terms of just what they stand for and how they kind of configure themselves going forward. Coming up tomorrow, we've gone from the Savita Subramanian view of things. Then we go to the biggest bull on Wall Street side of things, John Stoltzfus of Oppenheimer. Meanwhile, we're also speaking with Gene Soroka of the Port of Los Angeles, Sarah Hunt of Alpine Saxon Woods, and Michelle Weaver of Morgan Stanley as we get some job openings data as we head toward that Federal Reserve meeting on Wednesday. And, of course, Oracle earnings after the bell. Good morning. This was Bloomberg Surveillance. Thanks for being with us.
don't really get the domestic consumption going, the domestic economy going, and they have, as you say, the property challenges, there's a problem with investment there. Can they continue to support that level of innovation?
Well, that's why I want to put this in perspective, because the domestic economy is slow. Prices are not rising. They're not really much falling anymore, but it's still growing by some amount. And they, of course, have far more fiscal space than we have because, and there are a lot of different numbers around, but my conclusion, my view is that they are not nearly as leveraged from a governmental point of view as we are. And so they have fiscal space. She is just reluctant to use it. But if you read his latest 5-year plan, for example, which came out a couple months ago, he is very focused on these cutting-edge technology industries and of having China have a premier place in the world. And they are on their way to doing that, if not already there in a lot of cases.
What did you find in those cutting-edge technologies? I mean, we hear about biotech, we hear about EVs, certainly, and AI, as you mentioned.
So we can take them in whatever order you want. On biotech, they have gone from importing our drugs to their country to exporting their drugs to our country. Not the actual drugs, but the drug development. And if you talk to any biotech investor, and we have a number of them, they will tell you that they are now spending time in China. What has become a thing is licensing Chinese drugs into the U.S. You have to do the trials again and so forth to comply with U.S. regulations. But they can develop drugs faster, better, cheaper than we can for all the reasons you can imagine that China does things well when they put their mind to it. And so that's become a big thing. AI, we were obviously ahead, and we're still probably ahead, certainly in terms of adoption and the value of the companies and things like that. But they have a number of very good models and building more. I think the question about AI for them is whether the world will use Chinese models. I think it'll be tough here. I'm not so sure it'll be that tough in the rest of the world because they will be so much cheaper. For example, Huawei, as you may remember, was deep into the telecoms infrastructure in many parts of the world until we effectively shut it down. And so people were willing to use Chinese technology, and they may well in this case as well. And in the case of EVs and cars, they have something like 50 car companies, too many, and there's consolidation going on and so on. But the quality of the cars is unbelievable, and the price is unbelievable.
It seems like Washington is fixated on China. Is China as fixated on Washington? Do they pay as much attention to us as we do to them?
It may well be on geopolitical and strategic things, which are not my area of expertise, as you well know. But on the economy, no, I don't think. Honestly, I think they feel like they know how to do this, and they're on their own. For example, the last trade spat that Trump and Xi settled, we lost, basically. They can buy soybeans from Brazil. They can get soybeans in other places. We can't get these rare earth minerals, which, by the way, aren't that rare, as you know. What's rare is the processing ability that China has developed, in which we essentially keep limited here because of environmental concerns, which I certainly subscribe to. But the result was Trump essentially had to back down. I mean, there's too much stuff that they make that we need at this point to survive. And so I think they're in a pretty strong position vis-a-vis us.
As China looks externally, what do they see as their opportunity markets? I mean, you mentioned Brazil, the soybeans, buying soybeans from Brazil. Soybeans. But what about for export? Who do they think are their opportunities out there?
Well, I think mostly the developed world, obviously. Their EVs are huge in Europe. The Europeans are trying to clamp down on it. But if you look at new car registrations in Europe, BYD is, I think, probably, I would guess, registering as many cars there as everybody else all put together because of the price. And it raises an interesting question for us, which is that, I believe in the auto industry here, as you know, but we're effectively denying our consumers the chance to buy a cheaper, better car because we effectively have banned Chinese cars by using 100% tariffs. And so we sell 16 million cars a year here, average price $50,000 a car. If you cut $10,000 off the price of that car, that's $160 billion a year of benefit to consumers here if we let them in at the cost of our automobile industry. So these are really tough issues for us and for other developed countries.
What have you seen in the nature of the strategy for the U.S. as against China? Because right now it appears that what President Trump and his administration are saying is, let's slow China down. through trade actions, through export controls, things like that. Is that a viable strategy to slow China down?
But my view is the only way we're going to beat China is by doing a better job ourselves. We're not going to out-negotiate them. We're not going to out-war them, if you will. We have to just do better ourselves. There's no other solution to this, in my opinion.
Your day job is investing and picking investors, and that's why you went to China after all. What did you learn for investors who are looking at China? What opportunities do you think there are there, if any?
Well, first of all, for the average investor, I would say you shouldn't be messing around with these. These are sharp objects. And China is a sharp object. There's no question about that. But investing, as you well know, is a mix of valuation and upside. And China valuations, even though the stock market has had a heck of a run this year, are still relatively cheap, certainly compared to the S&P. The multiple's probably half of the S&Ps or something like that. And companies, there are some doing well, some doing less well, depending upon what part of the economy they're levered to and things like that. But the companies are still doing reasonably well. For example, in AI, in terms of the valuation point, the Chinese LLMs, comparables to OpenAI, they're valued at $4, $5, $10 billion, not $500 billion. And so, it's a lot harder to get hurt jumping out of a basement window.
Can you see a path, whether we're on it now or not, forward to a reasonable economic relationship between China and the United States? When we went through a long period of time, we had no relations with them. Then we sort of really became enamored, particularly with Deng Xiaoping, and coming to the WTO, you'll get more like us. Now there's a growing disenchantment with it. We have to get along with the second largest economy in the world, presumably.
Well, they never got more like us. I'm very admiring of the Chinese. I'm very respectful of them. But the idea that they play fair in trade was always an illusion. And the people who thought putting them in the WTO would bring them into the community of nations and then they'd start to play fair were obviously mistaken, because they have never done it. And you can go back to the pirated video cassettes and all the other examples there are of Chinese trade practices. So we can do our best to nudge them, pull them, cajole them, whatever. And if all else fails, then we do have to have trade restrictions if they're really, truly not going to play fair. But as I said, I think the only way we're going to, quote, win against China is by doing a better job at home.
Coming up, nestled in the Himalayas, Nepal may seem far removed from the rest of the world, but it turns out that it shares problems of wealth inequality and a vigorous social media to show its citizens just what's wrong. This is a story about turmoil at the top of the world. In September, Nepalese demonstrators took to the streets, burning buildings and forcing a change in the government. Our colleague Michael McKee traveled to Kathmandu to see firsthand what led to the violence and found a story of inequality and social media not all that different from the rest of the world.
I was tired of living in a country where not my capabilities or my competence, but the connection that people have takes them forward.
We plan to have a very small, peaceful protest.
Did you stay off of social media or did you go back to posting?
No, I went back to posting. I will never stop posting. It's fine even if I die, but I will be dying speaking up for my country.
There is a huge class difference, and all these people, they get these opportunities not because they are capable of it, just because they know somebody.
Madagascar, Sri Lanka, Philippines, Maldives, East Timor, Nepal.
Government properties being demolished, burned down. Did we ever think that we will be targeted next? No.
The big question is, how many other similar countries does this spread to?
Now more than ever before, people have a window into the lives of others. Social media connects youth across countries and continents, but it also shows them riches beyond their reach. And as inequality and unfairness become more conspicuous, some Gen Zers have taken to the streets. But nowhere was the movement more visible and more violent than in Nepal, a small democratic country wedged between Tibet and India.
We were marching towards the Parliament gate, and I was always very opinionated. I used to have opinions on everything. I was a rebel kid. This video is about me.
Prashamsa Subedi is a 22-year-old law student who lives with her parents in the outskirts of Nepal's capital, Kathmandu. Not long ago, her life took a surprising turn.
It was 2024 when I started uploading the videos about my political opinion, what I felt the government was doing wrong, and that's when it took off.
In late June, after a Nepali politician downplayed the country's poverty, Subedi posted an angry response on TikTok. A day later, her clip had over 1 million views.
How can a leader, mantri say that? Ke? Before, when we think of it, these politicians would not have their life public. So we would not know what their lifestyle was, how everything was going. But then there is a very famous politician. One of his family members was a vlogger. And she used to document their lives, and every clip used to go viral. And people used to see what lavish lifestyle they were having, which we could not even imagine. So that is how it all sparked. That is how it all triggered.
In Nepal, there are so many people who have hand-to-mouth situation, and then you show off your luxury, this and that, everybody would get angry. So was I.
Although inequality in Nepal may be more visible, its existence is hardly new. Its 31 million inhabitants make an average annual income of less than $2,000. And at around $40 billion per year, Nepal's GDP is lower than that of any U.S. state. But GDP has been on the rise, climbing at an average annual rate of over 4% in the last 10 years. It's also got a Gini coefficient that's fallen over the past 2 decades, showing that, with the limited data we have, the gap between rich and poor in Nepal seems to be shrinking. Ghanshyam Upadhyay is Nepal's finance secretary.
We have experienced the 4.2% economic growth in the last decade. 1 year we faced the negative growth, that is of the COVID-19 year. That's why the economy of Nepal is resilient. Inequality is reducing.
Small steps towards stability, but seemingly not enough. Anger and resentment over perceived economic injustice built up over the years, and seeing stark inequality on social media pushed people over the edge.
There's sudden visibility to how much richer the rich are than the poor, right? That ability to kind of see over the palace walls.
Clay Shirky studies the effect of social media on politics at New York University.
In revolution after revolution, there has been some sudden change in perception of how the wealthy are living. In Nepal, it was around this idea of Nepo babies, right? It was the idea that the children of the rich were not suffering the way the rest of Gen Z was. There's a case, one of the famous Nepalese influencers, she was a former Miss Nepal, she was a Harvard graduate, and she was widely followed on Instagram. And once the idea of the Nepo baby arrives, many of her followers turned against her. She suddenly became a target for outrage for exactly the same thing she'd been posting all the way along.
Something had changed about the way Nepal's youth saw their country and the lives of its wealthiest citizens. It was not just the inequality that felt wrong, but the inequality of opportunity. The idea that those at the bottom would never have the chance to rise up, and those at the top might not deserve to be there at all. And although generational wealth, corruption, and nepotism had always existed in Nepal, today they were in your face, on your phone, seemingly flaunted. As the online furor grew, the government made a dramatic decision.
And Nepal has cracked down on a number of social media platforms, including Facebook, YouTube, Instagram, X.
I was, first of all, utterly hopeless and helpless.
18-year-old Shaswat Lamachan was one of the many Gen Zers who was angry about the social media ban.
Talked with some activist friends, figured out like what we could do, and we concluded that doing a protest will be the best way to do it.
Lamachan says he expected 200 protesters to show up. But across the country, others like him were putting out the same call to friends and influencers.
Today, we are here to say enough.
First, never-ending corruption.
The collective action problem is if one person goes to the government and is protesting out front, they are completely helpless. But if 1,000 people do, they have to pay attention. And if 10,000 people do, they're overwhelmed.
Everyone we spoke with said the plan was for a small, peaceful protest. But in the 3 short days between the social media ban and the protest on September 8th, the call to action spread like wildfire.
By that point, the evening of September 7, we figured out that this would be huge because everyone was talking about it. It ended up becoming a national thing.
Well, tell us what happened on September 8th when you woke up in the morning.
I didn't sleep that day.
We all planned to wear school dresses so that police could not even beat us because it's illegal to beat school children. We started marching and we were chanting slogans and we were having fun, we were singing songs, some people were playing Uno there, and we were 100 meters away from Parliament where we were sitting, and we got the sense of tear gas.
In an instant, everything changed.
That is when I got the news of a person being killed. We didn't think it would go that far, but there was a news of a person being targeted. I was just scrolling through the news. I could not work. I could not do anything. I was just scrolling through the one scroll, one death. One scroll, one death. After the news that one person is shot and he is dead, I felt so guilty because he might have come watching my videos. So maybe I am responsible for his death.
Police firing actual shots at children dying.
News of the violence traveled quickly, and then escalation.
The very clip that I would say that ignited the fire in the people was a 17-year-old getting shot on his head.
It outreached the whole population. The next day it was not Gen Z anymore. It was the nation versus the government.
The Hilton got burned. They started burning all the government buildings and everything.
Our palaces were burnt. Our banks were looted.
This factory belonged to the family of Nirvana Chaudhary, whose home was also set ablaze. His family owns one of Nepal's largest businesses.
So they went after your parents' house and then one of your factories.
Our showrooms got burned down and motorcycles looted, vehicles looted. People are frustrated. People are jobless. Do they want to see big homes over there? Frustration was what was targeted towards individuals and families like ours.
By the end of the violence, over 70 people had died, 2,000 injured. All the Gen Zers who spoke to us on camera made clear they never advocated violence and were far away when the situation escalated to the highest levels of government. On September 9th, one day after the protests began, many of Nepal's top leaders resigned, including the Prime Minister himself.
We never imagined this situation. It was like nobody told us we would be a country without a government.
The Gen Zers worried that in trying to improve their democracy, they might have inadvertently ended it. The army was taking control, stepping into the vacuum left by Nepal's leadership. But then, an unexpected phone call in the middle of the night.
The army invited us to sit down with them at the army headquarters to talk on what to do next, what the future of the country should look like.
Subedi also got the army's call, along with a handful of others. The ask, you helped start this, now come fix it. Lamichan, who had started a chat room to organize the protests, helped create another, this time to pick a new leader. Over 100,000 people joined, and for hours they debated and voted. The name they chose? Sushila Karki, a retired Supreme Court justice known for fighting corruption and supporting women's rights. Subedi, the law student, got her phone number.
She was asking if we were okay and everything, and we asked her to step up, and then she said, if you guys are trusting on me, then I will have to step up because it's not about me anymore, it's about the country.
Do you look at this and think, how amazing, I spoke into this camera and look what's happened?
Actually, no, because I still have that guilt of posting the video, and I still think some people might have come watching my videos and they had to lose their lives. But if something great happens in the days coming forward, then that day I might be able to grasp that I was one of the major people who was responsible for this change to happen.
In the weeks since Nepal's government was brought down, so-called Gen Z protests have erupted in other countries, including Morocco, Madagascar, and Peru. The outcome of these movements is uncertain, and their motivations are varied. But they are each grounded in the economics of inequality and a belief among younger generations that the system has, in some way, failed them.
Has something changed in society that makes people angrier about their condition? We've had the peasants and the royalty forever.
So there is a general anti-royalist and anti-elite sentiment that is spreading from country to country, a sense that the leaders of the country are not natural rulers. And there's also a sense that the economy should work for young people. And some of this is really just comparative, right? If you live in a place and you have a certain kind of life and you have no idea what anybody else's life is like, it's easy to just say this is how the world is. But if you can see across, right, if you can see to other countries, if you can see to other cities, that comparative sensibility makes it harder for a royal family or a set of hereditary elites to maintain legitimacy. And just the idea that the children of rich people should not have disproportionate opportunity, that is a surprising new idea.
For Subedi and others, it's an idea whose time has come. A look over the palace wall made them angry, but then also hopeful for a better future. Hopeful enough to take action. And now, hopeful that their action will be worth the sacrifice.
Up next, capitalism at a crossroads. That's what several experts have addressed in various ways as we seek a new model to replace the one that got us into the great financial crisis. Here at Wall Street Week, we bring you stories of capitalism every week. But this story is not just of capitalism, but
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
about capitalism, where it came from, where it's headed, and why so many people are questioning its future and its foundations. One of them is about to take over as mayor of Wall Street's home city at the end of the year.
I am a democratic socialist.
And if you listen to President Trump, it's not enough that Mr. Mamdani embraces democratic socialism. He insists on calling him an outright communist.
And now let's see how a communist does in New York. We're going to see how that works out.
Our Bloomberg colleague, John Authers, has taken a look through several recent books about capitalism's challenges, written not by its opponents, but by its supporters. And he has some thoughts about why there's so much capitalist soul-searching these days. Thoughts that he shared with us. What is capitalism? How do you define it?
Well, part of its strength, it's something that grew up naturally and has had the ability to morph and adapt in a way that none of its alternatives, socialism, communism, etc., have been able to do. I've been churning my way through this selection of enormous tomes, all of which have in common this belief that capitalism is in crisis. The point is that it adapts each time it has a crisis. There are more truly non-capitalist alternatives being considered at present than there have been, and arguably the latest model of capitalism really fell in 2008. We work for Bloomberg, we're part of the citadels of capitalism. Everybody, I think, has to agree that the model that was in force until 2008 really perished with the crisis. You would normally expect them to be more clarity about what was coming next this long after the crisis. And I think the reason people are writing so much about capitalism now, getting so worried, is that we're not seeing that new model, that new narrative taking shape with any clarity.
Before we look at the new model, let's talk about the old models. What are the models that capitalism has evolved through?
I'll give you the schema that Anatol Koletsky, who's sort of known these days for having set up the Gavkal. His book, Capitalism 4.0, is about what is Capitalism 4.0 going to be. 1.0 was laissez-faire. It gave us the growth of the British Empire, the Industrial Revolution, the Gilded Age here in the States, and it finally perishes after the Great Crash and the Great Depression. Capitalism 2.0 is basically Keynesianism, the New Deal, the Marshall Plan, the GI Bill. It gives you the great successes of the post-war economic miracles in Germany and Japan, and founders, obviously, in stagflation in the 1970s. Capitalism 3.0, we generally think of with regard to Ronald Reagan and Margaret Thatcher, the great pioneers of it, Paul Volcker, with the way he took over the Fed and changed monetary policy, the rule of the dollar. Nobody thinks that capitalism of the Thatcher-Reagan kind is going to come back anytime soon. We are going to have some transition on the scale of those ones I've just mentioned, the ones that came after 29 and after the 70s. The question is exactly what the capitalism 4.0 will be.
Although capitalism in markets and democracy in politics tend to occur together and have some things in common, they are not the same.
In each case, it was the markets that signaled to the politicians that this model had ceased to work. With the Great Crash, with the great inflation of the 70s, and with the crisis of 08. Democracy and capitalism have a symbiotic relationship. There's a wonderful line from Winston Churchill that democracy is the worst way of running society that anybody has come up with, apart from all the others that have ever been tried. Both have it in common that they're not perfect, but that they are more or less impossible to improve upon. They have internal checks. You don't want to get thrown out by the voters. If you're a politician, you greed and fear counter each other, and the two systems check each other. It's largely now up to governments to work out what to do next.
Does capitalism work without growth?
Yes, that is a critical problem. This is Sven Beckert's book, professor of history at Harvard. He spent 10 years writing this magnum opus on the history of capitalism, and one of the points he makes is that it's like a shark. It has to keep moving. You could argue that it's capitalism 1.0, Gilded Age. Donald Trump is terribly excited by President McKinley, who went for very high tariffs in the late 19th century when America was expanding the way it was by building railroads, connecting up the west and the east coast and all the rest of it, was a way of protecting this infant economy as it got ready to take over its hegemonic position in the world. However, most of the people I've been talking to would suggest that there's something a little more alarming going on, which you might call capitalism 0.0, or pre-capitalism, which is mercantilism, the idea that came before. Capitalism grows out of Britain's victory in the Napoleonic Wars, the growth of the British Empire and the Industrial Revolution. Different countries had their own spheres of influence and then tried to build empires to give them a place to sell their stuff to.
One of the problems facing capitalism is the growing role of governments in intervening to minimize pain for markets and investors.
Well, my point, David, in the book is not that capitalism has failed, but that it's been ruined. And it's been ruined by government over time.
Author Rashir Sharma is head of Rockefeller Capital Management's international business. His book is What Went Wrong with Capitalism.
So then you began to expand the role of the state. The problem is that it is now expanded to such an extent, and it's not just about government spending, as I said. It's the culture of the bailouts. Who does it help? It's the regulations. Who does regulation really help? And what I say in the book is that all these things have systematically increased to undermine what capitalism is supposed to be. And the outcomes we're getting today is not what the founders had in mind. When the founders spoke about the architects of capitalism, they wanted more competition, churn to happen, that the incumbents are never entrenched, that they're always challenged by insurgents. Capitalism was supposed to create that freedom. Let the insurgents come and challenge the incumbents. Instead, what we are seeing today is that the incumbents are getting more and more entrenched. The concentration of power, as you can see, the number of companies that dominate the S&P 500, how concentrated that is. And also the fact that you get this mismatch in risk, which is that you can capitalize the gains, but we are here to socialize the losses. I think it's this perversion of capitalism that we have seen today. And this is having real consequences.
That concentration has only increased in recent years. Much of the growth in America's equity markets today is driven by the Magnificent Seven.
Productivity growth around the world, and particularly like in America, has been falling off, right? At the end of the day, the key to long-term economic growth is productivity growth. So productivity growth is falling off. Why is it falling off? I argue it's because the dynamism that capitalism brought about getting new people to come, about taking out the dead wood, that dynamism is getting lost in this constant state support that we have for capitalism. And the other negative consequence is this concentration of power. And when you have so much regulation out there, that helps the incumbents. They're big. They can afford to deal with those regulations, and they can even lobby in Washington to get the kind of regulations that they want. But small to mid-sized businesses, they find it increasingly difficult to survive, forget even thrive in this kind of environment. There's a deep unhappiness with the establishment, as most people are very unhappy with their own fortunes, right? Which is that in America today, for example, I think about 70% of Americans today say that they are unlikely to be better off than their parents. This is a violation of the American capitalist dream. The American capitalist dream from 40, 50 years ago was that most Americans thought they're going to be better off than their parents. You're supposed to be better off over time. Young people in America today, when you poll them, they tell you that they'd rather have socialism than they would have capitalism. For me, that is possibly the one most important statistic that inspired me to write this book. That why are so many young people in this country disillusioned with capitalism? And the answer for me is the fact that they're disillusioned with the current form of system, which they think is capitalism.
With all the challenges that capitalism faces today, perhaps the most ironic is that its biggest advantage, deep capital markets, may in the end itself turn out to be anti-capitalist.
One of the things that surprised me, I've spent the last 20 years of my life covering this, it's fascinating how many actual capitalists, people involved in finance, now regard the degree of liquidity in the markets, the degree of financialization as having been a problem. One way to express this is a guy called Amar Bide, who's currently at Columbia, very interesting thinker, argues that to make a market as deep as they currently are, to be able to trade things, you actually need to homogenize them, you need to plan them. You rely on MSCI and S&P to create indexes, and then you trade indexes. You get the rating agencies to tell you, yes, this is AAA, you can split it around however you like. That you end up, in order to make markets that liquid, so that you can trade them, they can become as big and liquid as they are, you have to make such sweeping decisions about how you define companies, how you allocate them, that you're basically taking the role of a communist planner. So there is an argument in which the liquefaction, the financialization of the economy basically did away with judgment, did away with the notion of trust in people's dealings with each other, and therefore led to a version of capitalism that frankly isn't any better than socialism or communism.
Coming up, what happens when the next generation isn't all that interested in inheriting that family-owned business we've spent our lives building up? The story of small business succession in the United States. This is a story about
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
We don't see the robots taking over the jobs from humans. We try to make the job of the humans easier and to have more technical people that are really controlling the robots and especially improving the quality by utilizing those technologies. We have already deployed a first phase of robotics through Boston Dynamics, and we are working on the next phase on how can we facilitate the job of the workers.
hand-me-downs, not that sweater your cousin has grown out of, but a treasured local business that your parents spent a lifetime building up so you can take it over. A business like the family dry cleaners Gary Bachner has run 6 days a week for 35 years.
It all began in 1961 when Gary's father, Seymour, opened the family's first dry cleaning shop on New York City's Upper East Side.
My father bought Joseph Cleaners 1961 on York Avenue and 80th Street. He was obsessed with two things, Joseph Cleaners and the dry cleaning business and the New York football Giants. He lived the business, but as one of my friends said, it wasn't work for him. He loved the people, he loved the action, he loved trying to get the product to the people in a quality way, and he just had a great work ethic, never missed a day of work from 61 to 96.
Side by side, the father and son duo opened East Hills Cleaners in 2003, expanding the family's legacy.
We had to sign a new lease in 2001, and rent was going up, cost of doing business was going up, business was still good, and we decided to, okay, we'll sell, and then we decided to look for a store on Long Island, and we worked really hard to build this up. Okay, thank you.
After decades in the business, Gary is starting to look at what comes next, which for many mom and pops often means continuing the family business without the family.
Succession plan is something that I'm concerned with. I can't keep working, these hours. I try to take some weekends off and some time off. It's a small business, as the boss being here. My family says the brand in a small business is you.
Gary Bachner is far from an outlier. According to the U.S. Census Bureau, just over half of U.S. businesses are owned by people 55 and older. That's millions of small businesses nationwide that will soon be looking for someone new to take the reins.
The small family-owned businesses are a huge part of our economy. They're actually the backbone of our economy. There are about 5.5 million of them, and they employ a tremendous amount of the workforce in the U.S.
Christina Wing is founder of Wingspan Legacy and senior lecturer at the Harvard Business School, specializing in what comes next for America's family businesses.
Is the nature of small family-owned businesses changing in the United States?
In years past, it was left to the children, and the children wanted to run it. Now the rising gen would rather the family business owners sell their business, and they'd rather inherit the cash. And that's going to cause a real issue in the economy, because it's going to lead to jobs going away, and it's going to lead to people in communities owning the business that aren't part of the community.
Despite the importance of family-owned businesses to the U.S. economy, and despite the imminent retirement of many who built and run them, there's still a striking lack of planning for what comes next. A recent U.S. bank survey shows that only half of the 1,000 small businesses interviewed has a succession plan in place.
We talk a lot about succession when it's a big publicly traded company. Do small family-owned businesses think and talk about succession as well?
So the funny thing is, we actually talk about succession about other people, but inside the families, they don't talk about succession. We really need to start talking about succession a lot earlier, and it has nothing to do with the size of the business.
If I am an owner of a small business, and I'm getting on in years, and I want to figure out a way out, where do I turn? Who do I ask for advice?
There are advisors, unfortunately, who most owners of a small business ask. They ask a friend, and most friend has done it poorly. We have this problem everywhere in the world where succession and age get mingled. And so you start to feel, I'm old, I need a succession plan, oh, I better sell. But if they would talk to more professionals in this space, I think that they would see they have other options. And that's that spectrum of owner-operator to owner-investor. I think there's a lot of people that would love to hold the business, because sometimes their children might not want to work in it, but their grandchildren might want to. And so if you can kind of play it out for a while, it gives you more flexibility.
Over the next 25 years, baby boomer and older households are expected to pass down about $100 trillion in wealth. And though we don't know exactly how much will come from family-owned businesses, those holdings make up roughly 18% of their net worth, pointing to an estimated $18 trillion in business value that could change hands by 2048. But unlike other assets, family businesses can be messy, which makes the next generation less interested in receiving what's being passed down.
The era of sort of 2015 to 2018, I felt a little more pressure from founders wanting to work with their children. I'm seeing less and less, I should say, challenges from the next generation wanting to remain with the business, and really the business owner, the founder, looking for a solution provider.
Jarrett Turner comes from a family business, a roofing company founded and still operated by his 73-year-old father. Like others, Turner didn't want to go into the business himself, but instead started a middle-market private equity firm 11 years ago to help people like his dad when the time came for them to step down.
A lot of these businesses, the value in part is the connection to the community. They know the owner. They've been going to the same shop for a long time. Does the value of the business go down when it does come time for the founder to leave?
If the founder were to leave and control a lot of local relationships, I think inherently the business value would go down.
Turner's Soundcore gives owners the option to sell while staying involved in running their business for an extended period, preserving, at least for a time, the best of a local enterprise. It provides capital to those who built the businesses and continuity for the communities they serve.
We're focused on developing theses in sectors which we deem to be highly fragmented, in big market TAMs where we can aggregate and buy a number of family founder owner-operated businesses in the same sector. We can professionalize, we can implement technology, best practices, procurement programs, and take them to sort of the next level of professionalization, take market share, grow revenue, improve margins, and then typically sell within 4 to 5 years to a larger scale buyer.
Typically, when you buy a business, is it 100% of the business?
So I think when you're a private equity firm, or maybe you're a family buying someone else's business, one of the challenges is customer relationships with the business owner, and also the DNA of that business, the culture is often driven by 1 or 2 people. So for us as a philosophy, we look at sellers and we put together a seller retention matrix where we look at a lot of qualitative aspects of their personality and how long have they been with the business, the number of customers that they have, the number of suppliers that they have. But one of the best ways as a buyer to assure that you're going to have interest in that business owner to continue to sort of drive the business forward and not improve their golf score the next day is to have skin in the game.
Do you have much competition in private equity for small family-owned businesses?
I would say you would have to look at our average multiple that we pay. If you type in private equity and average purchase price multiple into Google and other search engine, you will typically see 12 to 20 plus times EBITDA. We've averaged in context at a 5.9 times multiple, and that's across 109 acquisitions. So in terms of our volume and the number of acquisitions that we've done and apply that to the multiple, we're probably one of the lowest of any private equity firm in the United States. I would use that as evidence that we don't have a lot of competition. The way that we're able to do that is we're buying very small businesses.
In a changing economy, dependable cash-generating businesses are gold mines, especially for private equity firms able to buy small and scale fast.
We at Soundcore, we focus on recession-resistant businesses.
What's your average length of time you hold them?
So we've owned businesses for a spread of 3 to 7 years. Our average is 5 years.
So that strikes me as remarkably short in private equity generally right now. We hear a lot, read a lot about private equity generally, the big private equity, having trouble getting out of investments. Is yours a different approach to private equity?
I think it is. I mean, I think there are a few things that you can do wrong in private equity. You can overpay for businesses, you can over leverage them and put them into a bad capital structure, or you can pick your favorite child and put too much of your fund in a commingled fund into one deal that doesn't go right. It drags down the rest of the fund. I think by our strategy of not overpaying for businesses, but giving business owners a fair price, not chasing to win auction processes, there's a lot more opportunity, even in this market, to exit our businesses.
For many owners, firms like Turner's present a way out, even if taken in stages. But Wing warns that the rise of large consolidators brings its own consequences.
We're seeing immense consolidation in the space, which means a private equity firm might have a mandate to go buy 100 dry cleaners within the Southwest or the Southeast or wherever. And then the brand and the experience becomes that of the 100, not of the local. And so it's a change in the community.
Well, that may not be an entity the local community likes as much, but it may be a more efficient business, may it not?
I think that the roll up of a lot of different personality-based businesses, there are great reasons to do that in certain places, but I don't think overall that I would make a statement that a financial buyer is a better owner than others unequivocally. But there are cases where they are.
And that brings Wing to a challenge she sees again and again. Many longtime owners assume selling is their only way to retire.
Because they've been owner-operators. If we can get some of them to understand, they could become owner-investors themselves, meaning they could keep the business, have somebody else run it, pay that person, but still own it.
Legacy's everything, you know. This is how I grew up. Quality, responsibility, and personality. We have great relationships with our customers. We've known them now generations.
Oh, really?
We give them a good product, and we like serving the community.
For Bachner, like so many others, it's never just a business. It's the early mornings, the familiar faces, the generations of trust that turn a storefront into a cornerstone of a community. And as the next generation steps in or steps away, the values at the core of these small businesses remain the foundation for whatever comes next.
Next, options for helping capitalism overcome its crisis of confidence.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Our ultimate goal was to turn the fridge from a storage box to a smart kitchen manager that helps the users.
That comes down to finding the optimal location for our camera.
I am most proud of our image matching algorithm. The entire user experience has to be fast and seamless. When it worked like we expected, it was really a breakthrough.
If capitalism is caught somewhere between a crossroads and a crisis, what are some of the things that could help it find its way again? John Authors and Rashir Sharma take us through some options. Does AI help or hurt? On the one hand, we're told we'll get a lot more productivity. That sounds good for growth. On the other hand, there are real questions about whether we're going to need nearly as many people working.
Yes, exactly right. The positive side of it is, yes, that creates, if you get a big bounce in productivity, then you can have nice low interest rates, you can get rid of inflation, you can make a lot of people much happier. The huge deficits that governments have at the moment become much less of a problem if productivity really grows. So that is the positive side of the equation. The negative side, as you just said, is that it kind of implies if AI is going to be that successful in building productivity, we all know all the amazing things AI can do that currently you need a human being to do. It of necessity involves far fewer people actually in work. Capitalism without workers is a very difficult concept, and if you want capitalism to work with democracy, capitalism with workers is not an easy thing to get a majority of the people to go along with. I'm being a British understatement there. There's no way people are going to put up with that. That leads to the interest particularly get from Silicon Valley, tech bro types in universal basic income. People lampoon this as a reward for laziness. But you could also look at this is a phrase from Victor Schwetz of Macquarie, who's written a book on capitalism. You could look at this as a compensation for irrelevance. You're not an economically relevant person, but you are a human being and you deserve a basic income.
Ruchir Sharma sees hope for the healing of capitalism in a basic return to equality of opportunity rather than a guarantee of equal results.
Is growing inequality inherent in capitalism?
In a way it is. So you're right about that. And I've always said that capitalism is meant to create inequality of outcomes, right? Just because of the fact that it is supposed to reward meritocracy. So you get inequality because of that. But here's the fundamental difference. Inequality in outcome is very different than inequality in opportunity, which is that capitalism is that everybody has equal opportunity, but then you can end up getting inequality of outcomes based on meritocracy. That is what true capitalism is supposed to be. Problem is that most people in America today feel that they don't have equality of opportunity. And that inequality of opportunity is not there because they feel that if you're big, you're well connected, you're close to Washington, you'll be able to get your way.
So where is capitalism working, at least relatively well, today?
So firstly, there is no utopian nation in the world. In my book, I speak about 3 countries where capitalism is moving in the right direction. For example, at the bottom of the development ladder, there are countries like Vietnam, which are going the way of China in a good way from an economic perspective. Because I think one thing we misunderstand about the Chinese economic success is most of us think that the Chinese economic success is about how the state promoted industries and like it was state-driven capitalism. What I show in the book, and other people have also sort of written about this, is that the key to China's economic success starting in the late 1970s was that the government got out of the way. Which brings me to my second example that I cite here, which is Taiwan. More of a middle-income country or top of the middle-income rung. That in Taiwan is very instructive in one way. That government spending in Taiwan as a share of GDP is far less than Europe or even America. I think about 25% or something. Government spending as a share of GDP, that low. But what they do is the government is super efficient and super tech savvy. So what Taiwan has shown us is that the impulse in countries like America is that whenever you have a problem, you say, oh, the government needs to fix it and let's throw more money at the problem. What the Taiwan and even the Koreas of the world show us is that you can achieve a lot if the government prioritizes a few things and also uses technology very savvily to try and achieve the outcomes. So therefore I cite Vietnam at the bottom of the rung, and the middle of the rung a country like Taiwan. And then of course I cite the richest country in the world, practically. That's Switzerland. It's the richest country in the world. And it also ranks as among the 10 happiest countries in the world, right? Because what do you want? Just being rich you think is not good enough, right? But you also want to be happy. And Switzerland is a country I've traveled in extensively. And what have I learned about this country? One, if you look at it, that it's again about prioritizing. That in Switzerland, government spending or even tax as a share of GDP is much lower than any of the other European countries. So I've traveled extensively like in Switzerland, and what I find remarkable about that country is the amount of decentralization that you have there. That I think there are about 26 odd cantons in Switzerland, and each canton figures out what's its strength and it plays to that strength, and there's much less centralization. So you have some canton which is busy making cuckoo clocks, someone doing Swiss knives, some other canton which sort of figures out that it's about watches. So I think that's the great thing about the Swiss model. It's about decentralization. It's about keeping government spending as a share of GDP relatively limited. Now, as I said, that there is no perfect nation. Even they played a role in bailing out the financial industry back in 2023 and stuff. But there's a reason why Switzerland is the richest country in the world today, and which doesn't get spoken about as much. So I think there are 3 things that we can do in America which are both politically popular and also economically good policy, right? Which is both good politics and good economics. So number 1, the leading symbol of what went wrong with capitalism in countries like America is housing prices. That for most people, the reason why they're disillusioned with the current capitalist model is because they cannot afford to buy a home. So the single biggest reason why housing prices are so elevated in America is that there's a complete lack of supply. That the new housing starts in America today are roughly where we were in the 1950s. So the population has grown obviously significantly, and yet it is very difficult to build new because the amount of regulation that you have, both federal, state, city, and it's all sorts of forms. Some of it is even cultural, like NIMBYism and things. So because of this, the amount of housing supply coming on is very limited. So the number one thing about making America affordable again is what do you do to get housing prices down, and deregulating the housing market and doing much more to increase supply needs to be the number one political and economic priority for this country. The second thing I will say is that there's been so much focus on financial sector deregulation, right? Every time we talk about deregulation, it's about the financial sector. And that's why in the 1980s and stuff like that, this impression was created that we're moving towards a much more market-oriented society because of the kind of financial sector deregulation that took place. But my point is that outside of the financial sector, we have had much more regulation that's taken place. And that is very painful to mid and small size businesses. Like in America, in the last 20 years, we have introduced on average 3,000 new regulations a year. And in that 20-year time horizon, the number of regulations that we have withdrawn, 20, over 20 years. And the third thing, as I say, is that we got to get out of this culture of bailouts. That America was not a place that believed in bailing out private sector companies. These bailouts are not popular. We saw that in 2008. And yet, we have a tendency of just bailing out financial firms at the slightest hint of trouble. So I'd say that these are three things which can be done, which would be both politically popular and economically sensible.
That does it for us here at Wall Street Week. I'm David Weston. See you next week for more stories of capitalism.
to today. And of course, on your screens too is copper following the recent declines. Very big drop in copper names in the greater Chinese market on Monday. And so we'll see what happens, of course, as a broader cohort today as well.
Yeah. Summarize, nothing's happening until the Fed mentions something, right? But I think the rate cut is all but priced in. But, really, that's the least important thing, really, in this meeting, right? It's all going to be about the signals, whether they can continue on with this rate cutting cycle when you have the rest of the world basically saying, we're done with our easing phases here so far. And then you have to talk about, or are they going to be just hitting the pause button when it comes to rate cuts moving forward, right? You talk about the pricing, right? December is pretty much all but guaranteed, but next year is still pretty much up in question. So I think the dot plots will be very interesting this time around.
It will be, right? So I think on the dovish side, we had Citi yesterday, and, their dovish call is a cut today, a cut this week rather, January and then March. You look at where market pricing is. The one after this one is not until let's call it the back half of the first half of next year, right? Hence the extremely range-bound session we're seeing in the treasuries market today. Not to mention, of course, the RBA yesterday, to the point you were making, right? That it does seem most of these central banks, with the exception of the BOJ, they're probably at the back end, if not done with their easing cycle.
Yeah, I think RBA, you've had the ECB and some officials there talking about, look, they're comfortable with the next move actually being higher for the ECB. So at this moment, are we dealing with more rate convergence or actually divergence next year? It seems like it's more about the former. But I think you mentioned, right, the next cut could be June of next year, but they're only talking about two that's been priced in currently according to money markets for next year. Then that's a lot of recalibration already and a retreat from what we've been seeing from maybe a few months ago.
Right. 1 and 2 is almost, the margin of error, you could almost call it nothing, right? On one side. You could also get 4 cuts, obviously, on the other side of that. Now, we mentioned Japan, of course, which is dancing to its own tune. Separately, you do have, of course, the China conversation on rates, and I think later on in the show we'll be having CGS International joining us, and their call is, given the rates outlook in China, 1 to 2 rate cuts next year. That's 10 to 20 basis points. We'll hear from Angela a bit later, Angela Zhang. Now, that goes into the inflation story in China today, where we are expecting a rebound. And in fact, when you look at, I think, the forecasts of 0.7, I know that does not sound like a lot, but I mean, that underscores the lack of inflation in recent years. At 0.7% actually would be the highest going back to early 2020. It doesn't complete the data set, but it certainly gets us closer to the activity numbers, which should be out, of course, over the next week.
It's what they call this kind of slow burn in terms of reflation, right? It's going to be slowly emerging out of that. Is sort of the theme that I think many economists are expecting for next year. But then again, it's been a pretty, I guess, when it comes to the data side of things in November, it hasn't been great, and it hasn't quite shown that things are firing on all cylinders. So you contrast that with what the Politburo meeting and really kind of the more optimistic tone around the growth picture is. That's certainly going to be quite interesting to see how long that sort of gap lasts as well. So that's one thing. We're still waiting for the credit data. You're focusing on markets that are not doing much, but the Chinex seems to be continuing on with this rally too. So
you had a
what's
big
going
move
on there?
Yeah, well, it was really the pronouncements coming out of the weekend. So I think it's a continued move we saw yesterday. It's certainly, if you had to pick one that was a standout, it was that. It wasn't by a lot. So on a normal day, that is something that would actually not be something to keep an eye on. We'll talk about the Vanke meeting in a moment. You have, I think, 2 trading debuts today. The IMF's briefing on the Chinese economic outlook, that's also happening. That's on deck. Now, as far as the sectors to watch, you have crypto, given the slight bounce we're seeing there. We talked about precious metals, and of course, drone makers. It's interesting because, of course, some of the tightening around regulation, and we'll see whether or not that affects trade today across some of the hardware plays, the drone makers there. But
Yeah, let's get to, of course, our top stories here this morning. It is that inflation print out of China set to release for November later on at the bottom of this hour. And really when it comes to CPI, we're expected to see a modest tick up. Factory PPI prices, though, remain in contraction. Let's bring in our China correspondent, Min Long, on what we're expecting here today.
Yeah, so we are expecting CPI to tick up to 0.7%. So it's still far below the target of around 2%, but pretty significant considering the longer term trend. It's been hovering around 0 so far. And if it comes through, 0.7% would be the highest print we have gotten since, I think, February of 2024. PPI, though, is just expected to be just marginally better, still declining by about 2%. And the divergence between CPI and PPI shows you how difficult and entrenched the deflationary trend trend has been, right? And it also ties into the trade data we got last week, which shows exports being really good, but imports lagging behind. And the PPI number in some ways probably making Chinese exports so competitive. And you also tie this into U.S. prices as well. China is probably exporting that deflationary pressure to the U.S., which is saving the U.S. from the worst of inflation, which also then opens the gate for the Fed to cut rates as well.
Yeah, see, look where that blessing came from, right? And everyone's in some ways hating on some case. Anyway, what does it tell us about the next year outlook?
Yeah, so we are looking ahead to the Central Economic Work Conference, which is probably taking place end of this week. So we'll be looking out for details from the readout. But from the Politburo meeting and the readout from there, the guidance seems to be that China is just going to, put out very incremental policies when it comes to domestic consumption stimulus. So that is something that I think investors have been disappointed by. But one thing to note from the Politburo readout, though, is that there has been the language there has been focusing on the external trade battle. And I think, that vigilance in policy making is key. Even as the government has been quite reluctant to put out the bold stimulus, they are paying attention to this protectionist streak that we are seeing globally.
Yeah, interesting they called it a battle as well. Min, thank you. Our China correspondent, Min Lo there. Another thing that we're watching out for today is this big meeting, right? Chinese developer Vanke is set to meet with bondholders to discuss a proposal to delay payment on a 2 billion yuan bond note due on December 15th. More, let's bring in our credit reporter for China, Trista Xingyi Luo. What's going to happen today specifically?
So bondholders are going to meet today at 10 a.m. local time, and they're going to review proposals so far. And they have currently have three proposals. The first one is the original plan Vanke proposed earlier to try to delay the yuan payment for a year without any upfront cash and any installments. And the other two offering more generous terms, asking them to pay interest on time and offer some credit enhancement. So today they're going to review those three proposals, and they will have until Friday to vote.
Yeah, I mean, separately, it's not all or nothing. There is some information out there that Vanke has reached out to some bondholders that the possibility of paying some of the interest, not everything, and then extending it. What do we know about that?
Yeah, so there has been, before today's meeting kicked off, there have been a lot of ongoing discussion between the local government, developer, and creditors. There was also even a meeting held over the weekend in Beijing. And then, as you mentioned yesterday, Vanke representative reached out to some creditors saying, yeah, we can, offer some interest payment, but they didn't specify how much. So I think that's a question there, and we really need to wait and see what's the discussion going to come out from today's meeting.
Okay, Trista, thank you so much. Our China credit reporter there, Trista Luo there. Right, coming up, we're having a look at monetary policy and bets in focus, not so much for this week, so that's almost a done deal when it comes to the Fed, but really what the path looks like in 2026. Pepperstone Group joins us for a wrap of markets this year, last few weeks, and a look into early of next year. Chris Weston in a couple of minutes with his thoughts. Cutting down to the open of trade, Shanghai, Shenzhen, and here in Hong Kong, futures are pointing to a slightly softer open. 20 minutes away, you're watching The China Show. Good morning to all of you.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
If the data suggests that we could do it, then like right now, I think there's plenty of room to do it.
Plenty of room, which plenty is more than 25 points.
Correct.
That was the White House National Economic Council Director Kevin Hassett there, of course, and largely seen as one of the contenders for the next Fed chair as well, mind you. Let's bring in Chris Weston, head of research at Pepperstone Group, as, of course, on this Fed day. Chris, I love what Tom Keene just mentioned in that commercial break. There's going to be a lot of anxiety, a lot of hesitation around this whole Fed meeting. I think the past 6 weeks, it's really kind of caught the eyes of many equity traders. And it really is more important than maybe even trade or even this whole AI discussion. What signals are you going to be looking out for in this meeting, apart from the rate cut that is largely priced in?
Yeah, I mean, it's really about the tone that they're setting for next year and whether we feel that love that is the Fed put and how open-minded they'll be to supporting should they need to support. And I think that's where the two-way risk in rates pricing comes for next year. So, I don't think we're going to see any changes to the dots. I don't think we're going to see any changes to the statement at SEPs. I think Powell basically come out and say that they're open-minded towards moderate rate cuts if they're needed, but obviously the barriers to do so are much higher these days. We're going to see the formal end to the recalibration phase. And so I think, if you have a look at the FX vol market, 1 week volatility across the dollar pairs is generally below the 20th percentile. It's very low, so the FX markets are not expecting the dollar to have a significant move. Gold's a little bit higher, but then obviously it's had a big run and positioning is very, very rich in that. And if you look at the S&P forward vol markets, they're pricing a 0.8% up or down move on for the Fed day. So that's kind of in line with the sort of realised vol we've seen over the last 8 quarters as well. So the markets are not expecting fireworks from this, and I think it's so conditional that the rate cuts priced in. Everyone's positioned for this hawkish cut, and there's going to be no changes to SCPs and stuff, various factors. So, I think as long as they're open-minded to further cuts if they're needed to happen, then I think we're okay with that situation, and we can plod on, and we can, obviously look to see what happens with Oracle's earnings, Broadcom's earnings, and next week with the payrolls and CPI. So, market's expecting a pretty low impact event, even through the significance of what obviously carries.
Yeah, I mean, clearly, Chris, David here, by the way, they're clearly looking past this, and you look at how poorly treasuries have been trading, how the curve's been steepening. Is there some element here that the markets are not just looking through this, but are somewhat expecting that the next move could actually be a rate hike here out of the Fed? I mean, might that be not just a tail risk at this point?
It's a tail risk, yeah, absolutely. I mean, and if you look at the distribution, if you looked at the full distribution of rates pricing, I'm sure there are people betting on the next move being a hike, but that would be a surprise to where the sort of weight of money is at the moment, because as everyone sort of says, is that the next move is expected to be in June, and we might get one more by the end of the year. That's the sort of, but that rates pricing is dynamic and it can move very, very sharply. If we were to get a strong payrolls number next week, I think above sort of 80,000 would probably constitute that. The break-even rate's around sort of 40, 50,000 on that payrolls number, and we would see the unemployment rate stay fairly firm. And then we look at inflation next week, and then obviously if we were still core inflation pushing up above 3.1%, then I think people would come into 2026 thinking is there 2 more cuts really the right call? And of course then you've got this mountain of issuance that's going to be coming through government bond markets. Probably not so much for the Fed, where most of it's going to come from the bill side of things, but certainly in Europe and Japan. And you've already seen curves long end moving up quite sharply, which is put some upside in the Treasury market as well. But I think there's really clearly two-way risk at the moment for rates pricing further out the curve. I think it's interesting that the terminal pricing has had a material shift recently. It's moved up about 41 basis points in the last month or so. So 323 is the sort of terminal pricing, and I think people are sort of massaging that position there as well.
Yeah, you mentioned about this is coming at a time where there's going to be a lot of government bond issuance, right? Particularly when it comes to Japan to fund this fiscal package, Europe as well. This coming at a time when we see a mountain of corporate bond issuance as well, whether it's for funding AI or the like. How do you see this kind of push and pull competing for global private capital here?
I think it's going to be one of the big debates for next year. I think things like affordability and electrical demand and pricing from their data centers is obviously going to be another big one as well. But I think the the investment grade issuance, certainly from the US corporate side, is expected to be quite significant. I mean, we're talking, estimates of $300 billion of issuance, mostly to pay for the infrastructure build out on data centers. We're talking about $3 trillion of infrastructure build out or investment over the next 3 years. But a lot of that's going to be funded on the debt markets. We've already seen places like Oracle and some of the Mag 7 stocks coming out and issuing that. But we're talking 300 billion next year. And we've also got about 900 billion in investment grade maturing over in next year as well. So some of that will need to be rolled over. Some of it obviously mature. But that is a significant amount of corporate issuance on the investment grade side, which could cause some widening of spreads and obviously some ripples through there. But obviously, as you say, that's going to be keep competing for a finite pool of private capital. With central banks not conducting quantitative easing and buying in the secondary market, there isn't. These entities are price sensitive, and when they're choosing between some very, very enticing investment grade issuance coming through against government bond markets, well, does that?
9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching The China Show. I'm Yvonne Mann with David Ingles.
We are counting down to the open of markets in Greater China. Our top stories today, stocks across the Asia-Pacific trading cautiously, very tepid session. On Wall Street, investors are holding off on big bets ahead of the Fed decision.
China's inflation numbers due this hour could show deflationary pressures easing slightly. Officials, meanwhile, signaling concerns about global trade as they prepare next year's economic plan.
And China Vanke is set to meet with bondholders today to discuss a payment delay as investors prepare for a worsening debt crisis.
Nine a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching The China Show. I'm Yvonne Mann with David Ingles.
We are counting down to the open of markets in Greater China. Our top stories today, stocks across the Asia-Pacific trading cautiously, very tepid session. On Wall Street, investors are holding off on big bets ahead of the Fed decision.
China's inflation numbers due this hour could show deflationary pressures easing slightly. Officials, meanwhile, signaling concerns about global trade as they prepare next year's economic plan.
And China Vanke is set to meet with bondholders today to discuss a payment delay as investors prepare for a worsening debt crisis. Good morning. Welcome to the program. Looking at markets, there's really not a lot to say given the price action on display, but we'll do it anyway, as they say. We're up about a 10 to 1%. We're on hold ahead of the Fed decision. It's not so much what they do. Largely expected to cut interest rates. You look at pricing, we'll get to that in a moment. Certainly the narrative is we'll have to wait a lot longer before they deliver on another one beyond today. The big story, though, across these markets, if you had to pick one, is in the commodity space, specifically precious metals, with silver on your screens, topping 60 and then some more going into today. A further 1% gains there. Iron ore is seeing a bit of a bounce following pressure in recent weeks. Copper is flat after the mild, should we call it correction? Following record highs. Brent crude bottom of your screens. A50 futures coming online, and the declines in focus given the yesterday price action. Hang Seng Tech has remained very much in range. It closed near the low end of that range. There's a technical level to watch going into today. And, of course, on your screens, too, is copper following the recent declines. Very big drop in copper names in the greater Chinese market on Monday. And so we'll see what happens, of course, as a broader cohort today as well.
Yeah. Summarize, nothing's happening until the Fed mentions something, right? But I think the rate cut is all but priced in. But, really, that's the least important thing, really, in this meeting, right? It's all going to be about the signals, whether they can continue on with this rate cutting cycle when you have the rest of the world basically saying, we're done with our easing phases here so far. And then you have to talk about, or they're going to be just hitting the pause button when it comes to rate cuts moving forward, right? You talk about the pricing, right? December is pretty much all but guaranteed, but next year is still pretty much up in question. So I think the dot plots will be very interesting this time around.
It will be, right? So I think on the dovish side, we had Citi yesterday, and their dovish call is a cut today. A cut this week, rather, January and then March. You look at where market pricing is. The one after this one is not until, let's call it the back half of the first half of next year, right? Hence the extremely range-bound session we're seeing in the Treasuries market today. Not to mention, of course, the RBA yesterday, to the point you're making, right? That it does seem most of these central banks, with the exception of the BOJ, they're probably at the back end, if not done with their easing cycle.
Yeah, I think RBA, you've had the ECB and some officials there talking about, look, they're comfortable with the next move actually being higher for the ECB. So at this moment, are we dealing with more rate convergence or actually divergence next year? It seems like it's more about the former. But I think you mentioned, right? The next cut could be June of next year, but they're only talking about two that's been priced in currently according to money markets for next year. Then that's a lot of recalibration already and a retreat from what we've been seeing from maybe a few months ago.
Right. 1 and 2 is almost, the margin of error, you could almost call it nothing, right? On one side. You could also get 4 cuts, obviously, on the other side of that. Now, we mentioned Japan, of course, which is dancing to its own tune. Separately, you do have, of course, the China conversation on rates, and I think later on in the show we'll be having CGS International joining us, and their call is, given the rates outlook in China, 1 to 2 rate cuts next year. That's 10 to 20 basis points. We'll hear from Angela a bit later, Angela Zhang. Now, that goes into the inflation story in China today, where we are expecting a rebound. And in fact, when you look at, I think, the forecasts of 0.7, I know that does not sound like a lot, but I mean, that underscores the lack of inflation in recent years. At 0.7% actually would be the highest going back to early 2020. It doesn't complete the data set, but it certainly gets us closer to the activity numbers, which should be out, of course, over the next week.
It's what they call this kind of slow burn in terms of reflation, right? It's going to be slowly emerging out of that. Is sort of the theme that I think many economists are expecting for next year. But then again, it's been a pretty, I guess, when it comes to the data side of things in November, it hasn't been great, and it hasn't quite shown that things are firing on all cylinders. So you contrast that with what the Politburo meeting and really kind of the more optimistic tone around the growth picture is. That's certainly going to be quite interesting to see how long that sort of gap lasts as well. So that's one thing. We're still waiting for the credit data. You focus on markets are not doing much, but the Chinex seems to be continuing on with this rally too. So
you had a
what's
big
going
move
on there?
Yeah, well, it was really the pronouncements coming out of the weekend. So I think it's a continued move we saw yesterday. It's certainly, if you had to pick one that was a standout, it was that. It wasn't by a lot. So on a normal day, that is something that would actually not be something to keep an eye on. We'll talk about the Vanke meeting in a moment. You have, I think, 2 trading debuts today. The IMF's briefing on the Chinese economic outlook, that's also happening. That's on deck. Now, as far as the sectors to watch, you have crypto, given the slight bounce we're seeing there. We talked about precious metals, and of course, drone makers is interesting because, of course, some of the tightening around regulation, and we'll see whether or not that affects trade today across some of the hardware plays, the drone makers there. But
Yeah, let's get to, of course, our top stories here this morning. It is that inflation print out of China set to release for November later on at the bottom of this hour. And really, when it comes to CPI, we're expected to see a modest tick up. Factory PPI prices, though, remain in contraction. Let's bring in our China correspondent, Min Long, on what we're expecting here today.
Yeah, so we are expecting CPI to tick up to 0.7%. So it's still far below the target of around 2%, but pretty significant considering the longer term trend. It's been hovering around 0 so far. And if it comes through, 0.7% would be the highest print we have gotten since, I think, February of 2024. PPI, though, is just expected to be just marginally better, still declining by about 2%. And the divergence between CPI and PPI shows you how difficult and entrenched the deflationary trend has been, right? And it also ties into the trade data we got last week, which shows exports being really good, but imports lagging behind. And the PPI number, in some ways, probably making Chinese exports so competitive. And you also tie this into U.S. prices as well. China is probably exporting that deflationary pressure to the U.S., which is saving the U.S. from the worst of inflation, which also then opens the gate for the Fed to cut rates as well.
Yeah, see, look where that blessing came from, right? And everyone's in some ways hating on some case. Anyway, what does it tell us about the next year outlook?
Yeah, so we are looking ahead to the Central Economic Work Conference, which is probably taking place end of this week. So we'll be looking out for details from the readout. But from the Politburo meeting and the readout from there, the guidance seems to be that China is just going to, put out very incremental policies when it comes to domestic consumption stimulus. So that is something that I think investors have been disappointed by. But one thing to note from the Politburo readout, though, is that there has been the language there has been focusing on the external trade battle. And I think, that vigilance in policy making is key. Even as the government has been quite reluctant to put out the bold stimulus, they are paying attention to this protectionist streak that we are seeing globally.
Yeah, interesting they called it a battle as well. Min, thank you. Our China correspondent, Min Lo there. Another thing that we're watching out for today is this big meeting, right? Chinese developer Vanke is set to meet with bondholders to discuss a proposal to delay payment on a 2 billion yuan bond note due on December 15th. More, let's bring in our credit reporter for China, Trista Xingyi-Luo. What's going to happen today, specifically?
So bondholders are going to meet today at 10 a.m. local time, and they're going to review proposals so far. And they have currently have three proposals. The first one is the original plan Vanke proposed earlier to try to delay the yuan payment for a year without any upfront cash and any installments. And the other two offering more generous term, asking them to pay interest on time and offer some credit enhancement. So today they're going to review those three proposals, and they will have until Friday to vote.
Yeah, I mean, separately, it's not all or nothing. There is some information out there that Vanke has reached out to some bondholders that the possibility of paying some of the interest, not everything, and then extending it. What do we know about that?
Yeah, so there has been, before today's meeting kicked off, there have been a lot of ongoing discussion between the local government, developer, and creditors. There was also even a meeting held over the weekend in Beijing. And then, as you mentioned yesterday, Vanke representative reached out to some creditors saying, yeah, we can, offer some interest payment, but they didn't specify how much. So I think that's a question there, and we really need to wait and see what's the discussion going to come out from today's meeting.
Okay, Trista, thank you so much. Our China credit reporter there, Trista Luo there. Right, coming up, we're having a look at monetary policy and bets in focus, not so much for this week, so that's almost a done deal when it comes to the Fed, but really what the path looks like in 2026. Pepperstone Group joins us for a wrap of markets this year, last few weeks, and a look into early of next year. Chris Weston in a couple of minutes with his thoughts. Cutting down to the open of trade, Shanghai, Shenzhen, and here in Hong Kong, futures are pointing to a slightly softer open. 20 minutes away, you're watching The China Show. Good morning to all of you.
We don't see the robots taking over the jobs from human. We try to make the job of the humans easier and to have more technical people that are really controlling the robots and especially improving the quality by utilizing those technologies. We have already deployed a first phase of robotics through Boston Dynamics, and we are working on the next phase on how can we facilitate the job of the workers.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
If the data suggests that we could do it, then like right now, I think there's plenty of room to do it.
Plenty of room, which plenty is more than 25 points.
Correct.
Okay.
That was the White House National Economic Council Director Kevin Hassett there, of course, and largely seen as one of the contenders for the next Fed chair as well, mind you. Let's bring in Chris Weston, head of research at Pepperstone Group, as of course on this Fed day. Chris, I love what Tom Keene just mentioned in that commercial break. There's going to be a lot of anxiety, a lot of hesitation around this whole Fed meeting. I think the past 6 weeks, it's really kind of caught the eyes of many equity traders. And it really is more important than maybe even trade or even this whole AI discussion. What signals are you going to be looking out for in this meeting, apart from the rate cut that is largely priced in?
Yeah, I mean, it's really about the tone that they're setting for next year, and whether we feel that love that is the Fed put, and how open-minded they'll be to supporting should they need to support. And I think that's where the two-way risk in rates pricing comes for next year. So I don't think we're going to see any changes to the dots. I don't think we're going to see any changes to the statement at SEPs. I think Powell will basically come out and say that they're open-minded towards moderate rate cuts if they're needed, but obviously the barriers to do so are much higher these days. We're going to see the formal end to the recalibration phase. And so I think, if you have a look at the FX vol market, 1 week volatility across the dollar pairs is generally below the 20th percentile. It's very low, so the FX markets are not expecting the dollar to have a significant move. Gold's a little bit higher, but then obviously it's had a big run, and positioning is very, very rich in that. And if you look at the S&P forward vol markets, they're pricing a 0.8% up or down move on for the Fed day. So that's kind of in line with the sort of realised vol we've seen over the last 8 quarters as well. So the markets are not expecting fireworks from this, and I think it's so conditional that the rate cuts priced in. Everyone's positioned for this hawkish cut, and there's going to be no changes to SCPs and stuff, various factors. So I think as long as they're open-minded to further cuts if they're needed to happen, then I think we're okay with that situation, and we can plod on, and we can obviously look to see what happens with Oracle's earnings, Broadcom's earnings, and next week with the payrolls and CPI. So market's expecting a pretty low impact event, even through the significance of what obviously carries.
Yeah, I mean, clearly, Chris, David here, by the way, they're clearly looking past this, and you look at how poorly treasuries have been trading, how the curve's been steepening. Is there some element here that the markets are not just looking through this, but are somewhat expecting that the next move could actually be a rate hike here out of the Fed? I mean, might that be not just a tail risk at this point?
It's a tail risk, yeah, absolutely. I mean, but and if you look at the distribution, if you looked at the full distribution of rates pricing, I'm sure there are people betting on the next move being a hike, but that would be a surprise to where the sort of weight of money is at the moment, because as everyone sort of says, is that the next move is expected to be in June, and we might get one more by the end of the year. That's the sort of, but that rates pricing is dynamic, and it can move very, very sharply. If we were to get a strong payrolls number next week, I think above sort of 80,000 would probably constitute that. The break-even rate's around sort of 40, 50,000 on that payrolls number, and we would see the unemployment rate stay fairly firm. And then we look at inflation next week, and then obviously if we were still core inflation pushing up above 3.1%, then I think people would come into 2026 thinking, is there 2 more cuts really the right call? And of course, then you've got this mountain of issuance that's going to be coming through government bond markets. Probably not so much for the Fed, where most of it's going to come from the bill side of things, but certainly in Europe and Japan. And you've already seen curves long end moving up quite sharply, which is put some upside in the Treasury market as well. But I think there's really clearly two-way risk at the moment for rates pricing further out the curve. I think it's interesting that the terminal pricing has had a material shift recently. It's moved up about 41 basis points in the last month or so. So 323 is the sort of terminal pricing, and I think people are sort of massaging that position there as well.
Yeah, you mentioned about this is coming at a time where there's going to be a lot of government bond issuance, right? Particularly when it comes to Japan to fund this fiscal package, Europe as well. This is coming at a time when we see a mountain of corporate bond issuance as well, whether it's for funding AI or the like. How do you see this kind of push and pull competing for global private capital here?
I think it's going to be one of the big debates for next year. I think things like affordability and electrical demand and pricing from their data centers is obviously going to be another big one as well. But I think the investment grade issuance, certainly from the US corporate side, is expected to be quite significant. I mean, we're talking estimates of $300 billion of issuance, mostly to pay for the infrastructure build out on data centers. We're talking about $3 trillion of infrastructure build out or investment over the next 3 years. But a lot of that's going to be funded on the debt markets. We've already seen places like Oracle and some of the Mag 7 stocks coming out and issuing that. But we're talking $300 billion next year. And we've also got about $900 billion in investment grade maturing over in next year as well. So some of that will need to be rolled over. Some of it obviously mature. But that is a significant amount of corporate issuance on the investment grade side, which could cause some widening of spreads and obviously some ripples through there. But obviously, as you say, that's going to be keep competing for a finite pool of private capital. With central banks not conducting quantitative easing and buying in the secondary market, there isn't. These entities are price sensitive, and when they're choosing between some very, very enticing investment grade issuance coming through against government bond markets, well, does that mean that we're going to see term premium increase at the long end? And that could cause some ripples in markets as well. So I do think that competing force of governments versus corporates is going to be a big theme.
If the term premium comes back, Chris, can I just maybe use that as a jumping off point? Are we sleeping on a stronger dollar next year then?
I just think you need to be open-minded, to be honest. I mean, everyone's going into this again thinking that the dollar's got downside risks and various factors, but I think FX vol is probably the trade for next year. No one likes to be long volatility because it costs money, but there's a roll charge and a carry charge involved in most of the sort of long volatility structures. But I think you're seeing bigger dispersions coming through in central bank pricing, and that generally means you see spread widening. Generally means you get FX volatility. But I think we just need to be open-minded to the possibility. It's a midterms next year. I think the US was going to get some tailwinds from the One Big Beautiful Bill, we've got rate hikes already priced in Australia, New Zealand, Canada for next year, Bank of Japan. But you've got to say that there's probably more risks that there's extra 50 basis points of cuts next year could come out of the market, which in theory could give you a stronger dollar. I don't think that we're going to see too much in the way of Fed independence being called either. So, I think open-minded, but I can make a case, very strong case for an upside in the US dollar.
All right, Chris, what does it mean for the whole AI trade too? I mean, we have Oracle earnings coming out as well. Seems like this one could be quite a volatile event too.
Well, I think the best trade for the moment is stay in the infrastructure side of things. There's no bubble there, and I think that's come off the boil a bit now. But the power generation stocks in the staples utilities, I think it's probably still a place to be, and maybe in the quantum side as well. Quantum computers is probably the place to go. But I think one of the big themes that's really emerged over the last month, which will continue to spill over next year, is the idea about Google TPUs versus OpenAI and the different stocks that are leveraged to both camps. I think it's a major one there. So obviously you've got Oracle, which is a major proxy of OpenAI, and that's cost them, that's hurt their stocks. Their stock's down 33% since their last earnings. And then, of course, you've got Broadcom later this week coming out, and they're very representative of the Google camp, which is, everyone loves Broadcom at the moment, and we still continue to see upside risk there. But on the earnings side for Oracle, I mean, the stock's been beaten up pretty badly, and that's going to help them at earnings. So we expect them to do quite beat on earnings and sales and the various metrics that we look at. And so there's probably some upside risks there, and the market's expecting a 10% move up or down on the day. So big volatile moves. But it's for the rest of the sector, it's all about their commitment towards OpenAI, capex intentions. And again, we're coming down to the financing of their debt and their expansion plans going forward, which I think everyone's going to be looking at.
Chris, as always, appreciate the time, sir. Thank you so much for spending time with us. Chris Weston, their head of research at Pepperstone Group. We're just going into 7 minutes, 30 seconds to the opening bell. Reference rate of the day, bottom of your screen. Let's call it flat. Well, we are calling it flat because that's exactly what we're looking at right now. Inflation numbers are coming through also in about 7 minutes' time. Plenty more ahead. This is The China Show.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Prime Infra is an investor, developer, and operator into socially relevant and sustainable infrastructure across 3 primary market segments: water, sustainable energy, and waste management. We're really about doing the hard stuff, and that is highly regulated market, significant barriers to entry, and the type of infrastructure that renders an essential service. that DNA comes from the owner, and we're built on the DNA to create a very successful company.
We're looking at one specific benchmark today, and that's really, as you can see, and you can see why here, over 5 days, 5.7% on the China Next Index. And early going suggests that we might actually see further upside. We'll see. We'll see what happens with this. Now, the other thing to point out is inflation coming through. I think it's a 2 or 3 year look at inflation plus the forecast median, the low and the high. The high is Goldman Sachs. You have the low end of 0.2. 0.7% is what we're looking for as far as, that's the yellow line on your screens. If we get that, that would take you all the way back to early 2024.
All right, that's the next thing to watch in the next 5 minutes or so. We're also watching some of these weight loss, obesity drugs. Oh, well, we're doing chip stocks first. SMIC and Hua Hong Semi there were slightly to the upside here. There was this FT report talking about China adding some of these domestic AI chips to its official procurement list. Also watching the pharma side of things, as we talked about, right? So particularly when it comes to Shanghai Fosun. So they basically have gone into a collaboration with Pfizer when it came to its weight loss, early stage weight loss drug. There you go. The stock is up some 4% here today. So that's going to be the one thing to watch. Silver and gold, we talk about, silver reaching $60 a ton, or an ounce, I should say, not a ton, for the first time ever. You're seeing some of these silver stocks reacting to that too today.
Yeah, there we go. The other side of that, of course, is the copper trade, which did see some pressure yesterday. Some trading debuts today, and of course, we'll be joined by the CEO of one of these companies, and we will leave you to your best guesses which company we're talking about here. One is doing fantastically well, one is doing decently okay, 4.3% to the upside. So these trading debuts continue to feature into the market story today. Apart from that, we're looking at a flat open, onshore and offshore, also sideways trading on the Chinese currency. The opening bell, 3 minutes away. Right, welcome back. You're watching The China Show. We're counting down to, open up markets and also the release of November inflation numbers, PPI and CPI, and broadly expectations are for an easing of disinflationary pressures to show up in these numbers in about 30 seconds from now.
Yeah, and when you take a look at this, it's incremental, as they say, right? That we might see a little bit of improvement on the numbers side of things. Does it change the big picture at all? And what we're seeing in China, when there are still seems to be price pressures that are very much entrenched in this economy. We're going to get John Jouet to comment about that on the back of these numbers. But this on the back of that Politburo readout that really didn't send sort of urgency when it came to the stimulus side of things as well. But certainly we're focusing on that Central Economic Work Conference that could be happening later on this week as well. So that could be the next thing to watch in terms of policy signals, of course, as we count down to the March meeting as well. That's when you get the government growth targets, budgets, the like there, and more maybe numbers for us to kind of digest. But here's the market open before, of course, those inflation numbers do come out. We talked about we're not doing anything really ahead of the Fed. Of course, markets have been retreating in terms of rate cut expectations there, but there you go. PPI prices, so this is a slight miss there. This is 2.2% in contraction for PPI prices, Dave, for November. CPI prices, that's where you're seeing that incremental improvement, right? 0.7% for consumer prices there. What else has caught your eye? Yeah, so I'm just looking at the range of, let me start, while I bring up the data on my screens, let me just give you context on the CPI numbers at 0.7%. That's clearly bang in line with the median estimate. That's clearly well within range. It's a big improvement, big relatively speaking, from the previous prints. On an absolute basis, 0.7%. Actually, it's actually the highest headline inflation print going back to early of 2024. So that's the improvement side of things. Now, when you look at PPI prices coming in slightly below the median of, so clearly an acceleration relative to estimates of the PPI prices, actually coming in near the low end, but not at the very low end of forecasts of negative 0.2%. So some of the pressures there continue. I would imagine, though, just throwing this forward, just given how commodity prices have traded of late, we might actually see further pressure. Currency trading on the weaker side of things. We'll wait for the data
in terms of what goes into the basket to really get a more informed view of the inflation situation. But just to help us understand on a headline number basis what this means for policy, an initial take, Zhang Zhiwei is with us here, President and Chief Economist at Pinpoint Asset Management. Initial glance, sir, what do you think?
I don't think there's a very big surprise. I think the market kind of expect, the CPI side, there will be some improvement. To a large extent, it's driven by vegetable and food prices rising, and we already know that because we have high-frequency data points. And the focus, I think, in the market now is on the PPI. Whether there will be meaningful improvement on PPI side going into next year. I think the market not really expecting very sharp improvement on PPI in the very short term. But now there's some expectation for the next year, going into particular second half of next year, the PPI deflation might get better on the margin, right? So it might become close to zero. That would already be improvement. So there's a debate on how the PPI outlook will become.
Okay.
And I mean, overall, the data has been mixed, right?
Yeah.
It seems like we're likely going to hit that growth target this year. But then again, you talk about inflation is still sort of, I guess, a slow burn.
Right.
And you have the property market that seems to be reemerging more as a bigger risk.
Yeah.
How are you assessing the broader growth trend now for next year?
Nowadays, if you look at many countries, U.S., China, even Japan, mixed picture all over the place. I mean, in China, you would look at for instance, the AI space, there's a very strong consensus things are going very well, right? So manufacturing sector, there's some positive news coming from there as well. Now, if you look at property, things on the margin still getting worse. And that trend, it seems to be quite persistent. And I think going to next year, what the market kind of waiting for, the investors are waiting for is whether the government will do something in the property sector, given that, the trend has been on the downward trend for a while. So that going into, first half of next year, will the government do something, particularly in Tier 1 city, to keep property price falling? And there are things I think they can do, particularly in Tier 1 city. I understand in Tier 3, Tier 4 city it's very hard. But Tier 1, the imbalance is not that severe. So I think if they do something there, they can make some improvement.
If they are going to do something, it doesn't seem very obvious, though, looking at recent policy pronouncements, right? So I think that the Politburo meeting, the Central Economic Conference, not to say they won't do anything, but it doesn't seem that there's a great amount of obvious urgency for them to act. Now, is that actually a good thing?
I think, again, as Ivan mentioned, right, the GDP growth is on track to reach 5% for this year. And I think, if you roll back 6 months, the number one issue on policymakers' mind is probably about the external environment, the trade war that now is becoming less of a concern. So I think the overall evaluation of the economy seems to be okay. It's not as bad as in the beginning of the year. So the risk has already come down. I think that's probably if you think from a policymaker's perspective, the overall situation seems to be kind of relatively benign compared to the beginning of the year. Now, the property sector has been a drag to the overall economy, but has it been kind of a crisis scenario? Does it cause financial instability? Not really, not at that stage. So it's kind of contained by itself. So,
and in that Politburo readout, there was things that were not mentioned, whether it was the property market. There was also not much mention of anti-involution.
Right.
Is that a signal that maybe the overcapacity concerns are not as bad as what we thought it would be?
I think the anti-involution is still a policy priority. It's not mentioned there. Let's see. We're waiting for this Central Economic Working Conference, which will give a lot more details, right? So I think there probably will be some discussion on that topic. I'm saying this because the PPI deflation is still obviously an issue, right? And it does affect, broadly many aspects of the economy, fiscal revenue. You hear, foreign leaders coming to China to complain about this. So there are many reasons why the government need to address this issue. And there are things they can do. They can, cut overall excessive capacity in some industries. Bank lending to those industries might be, more constrained. So there are things that they probably can push forward.
It's end of the year. it's a good time to look at this. Maybe is the economy improving? Very simple question. Is it in a better place now than it was 12 months ago?
I would say it's weaker compared to the second quarter of this year, right? So this year, the first half of the year, the government support was very strong, fiscal and monetary. So the first half of the year, the economy was doing quite well.
But is that seasonal?
That's
the start of the year?
I wouldn't say, yeah, I mean, the past few years has been seasonal, right? So,
just one.
But, Q4 particularly, we've seen some weakness. I guess the question is whether going into Q1, whether the government will ramp up support again, particularly on infrastructure investment, so we get, marginal growth to stabilize or even rebound a bit. That's the question, right? So the first quarter fiscal support is a key issue to watch.
How important is it that the renminbi stays strong? That in order to actually boost that domestic demand picture now?
Yeah, I do think the renminbi may strengthen even further going into next year. The Fed is going into a rate cut cycle, and China has a huge trade surplus, right? So I think from a fundamental perspective, there is room for renminbi to appreciate against the dollar and even against the basket. It's not a huge appreciation, but on the margin, I think there's definitely more pressure for it to go up. To strengthen against the U.S. dollar. And I think the government, from a policymaker's perspective, they probably go into next year be more tolerant of that idea. That, if the Fed go into rate cut cycle, the dollar maybe weaken a bit, let renminbi appreciate a bit. I think that makes perfect sense.
Yeah, they'll just largely stay out of the way.
Yeah.
Just looking at just rate differentials, I think, to your point.
Right.
What assumptions are you making around the consumption and subsidy story? The trading policies and everything that's supported consumption levels this year.
Consumption has been weak recently. So the question is whether the government will ramp up further support through subsidies. I mean, it's a bit hard because we've been running on subsidies for several years, right? So you cannot buy a car every year. I mean, that's the marginal impact probably will decline. I think the government probably will keep that subsidy going into next year.
Right.
But whether that's enough to keep consumption strong, because the marginal impact is declining, right?
Yeah.
So maybe they need to do something more. And related to that, property sector, because property, people's wealth is in property. If you get a negative wealth effect, you hurt consumption. So that's, I think the pressure is building up for the government to do something on the property sector.
You're in the ground, right? The sense I get when we speak to people here is and risking obviously oversimplifying the Chinese consumer. There's a lot of them, right?
Right.
Is the sense we get is people are not overwhelmingly bullish over prospects, but they're also pretty far away from feeling dire and depressed over the economic outlook. Things seem to be doing okay.
That's right.
And what is there a takeaway for you as far as that's concerned? Like things are just fine.
I think you're right. I think that's a very important point that compared to, say, 3-4 years ago, that you hear a lot of complaints, right? So from social media, there's people seems to be facing these challenges, but they also find ways to deal with these challenges. So it's not a massive social unrest, that kind of scenario, right? So they're certainly
far from it.
Yeah. I mean, there seems to be some of the cities. You go to Shenzhen, you go to Shanghai, you see that on the margin things are improving. That is very open. There are more foreigners coming in.
Yeah.
Activity. I mean, the entrepreneurs becoming more active. You do see that on the ground from bottom up. So. That shows up in the equity market more than in the property market.
Thank you so much. Nice to see you.
Hi.
John Zhiwei there, our President and Chief Economist at Pinpoint Asset Management. Just a glance at benchmarks, and we have tacked on to the downside some of these price moves there. Weakness, clearly, we've shown you that in the currency, maybe reacting to the PPI numbers, the weaker PPI numbers. And we will have a look at some of the silver and gold stocks. That's really on the back of the price moves we've seen in silver too.
It's maybe the tightness that we're seeing in this market, of course, on the back of these Fed cut bets, and really as
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
A lot of them, actually.
Welcome back. Right, let's take a look at this NVIDIA story and this ongoing feature, of course, when it comes to geopolitics and this trade, let's call it trade in terms of the concepts there between the two sides. So we're learning more about why President Trump has greenlit sales of the H200 chip, specifically to China. Sources say it comes down to the strength of the mainland semi ecosystem. Annabelle is here with us to help us unpack that for us. And what else are we hearing? And just what's forced? Is forcing an accurate word?
Yeah,
incentivize the White House to allow this to happen.
No, I mean, it forces a rethink, at least, of your policies. And it comes down to, how you benchmark NVIDIA's progress versus what you're seeing in mainland China and the whole push from the US, like what you see in China. But both want to retain their lead, or China wants to catch up, but the US wants to retain its lead. And when it was making these decisions, what we're understanding from sources is that it was looking at how's NVIDIA going versus what we're seeing from the best in China, and that's Huawei. And so what they did was look at one of the Huawei systems that's essentially a platform known as Cloud Matrix 384 or 384. It's built using the Ascend chip series, which is Huawei's AI chips. And they found that actually when you benchmark the progress or the performance of that system versus what you see from NVIDIA's NVL72, which is built using Blackwell chip architecture, actually the performance was looking pretty similar. And so that made them think, okay, actually Huawei is really catching up here. If we want to try and retain that lead, and we need to then give them more advanced products, because the whole idea is that the Trump administration wants Chinese companies to build using US architecture and infrastructure to try and then also reduce that push to build out that self-reliancy, at least domestically, because still NVIDIA is more advanced, at least by an 18-month window. And the other factor they were looking at for this decision-making was also the production capabilities, because SMIC and Huawei are the two main foundries. SMIC really is the one that can do more advanced nodes than what you can get from Huawei.
Yeah.
But actually, we're hearing as well, and the White House is estimating that they're going to be able to build millions of these AI processors next year, possibly. So that also creates that urgency to act and to shift on the H200 policy.
Yeah, and the FT has some good reporting on just how China is responding, of course, to this news of maybe possibly limiting the amount of H200 chips that do come into China, and other ways to really preserve its domestic chip sector.
Yeah, exactly. Yeah, there's been two different stories from the FT this morning, and they sort of work together quite nicely. But to go to that first one, they're looking at limiting access to H200. One of the ways they're doing that is looking at maybe restricting buyers or purchases of the H200 chips, also maybe saying to companies, you need to justify why you want this H200 versus what you can get domestically. So that's one policy, is to essentially limit companies directly. The other is to continue to build up and to focus on domestic players. And one way they can do that as well, and the FT is saying, is that actually the domestic AI chips have been put on an official procurement list for the first time ever. So now government agencies, or it's a government-approved, essentially, list of suppliers for the likes of Huawei, also Cambricon, but it's another way to push, I guess, and promote that local chip designer or chip ecosystem. So they're two different stories, but I think it also tracks very nicely with what we've had from our Bloomberg intelligence team. And they're sort of saying the same thing here, that this NVIDIA U-turn is coming too late. You've already got names like Baidu, Alibaba, Tencent that are preferencing local chip makers just because the US administration has been flip-flopping too much on its policy.
Yeah, okay. So I wonder what the update tomorrow is going to be. Belle, thank you so much. Annabelle Jewelers there on the latest around tech. Let's have a look at some corporate news that we're tracking this morning. We're watching crypto stocks across markets today, Hong Kong specifically here, as the city seeks public comments on implementing new global rules on reporting digital asset transactions. Now, the Hong Kong government launched a public consultation on Tuesday. Issues include record-keeping requirements and a proposed penalty framework. Now, Chinese regulators are moving to tighten control of the drone industry with mandatory national registrations. State broadcaster CCTV says requirements include real name, registration, and operational identification of civil drones. Now, drones also cannot have flight capabilities before their registration is activated. The new rules will take effect come May. Now, we talked about the story. Pfizer has, past tense, entered into an exclusive collab, as they say these days, and licensing deal for an early-stage weight loss drug with a unit of Shanghai Fosun Pharma. I believe that was the stock you saw bottom of your screen, so we'll get that up again shortly. Under the deal, Yao Pharma will complete an ongoing phase 1 clinical trial of the drug, and the agreement also allows Pfizer to develop, manufacture, and commercialize it worldwide. Now, JP Morgan shares dropped after it flagged $105 billion in expected spending this year. That's close to some people I know. The guidance is higher than the top estimate from analysts surveyed by Bloomberg. Now, JP Morgan's Consumer and Community Bank head, Marian Lake, says that the anticipated cost growth is due to volume and also growth-related expenses, as well as inflation. All right, SpaceX, big one, big deal, potentially, the biggest one, potentially. Bloomberg has learned that the company is moving ahead with plans to go public next year. Now, sources say it aims to raise significantly more than $30 billion in the IPO, targeting a valuation of about $1.5 trillion. Now, the transaction would make it the biggest listing of all time. SpaceX expects to use some of the proceeds to develop space-based data centers. Right, we'll just take a short break. Back on the other side of it, a look at markets right now. We're splitting the difference. We're coming off lows of the day, but still looking at declines now, about 20 minutes into the cash market session.
All right, just recapping that CPI and PPI print as well. I think it was a bit of a mixed picture here, right? When you talk about CPI prices bouncing back in some of the biggest prints that we've seen in over a year, but then PPI prices still very much in contraction.
Yeah, I think the expectation is still PPI slowly gets to the zero level and then crosses into positive next year. The CPI prices, well flagged. I think Zhang Zhiwei mentioned food prices, high frequency data, vegetables, pork prices have indicated we are going to get this, what we got today. So market is reacting to the PPI print, which missed
a little bit more negatively. Yeah. We saw that in the renminbi in particular. Markets are also slightly under pressure here today as well. We've been focusing on sort of some of the key trends that have been kind of driving this equity rally in China,
at the southbound flows now.
Southbound flows, for one part, has been a key driver of that, right? Mainland investors that were definitely buying up a lot of either the tech space and the like earlier this part of the year. You take a look at this chart, though. If we can just fire it up real quick, that starts to be fading a little bit now. So you got to wonder how much more momentum is there around this market, really?
Yeah, and for the longest time, right, this remained really a key pillar of the market. In fact, our markets producer Anthony Stephens really flagged this earlier on. When you look at how on price the benchmarks in Hong Kong remain decent and range bound because of this sort of flow into Hong Kong across the Stock Connect, particularly as we entered the fourth quarter. But as you can see, that softened of late. In fact, right now, it's either zero or flat, which does explain, of course, the weakness coming through on price itself. Now, on the Hang Seng China Index specifically, we're down 0.25%. We did manage to bounce off, but we touched it for the very first time in months, the 200-day moving average, currently at 88.59, and we're trading currently at 89.13. So we're very, very close to that level, just to mention a few things. Okay, a few other things. SK Hynix has been very much in focus this week. That's coming up on your screens. The chip plays, TSMC doing well. Honda is up 3.3%, and I'm about to figure out if I can deduce or guess why we're looking at that to the upside. I'm looking at my
There's an upgrade from Nomura.
To
buy for the stock here. So they're talking about the problems are close to being resolved, according to Nomura here. So this recognition of losses that have been related to the EV collaboration with General Motors that they say is nearly complete. So maybe that's why things are looking better for the stock. Honda's up some 3%. Toyota as well, up some 1%.
Yeah. You know, when a company's problems are well publicized, if there's no need to elaborate on the problems themselves. Quote, problems are close to being resolved. Okay, the 2 trading debuts today. We're down on, live TV. We're up slightly now on 1, and we'll be joined, of course, by the founder, chairman, and CEO, Bao Junwei, at those times on your screens on their business strategy, competition in the industry. If you're curious, they're in the LiDAR industry. Plenty more ahead. This is The China Show.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
All right, welcome back to the China Show. Here's a look at the HSI half hour into the session. And yeah, we bounced out the lows, but we're still, marginally lower here this morning. The inflation numbers that just came out, that was still front and center for investors here this morning. So CPI prices are actually above 0 and 0.7%. The sort of the biggest print or largest print we've seen in terms of CPI in over a year. PPI is where there was that bit of disappointment, where we're still very much in contraction of 2.2%. But, as Mark Cranfield from our MLive team is saying, the market seems to be more focused on the CPI prices, given the fact that they think the interpretation is maybe deflation's in the past and maybe possibly less policy stimulus for next year.
Oh, that's going to be interesting because in a couple of minutes, there might be a different take to that. Yes, we have a guest coming through that they do expect more cuts coming going into next year. Apart from that, and also steeper curve, which we'll get to as well in a moment. Right, so apart from the Hang Seng Index, we're looking at the benchmarks right now, and since about 90 minutes back, we've seen further declines across price. I haven't looked at volumes, but I am willing to bet my very healthy liver that volumes are not there. Today, Asia Pacific down about 1/10 of 1%. We're moving, of course, into a Fed decision where it's, for all intents and purposes, the expectations are for a cut. It's really about next year and what the path looks like. Silver's a big story today. 60, we topped that level, and then we're further above that right now, further 1%. In fact, you look at, for those who don't know, right? So if everyone was focused on gold, but silver's up by more than double. In fact, it's the best performing commodity this year. It's the best year for silver since 1979, 110% on silver. Copper's coming off a little bit, and some of the silver-related names on your screens up 8%. But apart from that, we talked about PPI. Okay, we're done with that. The Vanke story. The meeting, I think, should be starting now.
Yes.
Looking at the agenda, but we're still waiting for more headlines on what the middle ground can be with the bondholders.
10 a.m. local time was what we were expecting here. So we're looking for some sort of vote from holders. They need at least 90% of that vote to clear to actually avoid a default, right? So that's one thing, whether they actually approve this sort of extension plan for that bond payment. We have heard some of our sources saying that they might be willing to give out at least some interest payments.
A little bit of it.
Yeah,
a partial of the coupon.
So we'll see if we get any sort of clarity on that front on what the next 12 months is going to look like for Vanke, but they can actually mitigate and reduce that sort of default risk out there.
Yeah, and this is for the bond that's specifically for December 15.
Yes.
Not to mention the other one, of course, which is later, the 28th, I believe, this month, which is a separate conversation altogether. Right. I'll look at, this is going to make sense in a moment. I'll look at the sovereign yield curve in China. Why we're doing that?
It is a slow day.
It is a slow day. We're not just chucking in random macro themes here and then finding a reason to talk about them. The expectation is for a steeper curve. This is the 2s and 30s. We are anchored, of course, in the short end. A lot of pressure on 30-year futures of late. That's also coming up on your screens very, very shortly. For more importantly, the why. Iris Ouyang, FX and rates reporter, is with us here to take us through what is behind this recent steepening of the yield curve.
Thank you for having me, Yvonne and David. Yeah, the yield gap between China's 30-year and 2-year bonds reached a widest in almost a year. That's partly driven by the rapid rise in the long end because people are concerned about the upcoming mutual fund fees changes, and there's a massive outflows from the fixed income funds. And then on the short end of the curve, there is the rich liquidity boosting the bond yields to remain low. Because the PBOC and Chinese authorities have been saying that they are trying to maintain the abundant liquidity to support the economy into next year. So we are seeing the short tenors are still remain the low yields, and markets are now expecting maybe a likely steeper curve going forward.
Okay. So they think things could actually steepen further from here in terms of the curve? What are they projecting?
Yeah, I think the markets in general are projecting a steeper curve going forward into next year because that's also favored by the Chinese authorities. The PBOC has been stressing that they prefer a steeper curve because that indicates a positive economic outlook, and it also means that the Chinese assets are attractive enough for global investors. But people are expecting the pace could be very gradual because you cannot have a too volatile bond markets, especially after the recent sell-offs.
So the key. So we talked about inflation. That's one key issue. Maybe bond purchases, which has reemerged as another issue to talk about. Among these key themes, what are the things we're tracking in the bond markets next year?
Yeah, of course, this week people are looking for the economic policy, especially when we are having the Central Economic Work Conference coming up. From the Politburo meeting, we're already seeing that authorities, the top policy makers, are trying to maintain the monetary and fiscal policy basically unchanged. So bond investors are looking for example, especially into the two sections, maybe the policy makers will unveil the targets for the GDP and fiscal deficit. You know, recently people are especially looking at the fiscal deficit because whether it will remain unchanged at the 4% level as this year or it will be higher than 4%. There are some rumors already circulating in the markets that impacting the bond prices already. And people are also watching, you know, what will be the size of the bond sales into next year because China will have to lean on the sovereign debt issuance into next year to further boost the economy.
All right, Iris, thank you. Iris Ouyang there, our FX and rates reporter. Let's bring in Angela Cheng now, Head of Research and Chief Macro Strategist at CGS International. Angela, it's great to have you here on the program. In terms of policy, I mean, what's your sort of outlook for next year from China? Because it seems like we're not getting that much urgency from policymakers just based on that Politburo meeting. But what's your expectation?
It's a big week for macro data and policies, right? We just get the CPI and the PPI data. Actually, we got some of the supports maybe going to next year for the CPI because it's the major concern for the investors, right? So the first one major support is the local and the central government's support of service consumption moved to the domestic demand side, right? So this kind of policies we expect like 300 billion trading programs to continue at least to provide a steady support to that going to next year. The second one is that the service consumption, different kinds of scenarios for the consumption, right? So thinking about tourism, the kind of emotional related consumption.
Yes.
Yeah, right. Yeah. That's quite popular recently. And for the third one, thinking about some they called investment in people, right? Enhance the social security and the healthcare, elderly care to enhance people's willingness and capacity to really consume. So by all this supporting like policies, we are confident that next year we are going to see more kind of improvement in terms of the CPI. But I think PPI will just narrow its decline for next year. So our prediction is negative 1.1%. Of PPI year on year.
That's about half.
Still stay in a negative territory, but for CPI about 0.5%.
Positive 0.5, just to be
positive.
Okay,
but a little bit lower than the market.
Needed to be clear about that. Okay, so what room does monetary policy play a major role in supporting the economy? Is it more fiscal? If it is monetary, do you expect more rate cuts, for example, or bond buying? In what form is that going to come?
Nowadays, I think for Chinese economy, fiscal policy and monetary policy should go hand in hand. And for monetary policy, I think it's little room now, but we're still anticipating more like monetary easing next year. We anticipate 1 to 2 times of rate cuts, cumulative like 10 to 20%, 20 basis point next year, right? So it will pull down the LPR and also will translate to the lending and deposit rates among the whole financial system. And also, as you mentioned, the T-bond purchase will be the primary tool for the PBOC to implement this monetary easing, especially after Fed cuts. Right?
Yes, that's right.
Very
this
likely,
week.
this week.
What role do you think the equity market's going to play in terms of really, bringing that wealth effect and getting people to actually, dispose their household income and the like? I mean, do you think that that's going to be a bigger role next year?
Yeah, this is a very clear trend, actually, because if compared to global peers, actually the residents' portfolio, the percentage of actually assets or the percentage are quite lower than the global other countries. So I think from the policymakers' perspective, it's a very clear signal already being sent to the market that equity market should play a bigger role in this economic hold of the system, right? So, and from like the December 6th, the Wu Qing, right, SBRC's chairman, also sent a signal to the domestic leading security firms that we ease the leverage ceiling for that. This is a very clear signal.
Southbound flows have been fading. We were just talking about that
recently.
Where are they going?
What's going on?
What's the preference now for mainland investors?
One concern is about the year-end effect, I think. So they're just to secure their profits this year. For another reason, I think it's more about. I think it's an overtrend with ups and downs, right? So this is it is very temporary pullback. Right. So, but going to next year, we're very optimistic about the southbound.
What's the best opportunity next year, anywhere in Chinese markets?
I can give you some of the feedback from our global investors.
Sure.
For example, the sovereign funds and the insurance companies, long-term funds, right? So, with some of the cautious sentiment still there about the whole macro picture. I think many of the global investors, they're eyeing on China's sector level opportunities. For example, robotics, AI, and also some of the subsector within the consumer discretionary sectors. Right. So, for example, the shows, the tools that we all arranged for them into China are quite popular. Almost all of them are.
What do you guys do on tours? I'm curious. You take them on tours?
Into factories or showrooms or R&D centers to let them really see how fast this technology progress are in China. So really want to get that opportunity, and we can get a sense that the next to China is still China. So this is what they let me know. So,
and we were just talking to a guest yesterday about there still seems to be some downside risk to the Hong Kong market, maybe more downside risk than upside risk.
On an index level,
when you look at risk and reward, maybe it's still the A-share market because you have so many of these growth stories, as you mentioned, as well. Is the preference still for maybe domestic onshore markets then for next year?
I think so for domestic investors, if you compare the domestic equity market with the Hong Kong ones, I think you can still see very good companies here. That's one of the things they really value, right? With the tech or consumer, the sectors, they can find, especially healthcare and otherwise. So find it here in the Hong Kong market. So still attractive with more IPO projects coming, right? So that's one of the very promising sector that we should look at. And for, I think, global investors, now they're viewing the Chinese market, let's conclude mainland China and Hong Kong together, right? They really want to grab this opportunity to take this trend of AI development and grasp that, take that profit actually, to be really involved in this process, not miss this opportunity. So that's why I think both the Chinese companies going abroad and the global investors are looking at the Chinese market. I think this is a two-way kind of interaction, very active. This is what we can feel. I think the sentiment here is highest compared to the past 3 years after COVID.
Yeah.
So this is a very clear signal. Although this progress can be kind of slow with cautious sentiment and with maybe needs more clear picture of the macro data. Right.
In fact, I wanted to ask you about the macro. It's the time of the year we're in between the Politburo meeting, the Central Economic World Conference, and then they map out the Liang Hui, right? The two meetings next year.
Right.
You guys have mapped out 3 scenarios on growth. Optimistic, I think it's coming up. Optimistic is 5.4%. 5.4%.
Pessimistic.
What's base case?
Base case 5%.
Okay, and pessimistic is?
4.5%.
4.5%. Talk to us about 5.4%. What do you think gets us there? And do you think if we get a cyclical recovery in the economy next year, what happens to the AI trade, which has largely been, let's call it, it's largely been agnostic to what the economy's done. It's done very well despite the weak macro.
Right. Let's start with the base case because the 5% is the baseline for the first year of the 15th five-year plan. Right? So it's very important to set a benchmark for the next economy, like 5 years or more. So 5% GDP growth. Let's watch out the National Economic Work Conference this week. See whether it will be kind of adjustment to like 4.5 to 5%. That's this kind of range because they will send some of the signals whether the policymakers will want to both achieve the economic growth as well as the construction of the whole economic system or achieve other goals at the same time. But for the optimistic scenario, 5.4, I think will give more like first about more favorable external environment, right? Fastest more and less like geopolitical concerns, of course. And at the same time, we'll have more like supportive policies internally, right? So both fiscal and monetary policies.
Okay.
Yeah.
And how scared should I be, just very quickly, if we get 4.5%?
So it's maybe the U.S. and China tensions.
That's the underlying assumption. That gets you to 4.5%.
That's a small possibility.
Yeah. Which seems to be not the case, right? We've seen a smoothing of the relations.
Yeah. Just to provide a floor to that projection.
Fantastic. Yeah. Thank you so much. Happy New Year. Let's talk again in the new year. Angela Cheng there, Head of Research and Chief Macro Strategist at CGS International. Right, just ahead here in shows, the world watches as the first teen social media ban takes effect in Oz. We'll have the details of that and how it could influence other.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Global electricity demand is set to surge 75% by 2050. Infrastructure alone won't keep up. To power the future, we must change how energy is used, not just how it's generated. The missing link? Demand-side solutions that unlock efficiency, productivity, and resilience. The Bloomberg New Economy Energy Technology Coalition is uniting industry, innovators, and investors to scale these technologies for a future-ready energy system. Learn more at bloombergneweconomy.com/ntech.
Right, welcome back. So it's been over a year since this restructuring, of course, out of HSBC. So it's interesting here. We'll play it for you in a moment. So the CEO, current CEO, of course, George Elhedery, says it was not enough executives were fully accountable for their performance over their respective businesses before he began that radical restructuring that we're witnessing currently. That was 15 months ago. Now, he was speaking with Francine Lacqua, Leaders with Lacqua, of course, the podcast. And he said that the structural changes need to be made from the very top all the way down. Have a look.
I was definitely ruthless about killing the complexity and the drag in the bank. and I had all my colleagues who wanted to achieve the same. And, we set out to do it. The most difficult part is when you have to separate with some of your colleagues. I think we've been very thoughtful, we've been very considerate, we've done it hopefully the right way and the most respectful way for the benefit ultimately of the firm and its customers. And everybody, that's a guiding principle, is what do the customers want? They want a bank that moves at their pace. They want a bank that moves fast in a fast-moving world, fast-moving customers. We needed to be agile. We needed to be, to be ready for a modern world. And to be that, we needed to be simple. And therefore, everything then drives what decisions you take from that mission statement. The importance for us is to be disciplined about what we want to do, is to be able to do it at pace, but to do it safely. It's always balancing how we do it safely, yet moving at pace and with discipline to deliver what we set out to do.
How did the bank become so complex? And again, this is something that actually most organizations have to face as they grow. I guess there's various factions, or a lot of companies actually could just become much more simple and simplified. What did you see?
Look, I think, back to my engineering days, entropy is a feature. Entropy tends to increase, which means complexity, if you do nothing about it, tends to increase rather than decrease. So things don't become complex by design. They end up becoming complex by lack of focus. So bringing the focus at the simplification will allow you to start dealing with it. That's the first observation. Second observation is you have to be extremely methodical. Again, I'm using a lot of my first principle engineering days, is like you transfer them and go first principles. What has created the complexity? How can it be addressed? Methodically, try to identify ways to be simple. Some of the ways to be simple is to decide not to do certain things, and this is why we exited a number of activities, but to be able to basically build it, if you want, from the bottoms up. The third thing is when you're taking structured decisions, you have to start from the top down. You can't take structured decisions from the bottoms up. Your first principles start from the bottom up. Your structural decisions, your organization decisions have to start from the top down. This is why the first decision structurally I've taken relates to simplifying the group operating committee. We moved from more than 20 people to about 12. More importantly, we moved from 0% single accountability. Everything had dual or multiple accountability, to now about 60% of our revenue is generated under single accountability. So that's important. And then the last thing, Francine, is to be patient, because we're not solving simplification overnight. It's going to be a journey, and we have to be relentless at that journey, quarter after quarter, month after month, until we get the desired outcomes. And that journey is still on, we're not there yet.
And that was the HSBC CEO, Georges El-Hedary, there, speaking exclusively with Bloomberg's Francine Lacroix. Now, in some other corporate news this morning, Microsoft has pledged to invest $17.5 billion over 4 years to help build India's cloud and AI infrastructure. CEO Satya Nadella made the announcement after meeting with Prime Minister Narendra Modi in New Delhi. This marks Microsoft's largest investment ever in Asia, as it targets the world's most populous nation to help fuel growth. And as the AI trade faces growing investor scrutiny, one stock is shining as an anti-AI play, and that's Apple. Its shares were battered earlier this year on concerns about its lack of an AI strategy. But now that hesitance has gone from a weakness to a strength. Apple was the worst performer among the Mag 7 stocks in the first half, but since then, it soared 35%, while AI hyperscalers have slid into the red. Oaktree Capital co-founder Howard Marks says AI has created a, quote, terrifying outlook for employment. He warns that the assumed productivity boom from AI fails to consider how many people will be able to afford the additional goods produced. Marks adds that some firms are piling on aggressive debt as Big Tech spends vast sums in an AI race designed to keep smaller rivals from catching up.
Right. Just look at markets before we take a short break, and we'll unpack what's happening on the CSI 300 in a moment. And as you can see, that's down about 0.9%. Curiously, there's only one sector that's actually pulling that entire thing lower. That's in the IT space. The CSI 300 IT index we're down about 2.5%. Dawning Information, Foxconn Industrial, Luxshare Position are all down over, let's call it 3.5%. In Dawning's case, we're down about 10. More on that after we take a short break. Back in a moment. All right, the IT.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Key index is down as promised. Here's a look at that. We're down about 2.1%. Underneath that hood, specific hood here, you have the four biggest losers. Dawning Tech leading those declines. So it's really a drag on that, and that's itself dragging the entire CSI 300 down. There we go, down about 10% on Dawning Information. Just very quickly to mention Vanke. The meeting, of course, now with the bondholders believe taking place. A pop in one of the bonds on the that's halted because of that. Plenty more ahead.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
.29 a.m. in Tokyo. Japanese markets a hand at lunch break in just a moment here. And we are hearing from the Prime Minister, Takaichi. She's speaking in Parliament here this morning and talking a little bit more about what's going on in the JGB market. Of course, the sell-off and this melt-up in yields that we've been seeing. She says she sees the JGB market as the most stable in the world. And right now, she's not in a position to really assess Ueda's remarks in Diet. You may remember that he just did an interview with the FT talking about he believes that Japan may have reached sustainable 2% inflation. So another step closer possibly to them hiking rates next, a few weeks from now.
Yeah.
Certainly one to watch. Vital to mull the impact of rising yields comprehensively, according to Takaichi. So that certainly is one key focus of when you talk about the fiscal expansion that Japan is currently underway. That is the big concern. How fiscally responsible they can be. And that's probably why the long end is looking pretty sticky these days.
Yeah, I mean, funny word selection on stable. At least it's certainly something that when you look at just the yield, the pop in the yield itself is not something that comes to mind. Anyway, of course, if it's stable, it's stable. I mean, it's stable over a 40-year time horizon. That is just to say, if the BOJ does hike interest rates, and I think just to bring you back to what Citi was telling us a few days ago, every 6 months until 1.5%, and you eventually get to a point where real yields for the very first time in many, many years are back positive at a time when the Fed's cutting interest rates, that's probably not a formula to have a stable bond market, right? But just to say that's going to be a major implication for asset allocators when you have a Japanese market that now has a proper interest rate. Okay, markets are doing this, nothing. I mean, I'm biting my nails, not because I'm nervous, but because I'm bored. And that's just to say we're waiting for the Fed, not so much what they do, but what they say in terms of the guidance into next year.
Asian stocks, U.S. futures, dollar is doing absolutely nothing here.
Yeah, they have been as still to make a portrait out of them. Let's get the artist in and get a sketch of these markets, and I guarantee you they will not move until that portrait is done. But
it's almost, we're just waiting, right?
No.
Hyperventilating, according to Keen
there we go.
over the whole Fed and FOMC decision that comes out later on today. So certainly that's one thing to watch. It gives us time to talk a little bit more about
this is a big
one thing that parents, I think all parents around the world are dealing with right now is really whether to let their teenagers use social media, right? Well, Australia has just become one of the first nations to really test this, right? The social media ban for youths came into effect today. It's a landmark move that really aims to keep those under 16 off certain social media platforms. And children can no longer have their own accounts and firms violating this rule may face fines of up to $33 million. So we're going to break it down by companies that might be impacted, right? The likes of Facebook, Instagram, Snapchat are subject to those new regulations as well. And even some of these Chinese companies, right? We're talking about TikTok and the like, right? So they've all pledged compliance right now. But some firms say the rules have been rushed through and do risk pushing children into more dangerous corners of the internet. Now, the Australian government, though, has now talked about just the impact this could have, right? They're estimating 86% of Australians aged between the ages of 8 to 15 use social media. So that's a big chunk of those preteens and teens here. And the world is closely watching what happens in Australia and whether this move makes any sort of impact, right? You talk about policymakers in Europe, in Indonesia are also looking to rein in big tech, even as the industry sees young users as key to fueling their future growth. But yes, it's not just an Australia story, of course, Dave. I think a lot of parents out there are really kind of focused on whether this is successful or not.
Yeah, as a test case.
Yeah.
And then let's see what other governments do along generally the same lines. Perfect opportunity to really get into the story today. Let's bring in our team. Our tech reporter, Newly Purnell, is with us here on set. Joining us too from Tokyo is Catherine Thorbeck, our Bloomberg Opinion columnist. Newly, let me start with you. Yvonne just set us up quite nicely on the sort of size and scope of this, but just how will this be enforced is the question now.
It's a good point, and it's something that people who have opposed the ban have pointed out. They say, how in the world are you going to enforce this? They say kids always find a way to get around rules like this. So far, we're not seeing any big technical snafus. None of the services are reporting any big issues. They are using a variety of means, everything from video selfies to the ability for young users to upload IDs if they have them. And I think what's really interesting, though, in the global context is, as Yvonne alluded to, the onus is on the tech companies. I think it's very interesting to put this in the global context. There's been a lot said about how responsible they might be for some of these social ills, and Australia is saying it's on you, tech companies. And so today's the day kids are getting shut out.
Catherine, you've been writing about this. Do you think the social media ban is it going to work?
So I think that's the big question. There was a poll in a local broadcaster that came out ahead of this ban that said 3/4 of 9 to 15-year-olds had no plans to stop using social media once the ban kicked in. And ahead of the ban, there were also videos going viral of sort of workarounds and teens encouraging each other to go to sort of more obscure apps. And so it really does raise the question of, what could go wrong if teens start congregating, a bunch of underage users start congregating on even less regulated corners of the internet. So I think, teens are very tech savvy, and if they really have a will, if they really want to continue to use social media, I think it's likely that they'll find a way.
Yeah, Catherine, I guess as a follow-up there, there's certainly a lot of criticism. There's criticism on both sides, just to be fair. But in terms of the biggest worries and concerns over this new legislation, just talk us through and elaborate more along those lines. What have you seen against this one?
Sure. So there's some valid privacy concerns that have been raised. There's also concerns that this will especially impact sort of more vulnerable teens and LGBTQ youth and sort of rural or indigenous teens. But I think one of the most interesting things actually came from the American Psychological Association, which really studies this. And they came out and said that hardline age limits aren't effective. They don't work at keeping children safe online. They sort of ignore individual differences in maturity levels. And I think most importantly, they don't address the underlying problems here. There's ways to sort of regulate social media without just sort of cutting off people that are 15 years old. And so I think that these psychologists, these researchers are really saying that we need to get to the root problem here. And I think that's something that's really interesting. But I do think that Australia is actually doing something, which is really more than can be said for a lot of other jurisdictions. So I'm rooting for this now that it's here.
I'm rooting for it too, really, Newly. In terms of the tech companies, how have they responded and what's the threat for them?
Yeah, it shouldn't come as a surprise. They hate this. They have been very vocal since the law passed at the end of last year that they think it's a mistake. They think it's not enforceable. As Catherine mentioned, they think it's going to push people to less safe parts of the internet. And they think that, yes, that it's going to be harder on young users who feel marginalized. To go back just briefly to the issue of enforcement, I would just say quickly, the Australian Prime Minister has pointed out, well, look, we have rules that say you have to be a certain age to consume alcohol or cigarettes, and every weekend or however you want to measure it, people get around those rules. We need to set this as a norm for our society to give parents the ability to say, look, it's against the law. We as a society have decided that these platforms can't be trusted. They're not safe enough for kids under 16. So, yeah, big tech doesn't like it. They have pointed out in all of our reporting to us, we have robust safety measures. And interestingly, in responding, some have even expanded them to other parts of the world.
Yeah, well, a question for both of you. Newly, I'll ask it first, and Catherine, I'll toss to you next. But Newly, I mean, you've written a lot about who might take Australia's lead, right? Who follows after this? Talk to us a little bit more about that.
It's been one of the really interesting things in our reporting. Angus Whitley in Sydney and I and others have been reporting on this around the world. And in the interim, after the law was passed end of last year and then coming into the months now that it's come into force, we sat down, for example, with a senior policymaker in Denmark who said, we are really inspired by Australia and we want to do this for kids under 15. Indonesia has been talking about it. Malaysia, Brazil, various European countries. And interestingly, they have pointed to Australia and saying, look, they're breaking new ground. We like what they're doing and we want to see if we can do something similar.
And Catherine?
Right. As Newly mentioned, the world is watching, and I think that's a good thing. It really does put Silicon Valley on notice. And I think one big takeaway from all of this is that the status quo is really not tenable. We don't need another sort of devastated parent coming out and speaking about, a child lost to a mental health struggle or some harm that stemmed from social media. So I think that that's definitely a good thing.
All right. Team, thank you so much. Very interesting discussion there. That was Catherine Thorbeck, our Bloomberg opinion columnist. Also, our thanks to Newly Purnell, our tech reporter, on really talking about the impact this could have. And certainly, of course, we're all watching, right, and rooting for it to see whether it works. Coming up, though, we're going to talk a bit more about, we're going to switch from social media to maybe more on the tech side of things here. Talk about LiDAR technology. Why not? We're talking to the maker, Seon, as the stock makes its debut in Hong Kong today. The firm's founder and CEO, Junwei Bao, joins us next. It's a de-SPAC, so we'll talk a little bit more about that. But there you go. Take a look at how the pricing is today. Looks like it's a pretty good day for Seon here. We'll talk about the competition, what they're seeing in the LiDAR space, the EV space in particular. These are, of course, the invisible airbags, as Hillside's David Lee has always coined them as well. So lots to talk about coming up next. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
In some corporate news this morning, Hong Kong's market watchdog and stock exchange admonished investment banks working on IPOs over filing shoddy and incomplete applications. In a letter sent to IPO sponsors, officials noted a decline in the quality of recent listing applications. Officials are raising concerns amid blistering recovery in Hong Kong listings. SK Hynix, meanwhile, says it's considering a potential listing on the U.S. stock market using treasury shares. And the move could close the valuation gap between the South Korean chipmaker and U.S. peers, including Micron. Korean media reported earlier that SK Hynix had received proposals from several investment banks to list roughly 17.4 million shares in the U.S.
All right, let's stay on theme. And one of the trading debuts today here in Hong Kong, Seon, we're doing well. I think 61%. First day of trade, we're trading at 17 right now. Of course, it's a company, Neo Supplier, Chinese LiDAR maker here, has listed here in Hong Kong via a de-SPAC transaction. Joining us now here on set is the founder, the chairman, and the CEO, all in one person, if that wasn't obvious, Dr. Bao, Junwei Bao. Very nice to see you and good morning. Congratulations, by the way.
Thank you. Nice meeting you.
Milestone for the company this week.
Yep.
What now? What happens now?
Next is, now finally, the three major LiDAR companies in the world for OEM car makers, Xi'an, Hesan, Robosan, we are all getting public listed in Hong Kong market. Yeah. It's a great time.
What will you be doing with the proceeds? What's going to be the next priorities then for you?
Yeah, as we listed in the circular, we'll be spending most of the proceeds we collected here on R&D. Okay, LiDAR still a highly competitive market products and a lot of new technology involvement, and we need to keep investing in R&D side, keep adopting new technologies, and so that we can meet our customers, keep chasing of the higher performance LiDARs.
Yeah, and we'll talk about the pursuit of OEMs a bit later on. But for our global viewers who want to understand what the industry dynamics are, the competitive dynamics within China, how would you describe competition?
First thing is highly competitive. Great thing is the OEMs are very, very aggressive and innovative, adopting new technologies.
Okay.
They view LiDAR as one of the key differentiators for them to stand out in tough competitive markets here. And in fact, also, LiDAR is offering a great value to help the cars to be able to see, quote unquote, the world around it, in a more clear way and in more diverse environments.
This coming at a time when the industry is going through a bit of a slowdown. I mean, I talk about the auto industry, where you see when it comes to car sales and the last 2 months have seen a softness because these subsidies are starting to phase out.
Yeah.
How does Sion adapt to this kind of slowdown in the industry? How are you navigating around that?
Yeah, the general, new EV market, new energy market is slowing down. However, the adoption of LiDARs actually is speeding up. Seeing the market size, we're seeing over 1 million LiDARs being shipped last year, and this year is well over 2 million units. Okay. And next year will be much more. This is partly because of the industry's trend in China, especially. People are seeing LiDAR and advanced driver assistance system, ADAS system is getting more and more recognized as very valuable. This definitely, was kind of part of it promoted by the leading EV makers like NIO, XPeng, and the Li Auto and Huawei system. Huawei's many kind of car brands as well. And consumers are getting better and better recognizing the value of LiDARs in the ADAS system.
Yeah, Dr. Ba, I wanted to bring back one of your peers, David Lee from Hesai. We have him on quite frequently, and he talked about, LiDAR is not just about being a car part or part of the car industry, but there's more about whether it can be applied in all sorts of sectors. I want to kind of listen in first on what he had to say.
Sure.
Company. We're actually a LiDAR company, and we build LiDARs for all different industries. For example, if you think about the other topic, which is robotics, when we talk about robotics, it's a completely different industry with very different ecosystems, but they share the platform technologies of the LiDAR from the ADAS, which we are super good at the quality, at performance, and the cost. So then we apply that to really many industries: the robo-taxis, the robo-truck, last mile deliveries, lawnmowers, and service robot, the cleaning robots.
So it's not just about cars, right? He mentioned, you could have one car, but you could have multiple robots. In your life. How does Sion then benefit from this surge, right? Whether it's humanoid robots or all sorts of technologies that are kind of emerging in China now.
I would say I pretty much agree with what he's looking into, expanding LiDAR's application into many other industries. In that direction, we are pretty well aligned on the next phase of growth. Beyond what he's saying, we're also seeing LiDAR can have a lot of great applications in the infrastructure. Okay, we're seeing LiDAR can be, have a lot of being adopted widely, including both inside China and in other parts of the world, in US and Europe as well, for intelligent transportation systems, for security, civilian security, and also, if you can think of the generalized defined physical AI, means, we see LiDAR as a key connecting point, connecting the digital world with the physical space. Digital world is people are training the models in what they are imagining, trying to make the world better, try to understand the world in a digital way. However, it needs to be corrected or calibrated with what's happening in the real world. And we are seeing LiDAR, because of its good 3D sensing capability, as a very key channel or connecting point, connecting these two worlds.
You mentioned earlier, and I think this is important for people to realize, the OEMs are, just as an example of potential applications, right, are very open to new technologies, right? So even if there is a cyclical slowdown, the industry is growing because it's just being used in more things. Are you seeing well, I guess I want to understand whether or not you're seeing a difference between Chinese OEMs and foreign OEMs? You mentioned you want to expand abroad in their appetite to embrace new technology, or is it more just still a Chinese player story?
I would say, in the old days, maybe like 5 to 10 years ago, when the global OEMs are still in the leading edge for autonomous driving, they were more or less analyzing the LiDAR's value or usage in a more like a forward development. Means they are analyzing to make LiDAR useful for level 2, especially for level 3 systems. You need certain performance specs. And in addition to the LiDAR itself, because LiDAR cannot show its value unless it coupled together with other part of technical stack, like the software part, like the compute part. So they want to have the whole system ready before they can really widely adopt LiDARs. Well, for the Chinese OEMs, they are more aggressive. Like many of our key customers are competitive key customers like NIO, Li Auto, Xiaomi, and so on. They try to adopt LiDAR, install the hardware on a certain generation of vehicles even before the software is ready, and they are counting on the OTA to upgrade the software to get more functions in the system. And over the time, I think the Western OEMs, in Europe, in US, and in other countries as well, they are trying to learn from this part as well, but they are still trying to carefully to manage, to monitor, is that good way or not? But we are seeing they are try to learn to some extent how the Chinese OEM are doing now.
Yvonne and I were joking yesterday about how having a fridge in the car, because I think someone has a fridge in her car. And the reason I bring that up is, in the case of LiDAR, for example, the new features in cars. Do you think we're getting close to a point where Chinese consumers will demand that any car they buy will have LiDAR technology? Are we close to almost 100% penetration at some point?
I think we are not far from that.
Okay.
Yeah, because once people are seeing more and more value of the LiDAR that can offer to the consumers, to the user of the cars, then they will ask for it. And somewhere down the road, you will see LiDAR will be like a seat belt, like an airbag, as an essential component of the cars.
Yes.
Yeah. You mentioned about global expansion. Tell us a bit more. Where can you increase capacity, and what are some of the plans that you have set in stone?
Yeah, on one hand, as I mentioned, as more global OEMs adopting LiDARs, and naturally we'll try to service them, provide product to them. In addition, like we talk about, LiDARs, many other applications in the industry, like for infrastructure, for industrial applications, for those kind of applications, then we are seeing, because Xeon is maybe a little bit unique compared to other LiDAR makers, where we are maybe the only player that have footprint in both China and in the US. We actually started in the US back in 2016, and we still have to core R&Ds, leading edge, R&Ds, and also supporting our customers using from our office in Sunnyvale, California. And with that, then, I think we can know customer better and give customer more in-time support and better support to the domestic customers over there.
Are you looking to invest more in the U.S. in any way?
Yeah, that's part of the proceeds we plan to expand as well. And try to build up, a better support team, commercial team to expand to the U.S. market and expand our adoption for LiDARs to our customers over there.
Okay. Dr. Bao, it's great to have you.
Fantastic.
Junwei Bao there, founder and chairman and CEO of Xeon Holdings. Now, if you are a subscriber and want to rewatch that interview, you can watch it through our interactive TV function, TV Go. You can also become part of the conversation by sending us instant messages. Check it out at TV Go.
Right. Some of the A shares we're looking at, retail stocks specifically, limit up, as you can see in at least the case of these three here. This government push to boost demand, that's really something to watch, not just today, right? It will be a sort of features going into not just next year, beyond that, given it is, of course, boosting consumption, is a major feature of the current next year 5-year plan there.
Yep, that's one thing to watch there. The retail sector, consumption, and then we got to talk about drones, right? I think CCTV had some interesting reports here talking about how China is looking to tighten its drone control when it comes to, you have to register. So that's really one thing to watch here. But you are seeing some of these drone stocks are actually doing quite well.
Yeah, it's not just flying a kite, right? Get the necessary permits and licenses. Okay, The Vanke story. One of the bonds is moving up right now. It halted because it had moved to the upside. But this is a story that we keep giving.
It will, and we're looking to see if we can get any sort of indication of where creditors are when it comes to this sort of bond extension that they're seeking, and whether we get that 90% approval. That's the number to watch here this afternoon.
Day for the Fed. The room to substantially lower rates. A Bloomberg report earlier stated that Hassett is the front runner in President Trump's search for the next Fed chair.
Jay Powell has done the right thing, which is he's taken the far left people of the board and he's coalesced them around, it looks like, a rate cut, which is the right move right now. I might like a bigger one, but I think that that's what the Fed chair has to do. Don't forget, you're managing a committee. And so getting rates down right now, it's a good thing. There's a lot more room to go.
And here's a closer look at China's latest inflation report. Consumer price growth accelerated to the fastest in over a year in November, even as deflationary pressures remained widespread. For more insights, let's bring in Bloomberg economist David Chu. And David, when you take a look at PPI, falling for the 38th straight month, you got to be worried about this economy.
Yes, definitely, because if you look at the profitability of the industrial sector, you will see that it is highly correlated with the PPI. Well, when the government helped the CPI side using the anti-involution approaches, the divergence between the CPI and the PPI actually is more concerning for me, because it means that the producers, they cannot, make more profit because of the limit of output. So that putting everything together, yes, I think that the deflation or disinflation is still a great pressure to the U.S. economy, to the China economy.
David, isn't it true that the PPI headlines don't even tell you the real extent of that slowdown?
Well, we cannot say what the real slowdown is, because the CPI or the PPI is not so correlated with the production side. But all in all, we think that if the disinflation or deflation pressure continues, it will weigh on the production side, because if the producers cannot make money, they will have to choose another strategy.
David, overall, this shows how, there is a broad slowdown that is gripping China. What measures do you think China will take to address the weakness?
Well, people are, including me, people are looking at the upcoming Central Economic Working Conference that is going to be held maybe this week. So people are eager to see what the government is going to do for next year. But for me, I think one thing is for sure that the government needed to boost the domestic consumption. That is because of the background of the challenge in the trade sector, and also the slowing and the drop in the investment side. So that you need something to boost the total demand. That is the hope. The consumption is the hope. Otherwise, if you have a strong production but a weak demand, that means one day you will see the loss of profitability of the corporates, and then it will limit the production side and slow down the economy. So putting all the things together, I think boost the domestic consumption will be one of the priorities that the government needs to do.
And that remains to be seen. David, thank you so much for that. Bloomberg economist David Chu there. Now, China Vanke meeting with bondholders today to discuss a proposal to delay payment on the 2 billion yuan bond note due December 15th. For more, let's bring in China credit reporter Trista Sinyilo. Trista, what is anticipated? How might this proposal look like?
Yeah, so in today's meeting, bondholders will discuss three proposals. The first one is actually proposed by Vanke, and they are asking to delay the yuan bond payment for 12 months without any upfront cash or any installments. And there are another two, which are offering more generous terms, asking Vanke to pay interest on time and also offer some credit enhancement. So in today's meeting, bondholders will review those proposals, and they will have until Friday to vote.
What is the likelihood that Vanke will get the votes it needs?
Yeah, so, any proposed change will need over 90% support from the creditors. So Vanke right now is, asking for one more push to win more support from creditors. There have been a lot of ongoing discussion even before today's meeting. During the weekend, there was a meeting held in Beijing, and then yesterday, Vanke's representative actually reached out to some creditors saying we can pay some interest, but they didn't specify how much. So there's still a question mark there, and we really need to wait and see the final result coming from this, today's meeting and also the voting. So I think overall, any discussion ongoing right now is still just buying time for Vanke. And moving forward, I think investors are largely expected that there will be a restructuring coming ahead.
Well, Vanke has been given a lifeline before. What are the chances we could see that again?
I think investors are not expecting any more further strong support from the government or from Shenzhen Metro, its largest shareholder. I think right now it's more like relying on Vanke itself, and also they're seeking support from the bondholder to help them to get through this, difficult time. I don't think investors are thinking more big support gonna coming from the government side. So I think right now they are actually relying on the current proposal, help them to cut debt and help them to relieve the liquidity strains and to avoid the immediate default.
And Trista, of course, lots of implications for the property sector as a whole. What are you hearing? Is sentiment turning, much worse than before?
I don't see any positive sentiment already pick up there. So that's also one of the reasons why Vanke will, going through such a difficult time right now, because Vanke could see its sales actually plunge 40% of this year. So, so that's the fundamental question about why those developers still suffering a lot nowadays. And right now is actually the time which bondholder need to reassess the proposal and try to make a decision right now.
Trista, great insights. Thank you so much for that. China credit reporter Krista Sinyi-Law there. Still ahead, JP Morgan Asset Management discusses the Fed's rate path as markets look ahead to its last rate decision.
Our ultimate goal was to turn the fridge from a storage box to a smart kitchen manager that helps the users.
That comes down to finding the optimal location for our camera.
I am most proud of our image matching algorithm. The entire user experience has to be fast and seamless. When it worked like we expected, it was really a breakthrough.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
The good news is that the Fed is cutting from a place of strength. They're not reducing interest rates in order to stave off a nearly inevitable recession, but rather simply just trying to bring down what is currently a restrictive policy down to something that's more neutral. And historically speaking, when you've had a central bank cutting interest rates after an extended pause, that's typically been very bullish for both the economy and markets going forward.
Yeah, I don't think we're going to see any changes to the dots. I don't think we're going to see any changes to the statement at SEPs. I think Powell will basically come out and say, that they're open-minded towards moderate rate cuts if they're needed, but obviously the barriers to do so are much higher these days. We're going to see the formal end to the recalibration phase.
Some of our guests sharing their insights on the upcoming Fed decision. Well, my next guest expects the Fed to cut rates by 25 basis points this week and sees 2 additional cuts by the middle of next year. Marcella Chow is global market strategist at JP Morgan Asset Management. Marcella, good to have you with us. Even as you're pricing in 2 rate cuts next year, it is pretty much data dependent. You can't be so sure.
Indeed. Right now, we believe that during the meeting tomorrow, most likely Chairman Powell is going to highlight is going to be a meeting-by-meeting approach. In terms of what the market should pay attention to, most likely will be about the summary of economic projections. We expect that the inflation forecast might be downgraded a little, but overall it should be remain broadly unchanged. And then the dot plot should also be roughly similar to last time. But I think what market will pay attention most likely will be to what the risk assessment going forward will be, whether it will be more balanced. And if it's more balanced, it might set the tone to the market that is a more hawkish tilt. And given what the job labor market report that we got from Jokes last overnight, that was slightly better than expected, that might suggest that it's a hawkish market tilt, that there might need to be more further job labor or job market weaknesses to warrant further rate cuts going forward.
I just want to point it out there that the rate cuts we're anticipating is pretty unusual. Usually the Fed cut rates when growth is slow, when inflation is low. Not the situation right now. So the dot plot becomes much more important this time round. I'm just wondering, what assumptions are you making, given that we have a Fed that's pretty divided on what needs to be done in terms of the path going forward?
Indeed. It's pretty divided since the previous few meetings, and so going forward it will still be the case. But it seems like right now it's a risk management move, and they are focusing more on the labor market weakness from recent few data points. And yes, overnight we got a slightly better than expected number, but still we do not expect that to change the sentiment for tonight's meeting. And also going forward, I think the labor market weakness, once after this data vacuum that we have more clarity, then like you said just now, it will still be meeting by meeting and more focusing on the labor market weakness to ensure that the growth momentum can be sustained in 2026.
Where do you see Fed funds by the end of 2026? Bearing in mind, of course, Trump wants, the long end of the curve to be much, much lower from here.
Right now, we're expecting 2 more after tomorrow, probably 2 more 25 basis point cuts before by middle of 2026. But it will also having to depend on, for example, because we right now expecting that 2026, the first half of the year, might be boosted by, for example, a temporary boost from tax rebates and also higher disposable income. That might actually cause an inflation to remain sticky. So that suggests that going forward, this will still depend on the data, but then it will still be an easing bias to expect the rate to reach the neutral level around 3% by mid-2026 next year.
What's key right now is actually the long end of the curve. 30-year yields expected to rise to above 5% and perhaps stay above 5%. What's your take on that?
Right, definitely going forward with the Fed chairman or election process still in progress, the focus will still be there, and also because of the fiscal deficit or the independence remains in question with regards to Fed. But then actually recently we see that this was mostly happening in the first or in the second or third quarter. Since we arrived to the fourth quarter, market focus was also remaining on more the dual mandate of inflation actually seems to be weaker than expected, but the labor market remains weaker than market expectation. That's why the Fed is focusing more on maintaining this dual mandate and ensuring the growth momentum to sustain, and that they're doing the cut. And going forward, we still expect that the first half of this year, they will still try to maintain this easing bias, but then the pace and the magnitude will very much depend on if we expect that the market data coming in is actually stronger than expected, they may actually do less or slower. But then if it's actually weaker than expected, they may do more, but then it's still prone to an easing tilt or easing bias.
Marcella, as we look at 2026, some say perhaps we might just see a tale of two halves, a stronger first half and a weaker second. What's your take on that, and how would you deploy capital, assuming that is what we will see next year?
Yes, indeed. So we do think, given the current earnings momentum and economic growth still relatively resilient, that should actually sustain for the first half of this year. Of 2026, and that will actually be constructive on equities and similar to what has happened throughout 2025. But then as the fiscal support wanes and also probably with inflation numbers remaining quite sticky and persist, the second half of this year, we actually advise investors in 2026 to move to or shift to a more balanced stock bond portfolio, and also maybe reach out and look out for alternative income generating assets. But then in terms of the global market momentum, we see that it's going to still be constructive for risk assets general, as we are still in a rate cutting cycle, and also most probably will still be led by AI, and also in US and also broadening out to Asia Pacific.
Which sectors do you see the best opportunities? Do we still play the AI theme in 2026 in as big a way as we did in 2025?
Yes, for AI, we remain quite constructive on, for example, AI data center and also computing power. But yes, like you said, in difference to 2025, I think there will be more divergence going forward. So identifying or being active in company selection remains key. And also, there will be more questions about or debates about AI overinvestment. And also going forward, the key will be the ones that can actually overcome all the supply constraints or supply bottlenecks. For example, electricity supply for the ongoing explosive demand for data center. Those that can actually overcome the supply bottlenecks will likely differentiate and yield a better return going forward in 2026. And also, as we were alluding to with two halves in the second half of 2026, when we actually see investor sentiment gradually shifted to a bit more sour, other than shifting to a more balanced stock bond allocation, probably also into a higher quality and defensive portfolio with more focus onto the defensive sectors like financials and energy and utilities. Those will be probably more applicable for the second half of the year.
Marcella, I just want to draw your attention to the allocation for AI plays. There's always this debate between the US and other markets, including the likes of China as well as Korea and Japan. What distinction are you making, and what kind of allocation are you considering?
Indeed. I think the U.S. AI will continue to focus on the U.S. innovation, but we see that China has actually been developing its own self-sustaining ecosystem, given its policy support and strong supply chain and also research. And so this one will, going forward in 2026, AI will probably be one of the key growth drivers within Asia, bringing in probably even even more better return for hardware like Korea and in Taiwan. But then I think going forward in 2026, what investors need to identify is not just looking for the innovators, but also focusing on the enablers in, for example, in industrials and utility sectors, and also the adopters, in financials or healthcare, suggesting that is a broadening out for AI industry development, even across the sectors. And in recent earnings call in China, we've seen that they've highlighted how it's not just benefiting technology companies, but it's actually a key core part of all the business strategies and operations across various sectors. So this will be key for 2026. And as broadening out that we've also called for action in 2025, remain in 2026, but broadening out within AI will be what the key focus will be for 2026. So it might not be what we're expecting broadening out across all sectors, but a narrow broadening out within AI developers, and also finding hardware, hyperscalers, and also AI developers, and also the emerging application providers, with a focus of also the end demand and also the monetization.
We're getting a clearer picture of China's economic situation. Today, we see deflationary pressures continuing for 38 months. We have Vanke, raising concerns about the property sector. Are you assessing these risks when you talk about, investing in a market like China for 2026?
Indeed. We see that the trend earnings per share growth has been trending down because of, like you said, the deteriorating GDP and also the ongoing deflationary pressures. But yes, property sector is one of the key pain points, but and one of the disappointing side where we did not actually see a lot of announcements or support related to that in the Politburo meeting. So the focus will be next on the Central Economic Work Conference, where the numeric targets will be discussed and probably be announced in next March 2026. But other than that, given how the property market recovery was more muted than expected, we actually have been searching for other growth drivers. For example, the ongoing anti-inflation campaign would actually be helping to lift profit margins and also restore the pricing power for those over-competed sectors. And secondly, we have actually seen a lot of household allocation into both onshore and offshore equities. So going forward, those will also be quite encouraging profit drivers for China markets.
Right. Marcella, thank you so much for that. Marcella Chow, Global Market Strategist at JP Morgan Asset Management. Still to come, Australia's social media ban for youth comes into effect today, a landmark move that's drawn global attention.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
At Virginia Housing, our mission is to help Virginians attain quality, affordable housing. We're one of the top housing finance agencies across the United States. Having a partner like Wells Fargo that is consistent, that we can rely upon, is so important, and it enables us to try and test things that some organizations frankly can't do. Together, we're serving the community. We're serving businesses when they want to come to the Commonwealth. We're serving the future of Virginia.
This reform will change lives for Australian kids and allowing them to just have their childhood. For Australian parents, enabling them to have greater peace of mind. But also for the global community who are looking at Australia and saying, well, if Australia can do it, why can't we? This will make an enormous difference. It is one of the biggest social and cultural changes that our nation has faced. It's a profound reform which will continue to reverberate around the world in coming months to assist not just this generation but generations to come.
Australian Prime Minister Anthony Albanese speaking about his government's social media ban for youth. It's a landmark move that aims to keep those under 16 off certain social media platforms. Children can no longer have their own accounts, and firms violating the rule face fines of up to $33 million. Companies including Facebook, Instagram and Snapchat are subject to the new regulations. They've all pledged compliance, but some firms say the rules have been rushed through and risk pushing children into more dangerous corners of the internet. The Australian government estimates 86% of the children in the country aged 8 to 15 use social media. The world is closely watching Australia's move. Policymakers in Europe and Indonesia are also looking to rein in big tech, even as the industry sees young users as key to fueling future growth. For more, let's bring in Bloomberg's tech reporter, Newly Purnell, and opinion columnist Catherine Thorbeck. Let's start with you, Newly. I mean, so many questions, right? What's been banned? How is it being enforced? And how do you actually ensure what age you are online? How do you verify?
Right, Haslinda, right. All of those platforms you just mentioned are banned, and there's 10 in all, including some of the most popular ones among young people. So TikTok, Instagram, even some that are not thought by many people often to be social media platforms like YouTube, controversially is included. YouTube's not happy about that. The tech platforms say that they have always had strong safety mechanisms in place, but they're now rolling out new features like the ability to submit video selfies or upload ID documents. So far, not seeing a huge number of issues, but we did see, as of yesterday, some younger users taking to other platforms like TikTok and saying that they disapproved of this, and we're also seeing some adoption of some other apps that aren't included in the ban. But a really significant global move here from Australia and really putting the onus on tech firms. They're saying, you got to do a better job. We don't want our kids under 16 on your services anymore.
Catherine, we know why this is being done. The question really is whether it will work. I mean, we've talked about how kids can go underground. This could be unregulated space for them, which is even worse.
That's right, Haslinda. And, you know, there was a poll that came out in a local broadcaster ahead of this ban, which said that 75% of 9 to 15-year-olds had no plans to stop using social media just because the ban took effect. And we know how tech-savvy young people are. They're always finding sort of workarounds to this. And another thing we sort of observed was that teens were sort of encouraging each other to congregate on more obscure apps. And it really raises the question of what could go wrong when swarms of underage users are going to even less regulated corners of the internet. So I think there's a lot of big question marks hanging over this at the moment.
What are the biggest concerns when it comes to this legislation? What's been brought up?
So I think there's some valid privacy concerns. There's also concerns that this will have a bigger impact on sort of marginalized teens, whether that's rural or indigenous youth who really rely on social media for community. But a big thing that I've been following is that the American Psychological Association actually does not recommend hardline age limits. They say that they're not effective at keeping teens safe online. And the reason for that is interesting. It's because it doesn't address sort of the underlying problems of the problems that emerge from these platforms. So they might keep some 15-year-olds safe, but then they just throw them into this sort of burning building as soon as they turn 16. So I think that there are other ways to sort of regulate big tech. But now that this, ban has come into effect, as I mentioned earlier, I'm really rooting for it. I really do think it's putting Silicon Valley on notice.
It is about child protection. It's also about freedom of expression, Newly. I mean, you got to wonder, what the tech companies would do. How will they respond? What's a threat to them? Can we quantify that?
Right. Well, Australia is obviously not an enormous market in terms of overall population, but there are probably, the Australian government estimates, around 1 million or more people who will be affected, young people who will be affected about this. What's been unusual in my time covering tech policy issues like this is oftentimes governments will talk about issues or new regulations, and the tech firms don't really say much because they don't want to, draw more attention to the issue usually. This one's a bit different. Since the law passed last year, the tech firms have been very vocal, saying that, as we mentioned earlier, it seemed like the legislation was rushed through. They say they have robust safety mechanisms already in place. Some of the other issues that Catherine mentioned, but they've been very vocal about that and have really only begrudgingly, late in the game, said they'll comply. The global perspective, I would just say, analysts we talk to say no companies really want to be regulated if they don't have to. And what the issue for the big tech firms is that the young users are the ones who provide future growth. These companies make money off of advertising revenue. They depend on users on their platforms in the years to come. And perhaps if young people in Australia, if they put off joining, maybe they might not join at all. Or maybe it will become the social norm. Maybe it will be uncool to be on social media. So they want to stop this, and they don't want to see these rules spreading around the world. And they just say they're misguided.
And Yuli, as Catherine said earlier, other countries are looking at it very closely. Indonesia, case in point, it's not the only one. Several other countries, perhaps even Singapore, is looking at it.
Right. In our reporting, one of the interesting things that we have brought to light is that since the law passed last year, you have an increasing number of governments saying we are taking inspiration from Australia. They're showing it can be done, and we want to follow suit. So we spoke with a senior policymaker in Denmark who said she finds what Australia is doing to be admirable. We know that Indonesia is talking about similar rules. Brazil, a huge market, a huge and young market. And then in Singapore, they have said that they are talking to their counterparts in Australia about age assurance measures, could take different forms. But yeah, we very much see that lots of countries, including these big developing markets that have huge pools of younger users, are talking about similar rules.
And Catherine, you're quite open about, agreeing with the move. I'm just wondering, what implications are there for the kids out there, right, in terms of digital literacy skills that could impede, that could perhaps limit how they grow in this space?
Right. So I think that we definitely need to have more robust sort of online digital literacy sort of courses. And we definitely need to talk to kids, caregivers and guardians definitely need to talk to kids more about, what they're doing online and really open that sort of conversation up. I don't necessarily think those have to be mutually exclusive with tighter age limits. I think one thing we have learned over the past few years is that really the status quo is untenable. We've heard so many really heartbreaking and devastating cases from parents of harms linked to social media. So I think it's good that Australia is doing something. And, what I've written about is that that's more than can be said for Washington, which really hasn't passed a comprehensive online child safety regulation in decades.
It'll be interesting how the other countries respond to it. Thank you so much for that. Bloomberg's tech reporter, Newly Purnell, and opinion columnist Catherine Thorbeck there for us. Still to come, how delays in a trade deal with the U.S. is putting India's economy under pressure.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Welcome back. You're watching Inside. We have headlines on the back of the tensions between Cambodia and Thailand. We have Cambodia now saying that Thailand dropped 2 bombs via the F-16s on Wednesday. We heard earlier, of course, from the Thai Ministry of Defense spokesperson Surasan Kongssiri, briefing reporters saying that Thai military operations are still ongoing there. Over 400,000 Thais have fled that border conflict areas, according to the spokesman, and that Thai military operations are still ongoing at this point in time. As you know, clashes have raged for a third day along the roughly 800-kilometer border, with the Cambodian Defense Ministry claiming that Thai shells killed 2 civilians overnight, raising the death toll to 6. And we see that tension ongoing as we speak right now. And we're also hearing from President Trump, who claimed victory when it came to that peace deal that he struck between the two sides. He's now saying that he'll call on Thailand as well as Cambodia over the renewed conflict. President Trump, of course, took credit for the peace deal, which was struck just several weeks ago when he was on his Asia tour. Again, we're seeing a resurgence of tensions between Thailand and Cambodia. Now, back to the markets. We're looking at Indian markets just ahead of the open. This is how it's looking as we count down to the Fed decision, which is impacting markets pretty much across Asia. We're seeing the Nifty futures currently flat, 25,916. The Sensex under pressure, down about 0.1%. The rupee, though, remains front and center, whether or not we're going to see further intervention and support from the RBI. Now, Bloomberg Economics says India's economy is set to lose momentum through early 2026 as delays on a U.S. trade deal choke exports, pressure the rupee, and spur capital outflows. Let's bring in Bloomberg senior India economist Abhishek Gupta. Abhishek, how are Trump tariffs affecting the Indian economy, and how's that shaping your views on the economy?
Thanks. So what's really happening this time around is slightly different when we've seen pressure on the rupee historically. Currently, you are in a situation where high growth is also contributing to higher imports, be it gold imports, some of which is also due to speculative investment, but also non-oil and non-gold imports are rising steadily. Part of it is also due to India's tax cuts, which is boosting consumption. Typically, whenever this happens, you have inflows on the capital account to balance the current account trade deficit. But this time around, because of Trump tariffs, you are seeing a situation where you are also seeing outflows on the capital account. So I think the situation should be manageable for another few months in the short term if an India-US trade deal comes through maybe by the end of this year or by early next year, even in 1Q 2026. But if things get delayed further, I think this external headwind situation could soon turn into a crisis situation, and that could really slow down growth further going forward.
Abhishek, do stick around. Let's get more insights with Pranjul Bandari, Chief India Economist and Strategist at HSBC. Pranjul, do you share that view that India's economy is poised to slow down in 2026? It's all dependent on the trade deal with the U.S.
Well, I think that's one of the factors. I do think that in the first quarter of 2026, there are several reasons why India's economy could lose some growth momentum. We've already seen exports to the US slowing, falling 10% year on year. Some of the boost from GST tax cuts are now starting to come off a little bit. And then we had a lot of fiscal expenditure, both by center and states, which was done upfront, which could slow in the first quarter of 2026. So my sense is, yes, growth could slow a little bit. But I also have a base case view that hopefully by March, we'll get a trade deal done, which will not just be good for exports, but also for sentiments. And then, towards the middle of the year, things could start to bounce back up again.
So what's the reason for the unusually strong GDP numbers which we saw recently in India?
Well, look, it was a very strong number of 8.2%. I think they were both sort of, cyclical tailwinds. We've had great rains. We've had both monetary and fiscal policy easing. We've had the GST tax cuts, and all of that played a big role in boosting consumption. But then there was also a statistical issue part of it as well. Our sense is that there are a couple of deflator issues, and once we try to quantify it, the growth which came out as 8.2% is more like 7% on the ground. Now, 7% is also a strong number, but our sense is growth wasn't ever as strong as 8.2%. I do think that this deflator exaggeration will continue until March. So for the full year, which we call FY26, we could get official numbers for the year averaging 7.7% GDP, but the real growth on the ground could be more like 6.7%, 1 percentage point lower, which, by the way, is also fairly strong growth performance.
Abhishek, how do you think the RBI is assessing the growth projection for India? It has a dual mandate of growth as well as inflation benign.
Yes, so if you look at RBI's December policy, they have revised up their GDP growth projection for the full year to 7.3% from 6.8%. But that's not forward-looking. Most of this growth increment is already in the rearview mirror. Growth in the first half of the fiscal 2026 averaged about 8%, and RBI's own assessment is that it's going to slow down to about 6.8% in the second half of the fiscal year. We think it could we're slightly more optimistic than the RBI in terms of the growth numbers for the second half, but still we also see a sharp slowdown to 7.2% over October to March from the first half in fiscal 2026. In terms of inflation, RBI has been revising downwards its inflation projections ever since February last year. It's made 5 downward revisions on the trot, and now it's forecasting 2% inflation for full fiscal 2026. Its inflation projections going forward continue to remain elevated. It's projecting 3.8 and 3.9% in 1Q and 2Q of fiscal year 2027. We sense that inflation will continue to undershoot RBI's forecast, largely because food prices would continue to remain contained. You've seen bumper rains last year, and this year again you've had good rains, and that should prompt good food supplies to last through the end of the agricultural year in June 2026. So all of that means that food prices aren't likely to rebound sort of as sharply as the RBI is expecting them to. Our own forecast is that overall headline inflation would remain contained at 3.2% in fiscal 2027 as well. There is a big risk to these projections. In February of next year, the government would be undertaking a major revision of inflation and growth series, and how that kind of changes the numbers is unknown. Our sense is that inflation could be revised downwards, and while the level of GDP is likely to be revised up, it's difficult to say what would happen to the growth trend numbers over the last few quarters.
Pranjul, given all the uncertainties out there in 2026, what would it mean for the Indian rupee, currently down about 8% versus the USD? Might there be a reversal of fortune? And what might that take?
Well, yeah, that's a great question. And I think the fact that the rupee is weakening, and on a real effective exchange rate basis, it's weakened 10 to 12% already. I think that's a good thing, because what it does is that it's the perfect medicine at a time we've got such a big tariff problem, a 50% tariff. Now, the tariff reduces the competitiveness of India's exports, but the rupee depreciation raises it back up. And in fact, it's very, very positive for services sector and services exports a lot more than it's for goods. So my sense is the fact that we're allowing the currency to depreciate could over time actually increase the competitiveness of India's exports. And, the exports could rise back up, the current account deficit could stabilize, hopefully over time. Inflows could come back if, exports are good, growth is good. And my sense is that there could be some auto correction. In fact, if you actually just plot the rupee in a real effective exchange rate basis over 10 years, you'll find that it always mean reverts. Once it's weakened weakened a lot, then there is an automatic stabilization. Your exports become competitive again, and your external balances improve, and your rupee bounces back. So the fact that we are allowing the currency to depreciate at this point of time, I think, is the right strategy. Generally, we get scared about rupee depreciation from the angle of inflation, but this time around, my sense is that inflation will remain quite low for quite long. In fact, we too believe that it's going to remain below the RBI's 4% target for at least the next 2 years. Our sense is that the drivers of disinflation this time are a lot more sticky. For example, exported disinflation from China is also playing an important role, which we think is not going away anytime soon. So on the back of that, allowing the currency to depreciate will not really add to too much headline inflation at this point of time. And from that perspective too, we can allow the currency to really correct, so to act as an automatic stabilizer and a shock absorber at a time we've been slapped with such a high tariff from the US.
But Abhishek, the question is if the RBI wants to put a floor to the rupee weakness, can it do that when some of the factors that have been cited are actually external factors like the trade deal?
RBI does have a very good chest of FX reserves. It's almost nearing $700 billion. It has lost a bit of reserves. Our estimate is it has lost about $35 billion or so since in July or mid-July. But then it has also recouped some of those reserves because of revaluation gains. Gold prices have continued to rise, which has also kind of stabilized RBI's overall FX reserves. Going forward, I think the RBI will continue to have this firepower to defend the rupee, but not for too long. So just like Pranjul, we also expect a U.S. trade deal to sort of culminate by the end of March 2026. But if there are delays beyond that, and that could be a big risk, because then this external headwind situation could soon turn into a crisis situation, because if India's growth continues to be steady and imports continue to remain high, the high trade deficit could continue to pressure down the rupee, in which case RBI can't just continue to sell FX reserves. At that point in time, speculation could also kind of build against the rupee, and RBI would find it difficult to maintain an orderly sort of weakness in the rupee.
Right. And Pranjul, it's all relative, isn't it? When you talk about rupee weakness, it's not as weak as other currencies like the yen and the yuan. I'm just wondering how competitive Indian exports can be when compared to Chinese exports, given where its own currency is right now.
Well, I think, when we compare India's exports to other economies, I think we need to understand that India is a little different in the sense that about 50% of its exports are actually services and not goods. And what impacts services can be very different from what impacts goods. And at this point, my sense is that the fact that it is sort of creating a name in this whole outsourcing of professional services exports and all of that is basically allowing exports to remain strong despite all of the bad news on the tariff front, and the fact that we are allowing the currency to depreciate. The real has depreciated by 10% this year. That also is very positive for services exports going forward. So I think all of this is something that is sort of unique to India. A final point I wanted to say that a lot of exports is changing in nature now. We used to think about goods exports and services exports, but now we have a lot more hybrid goods where India is a leader. So I think India does have its space to grow despite all of the tariff uncertainty around us.
Pranjul, great stuff. Pranjul Bandari of HSBC and Bloomberg senior India economist. Abhishek Gupta, very quickly, let's do a check on Indian Indigo stock. India's asked Indigo to cut 10% of its flight routes to help stabilize the airline's operations and reduce cancellations. It is extending its flight to about 1.5.
Indonesia holds 40% of the world's geothermal potential, but has tapped just 9% of its reserves. It's like an inexhaustible battery that never gets plugged in. Geothermal delivers clean power 24/7. It's essential as Indonesia strives to realize its net zero ambitions. Barito Renewables is unlocking these resources with continued investment. Soon it will pass 1 gigawatt of capacity, helping anchor Indonesia's clean energy future.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Welcome back. You're watching Inside. We're tracking Indian stocks. They've been trading for 15 minutes now. They've been under pressure on the back of uncertainties to do with that trade deal with the U.S. The Sensex, though, now inching upwards, up 0.2%, a positive tone in the market, though. Keep a watch on those small cap stocks. They've sharply trailed their larger peers, dealing a big blow to retail investors who have been the backer of the stock market in India. Again, the Sensex in positive territory. It is a positive sentiment pretty much across the board in India. The Indian rupee in focus currently, it is down 0.1%, continuing to slide versus the USD close to record lows. 89.97 is that level we are looking at right now. Now, the latest IPO in India begins trading at 1:30. SoftBank-backed online marketplace, Meesho, raised about $603 million in a public offering that was more than 79 times subscribed. It is the latest in a flurry of Indian companies rushing to capture booming investor demand for new shares. Meesho plans to deploy listing proceeds to penetrate smaller towns in India. And staying in India's consumer space, food delivery firm Swiggy has launched a new share offering for institutional investors just a year after its market debut. It's aiming to raise $1.1 billion as India's rapid commerce market expands and competition ramps up. Like Meesho, Swiggy is competing against Amazon and Walmart to build dense networks of warehouses and delivery fleets capable of fulfilling orders within minutes. Now, the move comes as the stock price has reverted to near its IPO price. And we're also keeping an eye on Lenskart, which recently went public. The company's shares are up slightly since debuting last November. Lenskart is an Indian multinational eyewear company with over 2,500 global stores. It holds a majority stake in Japan's Owndays and Spain's Mela, and recently partnered with Pop Mart to launch a Labubu-themed eyewear collection. Joining us exclusively, Peyush Bansal, co-CEO, or rather founder of Lenskart. Good to have you with us to talk about the outlook for the company. First off, that tie-up with Labubu, Pop Mart, I mean, what is the strategic thinking when it comes to that partnership?
Firstly, thank you for inviting me to Bloomberg TV. Well, I think consumers are now bored of what they have been wearing, the same kind of eyewear. They want more excitement, and Pop Mart has been creating the next generation of wave in terms of excitement, and a partnership like that brings more authenticity, touches upon nodes which are beyond just utility, and the product is looking beautiful. I just checked it out at a Lenskart store yesterday, and the best is yet to come.
And the thing is, you have now become part of the pop culture, so to speak. How big a market is that? I mean, what are you looking at? Who are you targeting? And what numbers are out there in terms of, projections and ambitions?
See, overall, if you look at eyewear, has been a very underpenetrated category. If you just few decades back, shoes used to be like that. We used to have a black shoes and a brown shoes, and at best a running shoe. And today, I don't think both of us would know how many pairs of shoes we own right now, and when we walk into a store online or offline, we check out one more, and if we like one, we pick it up. I think eyewear will go through the same level of transition. It's just that it requires work in terms of design, innovation, and then when you hit those trigger points with customers and you make it affordable and accessible, we see similar patterns. industry average of eyewear has been traditionally about one pair every 2 years, which now moved to about 1.8, and Lenskart it's almost about 4 pairs every 2 years, and that I think is something that we see growing further, and I think particularly with the growing myopia rates in all parts of the world, in Southeast Asia, where we are, almost 8 out of 10 people need glasses today, and why not wear fashionable, good-looking glasses since we anyways have to wear them.
How much of a boost would this partnership with PopMart provide?
See, it's difficult to give a number, but all of our growth is pegged on consumer choice right now, and because it's a non-discretionary purchase. I mean, I wasn't planning to buy a pair of eyewear, and now I suddenly bought another pair of eyewear. So if you look at Lenskart, which has been growing, H1 grew about 25%. A large part of that growth comes from people buying more and more.
So this could just be the start of further collaborations if you're talking about, setting fashion trends and so on and so forth.
Oh, absolutely.
What are you looking at? 12, 24 months? Are we looking at more collaborations?
Many more.
What would make sense?
So we are partners with Disney, Marvel. We have done collections from Dragon Ball to Harry Potter, 3rd year in a row, the Batman collection, which is really popular here, Superman. We did Pokemon. We are tied up with designers in India, which is Masaba. And with PopMart, this is just one character. And we are looking forward to doing many more characters coming forward. So I would say in the next 24 months, we want to just blow it out even more and have more fun with eyewear. And people also want to have more fun with eyewear.
What kind of growth are you anticipating? You have a global footprint. It's not just in India, although I think right now revenue, in terms of international revenue, it accounts for 40%. Yes. Do you see that being ramped up?
See, overall, I think both markets are growing. I mean, if we look at H1, both markets are growing at roughly about 25% odd, and we see that continuing. Lenskart as a business, we are trying to build a global relevant brand. We started first in Singapore and then expanded into Japan, other parts of Southeast Asia and Middle East. And a big part of that relevance creation in the local markets comes through design and innovation. So I think it's tough to predict right now how this will pan out, but I see both markets growing north of 20% healthy.
And the risk to that, perhaps, given that, perhaps people are anticipating a slowdown in the economy, that would hit consumption.
See, eyewear is very underpenetrated. I mean, if you look at the number of eye tests, we did just in the first half, we did about 10.7 million eye tests. We did 9 million eye tests approximately in whole of FY24. So this has been compounding at more than 50%. And most importantly, the number that matters is almost half of these eye tests are people who never got their eye tested before. I mean, Singapore, you're very well aware, every child here gets myopic, almost large part. I mean, I was reading some stats, 83% people get myopic in Singapore by the age of 18. And, at Lenskart, we are creating the market. We are making eyewear reach people who would never get it before. In Singapore, we sell 2 kids' glasses for as low as $50.
And we know eyewear has gone tech. And you've talked about how AI, AR are crucial to your growth projection. Talk to us about how you're incorporating all of that. What can be anticipated? You're wearing a high-tech glasses right now.
Yes. So I think, look, it's the next computing platform. The way I see it, there was laptop, and there came the mobile, which was a very good extension. It didn't make laptops go away, but it did make a lot of things move to the laptop, like browsing and consumption. And now with this, eyewear becoming a computing platform, which I'm very positive about, a lot of stuff that we do on the mobile will move here. One of them is being payments. So one of the things we have integrated in our new eyewear, which is coming, is that you'll be able to scan QR codes. No need to pick up the phone, enter a PIN, scan, and do all of that. Photos, which is now heavily used on mobile, I think will move here today. I was just at Gardens by the Bay on Sunday with my son, and I could just look up in the sky and record the whole beautiful scene. So I think a lot of that would move. I think a lot of logging food, getting information of the context. So it is going to be a big computing platform. The other area where I think tech would be heavily involved in style, as we just spoke about. I mean, we just launched an AI platform on our app where you could just sit in front of the mobile phone and it knows your face shape, it knows the clothes you're wearing, and it could recommend this is what you should be wearing for your interview today. right? And that I see a lot of power. And then, of course, accessibility, like we have seen in e-commerce, it has been missing in eyewear, but at Lenskart, we have been building a fully vertically integrated stack all the way from manufacturing to retail, which we have not seen in custom manufacturing categories.
So what kind of investments are you putting into AI, AR, R&D within the company? And, what kind of returns are you anticipating on the back of that?
See, at Lenskart, if you look at the overall thesis that the company has is investment into talent and technology. And eyewear has been deprived of that. It's difficult to say where are we putting, because everything is becoming AI today, all the way from our supply chain integration. So let me give you an example. Today we do eye tests in Mumbai, but the optometrist is not sitting in Mumbai. They are sitting in Kolkata, and they are doing an an eye test in Mumbai, where optometrists are difficult to find. One of the biggest problems that Asia is facing is where we have about 35, 40 opticians/optometrists for 1 million people. That's just not going to be enough. And so what we are working towards is, can we bring AI to do self-eye tests, which is already under pilot right now in a lot of locations. Can we move eye testing to mobile phone, which is a pretty powerful camera? So that's one area to bring access into the ecosystem. Second is, can we do this in a centralized way? Because doing it in a locally distributed way is not scalable. It's very, very expensive. So we today in our factory ship glasses in more than 60 cities next day. So, you place an order at 9 p.m. In Singapore, we just launched a 2-hour service for you to get products. So I think there's a lot of tech involved there. And then, in the styling angle, which, one undermines, but I think that is where, we don't buy mobile phone today for talking on the phone. We buy it because the camera keeps getting better, and then you need the next version. So I think that element is very, very important.
So it does seem like you don't buy eyewear now for seeing things. It's also for taking pictures and so on and so forth. You have become a tech company, essentially. I mean, what is the strategy going forward? I mean, how will the company look like in 5 years, for instance?
I mean, I won't say we have become. I believe we started as a tech company. None of us are really from an eyewear background. If you look at except one of the co-founders, most of us were working in the tech domain before. And we today, if you look at majority of our payroll cost, we have more than 500 engineers developing solutions from selection to choice to affordability to accessibility to now smart eyewear to the next version coming where there will be waveguides. So in the next 5 years, I think Lenskart transforming from a eyewear company, tech-enabled eyewear company to a tech eyewear and data company. Because what you're capturing in this device right now is all going to get into the Lenskart platform. And we are building it full stack, all the way from hardware, firmware, software. So when you log your food from a B glasses, we call these B, and I say, okay, hey B, tell me, should I be eating this today? That information is traveling into the Lenskart app. That makes me understand the consumer better. If you're getting bored today, you want to chat, okay, hey B, I'm getting bored, can we chat? Just like a counselor or just like a friend, that information. And that tells us a lot more about consumers, and that builds a subscription ecosystem in the future.
So you become a one-stop shop. Is that the end goal?
I mean,
providing all the services. And I'm also wondering right now, as you look to the future, who do you view as your competitors? Who are you competing with globally?
So first question first. I think the way I look at it is that eyewear can play a very large role in transforming your quality of life. And we have seen that with many other categories, but this being right in front on your face, and the more it can do for you, and that's why our tagline is do more, be more. I mean, and our mission is transform the way people see and experience the world. So it clearly fits in what we have been trying to do. And our competition, to be honest, is people habits, right? If you look at today,
no, I mean companies. Who are you competing with for market share?
I mean, it is difficult to say because our approach at doing this is very different, and we are not really in any sense trying to just consolidate the market. We are creating the market. I mean, I just told you that more than 45% of the eye tests we did are people who never did eye tests. The people who are wearing glasses, many would have never worn glasses if we didn't create some of those solutions. I mean, we're delivering glasses next day, same day, and that creates demand. So I'm not able to put right now a pen on an eyewear. To be honest, we do not have, especially in this part of the world, players which have been able to organize it and push the bar on customer experience every day.
What are you most excited about? What are we not seeing today that you think you will create in due time?
See, one thing which we are not seeing today is just the size of the market. Right? I think often people go at market numbers. I think while they are large, they are often understated. I think what we are not seeing is that there's a market creation under the carpet which is happening. Just to give you an example, we used to deliver glasses in 7 days, became 4 days, 3 days. Now we deliver glasses next day, and now maybe even same day. Now what that is doing is it is creating a market which never existed before, and I think a lot of people are not seeing that. Second, I think just the multiplicity which we are seeing, that people are not going to wear one pair of glasses, and I think we have seen the journey from 1 to 4 every 2 years. I won't be surprised, and I'm quite confident, I would say, on the other hand, of this 4 becoming many folds more in the times to come, which I think it's difficult for us to anticipate, but we could not guess that about shoes at any point in time. And this is even more powerful from where it sits, and in a digital Zoom world where only this part of the face is visible. And third, I would say, is just the computing angle. I think this is the next computing platform. This is with camera, but very soon the next version will have waveguides, so I can look at you and I can get a little bit of snippet, I can do translations. That, I think, is going to happen faster than what people are imagining.
I just have one final question. You IPO recently, valuing the company at about $8 billion. Do you think $8 billion reflects the kind of value you will bring in the years to come, or should you be valued higher than that?
Well, you know, as far as value, look, IPO is not a destination, right? It's a beginning of a journey in many ways, and it's a milestone. And we have been here for about 14 years now. I think we stay committed to building at Lenskart. Even after serving 25 million odd pairs, we only have scratched the surface. We own like 5% market share. So there's a lot for us to do. And myopia is a problem that remains under-addressed right now. Even in a market like Southeast Asia, there are no solutions that exist right now, and there's a lot more ahead of us. And I think valuations are a function of growth.
That's not answering my question. So you think you should be valued higher than that?
I'm not saying whether we are. I think it's not. We are not working for a valuation just on the IPO, right? We have to work hard, and at the end of the day, it's the numbers that will speak, and the investors will value on our performance, and that's what we've been doing in the first 2 quarters of this year.
Piyush, thank you so much for popping by. Piyush Bansal, co-founder and CEO at Lenskart. Still to come, Microsoft pledges to invest almost $18 billion into AI and cloud computing in India over 4 years. More details just ahead. Keep it here with us. This is Bloomberg.
This feels like a big get for JP Morgan and a big loss for Berkshire Hathaway.
And overall, we've seen Todd on their board for a while, so it's a close relationship that he's had with JP Morgan, and indeed Berkshire Hathaway are doing a lot of changes, aren't they? The CFO is changing. They're having just a new
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Todd Combs going to be coming in and be heading up really the investment strategy, but he's going to be sort of the right-hand person to Jamie Dimon, going to be there at the table, giving him strategic advice. But then it's where does the money get allocated?
Welcome back. You're watching Inside. Oaktree Capital co-founder Howard Marks says AI has created a terrifying outlook for employment. He warns that the assumed productivity boom for AI fails to consider how many people will be able to afford the additional goods produced. Marks adds that some firms are piling on aggressive debt as big tech spends vast sums in an AI race designed to keep smaller rivals from catching up. Now let's stay with that topic of big tech spending on AI, because Microsoft is looking to pour nearly $18 billion into India over the next 4 years. Our Asia Tech correspondent Annabelle Drulis is with us. And Belle, this announcement comes as CEO Satya Nadella is in India. What do we know?
Now, we have a lot of AI deals.
Yeah, it's a really major announcement that Microsoft has made for its ambitions around the India market in particular. So he had a meeting, Satya Nadella, with the Prime Minister Narendra Modi, and in that meeting meeting or around that meeting, he made this big announcement that Microsoft is planning to spend $17.5 billion on the country. So you've got this tweet or this, social media post on X essentially, but talking about this commitment, it's the largest ever that has been in Asia, but looking at a few different areas. So scale, skills, and sovereignty. That's what they're saying. It's these three pillars, and that very much aligns with Narendra Modi's mission to build out a broad AI ecosystem across the country. So, yes, that is the latest from Microsoft. In terms of where this sits with other investments, I mean, Satya Nadella, he's someone who's actually born in India, but has made several trips, and the latest one being in January to the country, where they also pledged a $3 billion investment. So $17.5 billion builds on that investment, and it just really shows as well how Microsoft is, or rather India is increasingly drawing the attention of a lot of different AI power brokers, because you've got this visit here from Satya Nadella, but it also follows, for instance, the Anthropic co-founder visiting back in October, and as well we're expecting NVIDIA's Jensen Huang, also Google DeepMind executive, also to visit in the coming months.
Thanks very much, Anurag Rana there talking to us about the IBM
And
deal.
speaking of Jensen Huang, Val, we're getting details on why President Trump has pivoted on NVIDIA's H200 chips. What's the story here?
For Warner Brothers Discovery.
Yeah, this is some great reporting from our colleagues over in the US. But what we understand is it's really around the competition that the Trump administration sees, and it's the competition between NVIDIA and also the chip leader in China, and that's Huawei. And so what we understand is that the Trump administration looked at a similar or comparable AI system from Huawei to one of NVIDIA's. So they looked at the Cloud Matrix 384 from Huawei, and they looked at the NVL72 from NVIDIA. So one is built on the Ascend AI chips, that's Huawei's lineup. The other one's built on Blackwell architecture, and what they found, these two systems actually have pretty similar performance, and so that obviously caused some shockwaves, because the US is sort of banking on it having technological supremacy. Huawei seems to be catching up, and that added a sense of urgency to why they made that pivot.
To 23%.
Yeah, Bell, thanks so much for that. Annabelle Jewelers in Hong Kong. Meantime, HSBC CEO Georges El-Hadri is ramping up the integration of generative AI into the lender's operations. Speaking on the new Leaders with Francine Lacroix podcast series, El-Hadri discussed the technology's impact on productivity.
All right, coming up, traders
we now
are
rolled
rotating
to
out of the concentrated AI
170,000 of our colleagues internal productivity tools that can materially improve their capabilities of reading documents, reading emails, writing documents, emails, querying, challenging.
The dream.
Process. 170,000 of our employees. Soon all the way to the 200,000+ employees. But for the moment, that's in the rollout phase. We've already reached 170,000. Of course, I will be monitoring usage. I'll be monitoring super usage. Those will be the most, kind of influencing among their colleagues to drive the utilization. But utilization is not optional, because that's how people remain very relevant in the future workforce 5 years down the road. But we're using Gen AI in wealth. We're using Gen AI in markets. We're using Gen AI in contact centers, we're using Gen AI, of course, in technology. Now 30,000 of our technologists, engineers are enabled Gen AI. The speed at which we're able to patch for, say, code weaknesses or kind of vulnerabilities is 10 times faster already now with coding assistance than it was the case last year. 10 times. And we're not talking
in 12 months.
In 12 months. We're not talking some productivity in 5 years. We're talking productivity already here. We're already 10 times faster at identifying and patching some of these vulnerabilities in our code. This is hugely transformational. So you can imagine how important it is. Now I go back to the first part of your question, Francine, is what are the skills that are needed for banks? I would say there is no one particular skill that's going to be critical, but it is going to be the ability to learn. Because you can come in the bank coming from an engineering background, from a technology background, from an accounting background, from a finance and economics background. You can even come into a bank somewhat from a different field than directly related to banking. But once you're in the bank,
of the market cap
your
of the
career,
world
the
stock
customer's
market.
expectation
So it's hard to
are
recommend
such that you're going to have to
overweight in
continue
something
smart.
that's already
And if you
quite
think you know
overweight.
it
I mean,
all,
if you
then there is no
told
place
people just to
for
maintain
those,
the current
you know,
weight of the
in
index,
an
that would
evolving
still be an
landscape.
overweight position
It's very
relative
important to continuously
to
be
what
ready to learn
most
and
people
put
would
in
think
the
would be a
hours and the
diversified
effort
portfolio.
to learn something new,
Ed
a new
Yardeni
skill,
on
an
his
additional
new
skill.
call. Let's discuss
Today,
it
the
with macro
most important
strategist
learning
Michael Ball.
capability
So, Michael, two
is how
parts to
to
it. One
best
is like,
embrace
it's
Gen
working
AI
so well
and
that
innovation
it's
in
dangerous,
general.
which I don't know about that one. And then the second one is that all the other companies in the
Coming
S&P
up,
500
our
are
exclusive
essentially
with Barclays
becoming
Bank
tech companies,
India's
so they should do
CEO
better.
Pramod
Do you buy
Kumar
either of those
on the
arguments
lender's
for
strategy
reasons
and
to
outlook for
98.97?
deals
Yeah, I mean,
in
I guess
India.
two
Keep
things
it here
here.
with us.
And how long you're going to be patient to see the shareholder returns. That now is sort of settled down as we've come off of this sort of choppiness that we saw back then.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Growth for AI CapEx has now become a little better with the Amazon and Google developments, giving alternative chips, alternative avenues with less energy intensity. And I think as you guys covered well for a while there, that was really a physical constraint on this growth and this valuation story.
Welcome back. You're watching Insights. We're keeping an eye on shares of Indian e-commerce platform Meesho as it makes its trading debut in Mumbai. The SoftBank-backed firm raised $603 million in its initial public offering that was fully subscribed on the first day of book building. Today's listing is closely watched as a gauge of investor appetite after a string of blockbuster tech IPOs. Take a look at that, 50% on the upside. For more on Meesho, let's bring in Bloomberg News' Ashutosh Joshi in Mumbai. Ashutosh, it is a test for the appetite in India's IPO.
This though to like the gin mill or word processor.
Thanks, Aslinda. Thanks for having me on the show.
Excel, right?
IPOs in India are already seeing yet another blockbuster year. Last year, India raised about $21 billion through new listings. This year, with 3 weeks to go, already this benchmark has been broken. So 2 consecutive years of records in India. A bulk of it is coming from demand from domestic investors as well as foreigners who are selling in the secondary market have participated in the primary market issuances. Technology-backed IPOs have been a big theme this year. We saw shares of urban company Lenskart doing well upon their debuts, and in the same line we are expecting strong appetite for Meesho's shares as well.
College or grad school grads, but it matters.
All eyes on Meesho because half of the IPOs in India so far have done pretty badly. This might change sentiment somewhat.
There's the actual crypto, which
wasn't
is the
that debate
blockchain.
settled in the office versus out of the office?
But do you have
Out of 90 odd IPOs, those listed on main board indexes, about 30% are under the water, trading below their IPO prices. But at the same time, we have seen some of IPOs such as Urban Ether Energy doing exceedingly well. Their shares have doubled on the trading debut itself and have continued to hold the gains. We can see the investor appetite for technology-backed companies, especially companies which started as a startup and then went on for debuting on exchanges. There is a special interest among investors for these companies, even though some of them might have been loss-making at the stage of listing, but investors are hopeful that these companies provide a longer growth opportunity, and some of them can also change the existing supply lines in the market and expand their presence. So there is investor interest for these names.
As you said, it is a loss-making company, but the focus is on its growth potential. What kind of growth potential are we anticipating?
Some of startups like Lenskart as well as Urban, we have seen their business models were able to expand rapidly, backed by their technology support. These companies also have expanded their businesses quickly because they were able to source and manage their supply chains efficiently. Same is the case with Meesho, which broadly focuses on a segment that some of its larger peers may not, and hence there is traction, especially in the rural parts of India, for services or the products that are available on Meesho's. Some of the most selling items on Meesho's platforms are dresses. Those are valued at as cheap as $1.04.
To Instacart. I mean,
that's kind of lame.
Yeah. Ashutosh, thank you so much for that. Ashutosh Joshi in Mumbai.
I wanted to
now joining us exclusively is Pramod Kumar, India's CEO and Vice Chair of Investment Banking APAC at Barclays Bank. Pramod, good to have you with us. First off, just to get your insights on what's happening in the IPO market in India, it seems pretty hard. We have
two consecutive years of very strong IPO market. Many of these companies offer very high growth. They've been held by private equity venture capital investors. They're catering to a very large market opportunity. And domestic institutional investors and retail investors continue to invest in these companies because of massive growth that they offer, right? So despite, I would say, relatively weaker sentiments or interest from the global institutions, the domestic institution and retail investors continue to invest. And I do expect that sort of trend to continue as we head into 2026 as well.
Is there reason to be concerned that some of these companies are actually loss-making? Shouldn't you be questioning fundamentals even as you talk about growth?
No, of course you should be questioning fundamentals.
Not quite enough. NASDAQ futures
loss making is sort of one criteria, but I think people buy shares on the basis of potential that they hold. So in a very strong market as we've seen in this year and last year, most of the companies you would see are market leaders, but when you see such frenzy, there's always a likelihood of some of the companies getting mispricing their IPOs, and therefore their stocks not doing well. As you heard from Ashutosh, there are some companies that are sort of trading below their offer price, right? So those things happen, but as long as we see majority of these companies do well, I think the market will support. Yes, but investors should really tread with caution and see which are the institutional investors that are coming in as anchor investors. What's the fundamental business model of these companies? Certainly you can't take your eye off that.
I ask because SEBI actually requires a company that's listing to have a track record of distributable profits in terms of Section 205 of the Companies Act. That's part of the reason why that question was posed, and considering that Meesho is actually loss-making. I just want to bring your attention to investor appetite, foreign investments, in particular foreign funds. What would it take for foreign funds to return to India?
Discovery shares sold off massively, so it just shows that the
market
thinks that this would be good for Paramount.
I think a couple of things. We've seen pretty flattish index this year, while earnings continue to grow. We do believe that we're now getting into a zone where multiples are looking attractive. Most of the global institutional money really is centered around US. If we see continued slowdown in the US, then investors are going to look outside. India, I would think, is now probably at a stage where the current multiples and expected earnings growth will make it sort of look relatively attractive. I do see, some of the other emerging markets like China, I think are looking sort of relatively attractive, probably 13, 14 times multiples versus, 20 plus multiple for India. But, the global money will flow as we see slight slowdown in the US, and therefore India could benefit. So 26, I would think, maybe beginning sort of second quarter or second half, we will see more flows coming into India.
But we see
and we had the RBI cutting rates by 25 basis points. It's adding liquidity to the system. Would that perhaps improve the appetite for Indian assets?
Earnings growth. We've already seen over the last couple of years significant surprises.
Yes, certainly. Look, on one side, RBI's liquidity measures are really to sort of facilitate, greater credit growth in the economy and continue to sort of propel the strong growth that we've seen in India. But yes, increased liquidity as we see transmission of these rates in the hands of consumers and users. Yes, that will improve, their ability to sort of make investments further.
We like the tech sector, though.
Do you see the cut that we saw recently as the last leg of the RBI's easing cycle? How much scope does it have to cut in 2026, you think?
Perspective. Also, they're going to benefit from many of the
Look,
AI adjacent
I do believe that we've front-loaded this. Inflation's under control. There was a unanimous cut, since last year, right, Feb, or since 2025 Feb, we've seen 125 basis cuts. I think that's a material cut that RBI has sort of already undertaken. I do believe that we take a pause from here on, see the continued trajectory of inflation, how exports do, how does rupee perform from here on, and you might sort of might not see any cut in sort of January, February, but maybe a little later in the year.
415.
And speaking of the rupee, it keeps testing record lows. Should the RBI be doing more? Should it intervene more to provide support for the currency?
U.S. yields with them. Is that a problem for stocks?
Look, RBI's stated policy is to, not really, let sort of huge spikes take place, right? So we've seen rupee depreciate by more than 5% this year. There is obviously an impact of our trade treaty with the U.S. Delay on that's really playing on the minds of both exporters and importers, and that's led to a sharp depreciation. I do believe that if we, on one side, governments actually signed up treaties with various other countries. The exports are being diversified as a conscious effort. And if the treaty with the U.S. gets signed over the next few weeks, as one sort of anticipating, I think the pressure will come off rupee. Inflation is, as I said, quite moderate. So therefore, I do believe that in the short run, I think the focus would really be on the treaty that could just kind of change the sentiments a little bit.
In concert with the Fed will do.
And Pramod, looking at the market, some say that India perhaps has become a more compelling fundraising hub. I mean, the IPO hot market is adding to that sentiment. I'm just wondering, on the back of that, do you see volumes in M&As accelerating perhaps in the next 12, 24 months?
Funding at the short end. That's where rates are lowest.
It's interesting. When we see very strong equity markets, the M&A volumes tend to be slightly slower, relatively speaking. So, we've seen very strong equity markets this year. M&A growth has really been relatively less. As we head into the new year, I would see Indian equities or IPO market continue to be strong, but we will see more and more activity. There is a lot of money with the private equity investors. India looks a very attractive market within the APAC. There are material opportunities there. The Indian corporate balance sheets are very healthy. They are at the lowest sort of leverage levels, and we've seen activity amongst the Indian industrial houses, both domestically and outbound, and we continue to see financial financial sponsor interest. So I think the M&A activity will continue to be strong. The IPO activity may probably go into a third year of very strong, performance, relatively speaking.
In the private sector. And so,
which
a lot of discussion
sectors
tech,
do you think will be most active?
The energy needs and the opportunities that there will be in order.
Look, from a deal activity point of view, and I'm clubbing both sort of IPO and M&A here, consumer tech, consumer businesses, given the massive opportunity that India offers with its large population and growing disposable incomes, will continue to see more and more deal activity, whether it's private capital raising, which gets classified under M&A, or IPOs. Amongst other sectors, we will see within M&A, infrastructure, renewables continues to be very strong. Healthcare, pharma, industrials hasn't seen that much, but we do see more and more activity in that sector. So tech would come back, in my view. I think tech's been relatively quiet, but valuations are getting to a place where there'll be more activity, and we do see some of the large tech services companies now having more appetite to act. So mostly sort of across these sectors, but generally I think we'll see a fairly robust M&A activity and equity capital markets activity as we get into 26.
Great to see you this morning. That's BNY Wealth.
And what's the risk to that projection, Pramod? I'm just wondering, everybody's waiting for that trade deal between the US and India. Should that fail to materialize in the next 6 months, might that impact sentiment?
To the upside, you have NVIDIA, just its sheer size. Broadcom,
no, that definitely will impact sentiments. We will see, more sort of, stable rupee. Sentiments will certainly improve. It's been, I would say there's been a overhang for last several months on this, and everyone's sort of watching. I think either before end of the year or in January, we would see that sort of getting sealed.
Let's look at the sectors, because I think this is really telling.
And Pramod, we know that the RBI now allowing lenders to provide acquisition financing. This is a highly competitive space, and Barclays is one of the leading players in this space. How do you intend to stay competitive?
Everything else, Matt, led by Staples at the bottom.
Look, on one hand, the overall activity will improve, the supply of capital will improve, right? So that will just expand the overall activity and financing available. That should spur and increase the overall market size. Secondly, look, from clients' perspective, they're looking for certainty. And we do believe that, a track record of consistently delivering on complex and large transactions will certainly be a strong support to us continuing to win business. So I'm really not sort of concerned about this. I do believe that the overall wallet will increase, the activity will increase. Maybe increased supply would lead to slight compression in pricing, but I would still believe that the clients would, really weigh certainty and the ability to sort of, deliver on complexity and in time far greater than anything else. So, I would see, significant sort of business opportunity continues to be with us.
Some of the top calls this morning.
And what are you most excited about for 2026 as you look to grow the business in India?
The firm says that Marvell is at risk of losing major Amazon chip work to a competitor.
As we've seen in the last few years,
even as current orders remain solid,
there continues to be strong global interest, strategic, while we've seen FPI sort of investments slow down and more sort of being pulled out of India. I do believe that's going to change. And there will continue to be more and more global financial institution interest. One of the large segments for our business, of client segments, is sort of financial sponsors. We have virtually all the global financial sponsors here raising Asia-dedicated funds, India-dedicated funds. There's emergence of domestic private equity funds. So we will continue to see them deploy capital and also monetize their investments. Both provide opportunities for institutions like us. Our Indian clients continue to be more active in raising debt and equity and also undertaking M&A both domestically and cross-border. So that will continue to be, supporting a robust deal activity. Our multinational clients continue to actually grow their India business. We're supporting them through, working capital, cash, trade, etc. So I think, look, India is amongst the fastest growing major economies in the world. We will continue to see both domestic and global interest in the country. So all of that really, I think, just provides a strong environment for us to grow.
Pramod, great insights. Thank you. Pramod Kumar, India's CEO and Vice Chairman, Investment Banking APAC at Barclays Bank. Coming up, saving the trade deal. The U.S. Trade Representative is reportedly speaking with a top Indonesian official this week to keep the agreement from collapsing. Keep it here with us. This is Bloomberg.
There's a lot at stake on the NVIDIA side, to make sure OpenAI is successful, given Google has their own TPUs. So from that perspective, with AI, everything always comes down to data and how you create an ecosystem. And, I think we're still too early in terms of figuring that part out.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Reign supreme and then raise prices.
Agreed. I think that's a great point. And in this race, everyone is finding it's very iterative. Just deploying an AI model, it won't work right away. You really have to grind through it to make it work, and then you will see productivity benefits.
You're watching Insight. The Financial Times is reporting that U.S. Trade Representative Jamieson Greer is set to speak with a top Indonesian official this week. That's as the two countries work to salvage a trade framework at risk of collapsing. Let's bring in Bloomberg executive producer Suraya Permatasari in Jakarta. Suraya, why is it collapsing?
From that perspective,
thank you and good morning from Jakarta. As reported by the Financial Times on Tuesday, citing sources, Jamieson Greer is supposed to have a discussion this week with the Chief Economics Minister, Erlangga Hartarto, to revive a trade framework deal announced back in July by President Trump, but have not been implemented. Now, a deal would see U.S. tariffs on Indonesian goods reduced from 32% to 19%. in exchange for some concessions. Now, it is still higher than the universal 10% tariffs, but a significant cut nonetheless, if it materializes. Apparently, there's been concern from the U.S. side that Indonesia is backtracking on agreements to eliminate non-tariff barriers on on American industrial and agricultural exports. They feel, apparently, that officials in Jakarta felt little urgency to finalize the deal or move quickly to fulfill the commitments, and that they have intentionally looked to delay the concessions. Now, Aslinda, just to take you back to what was agreed at the time in July, Indonesia had planned to purchase some $19 billion worth of American products, including maybe 50 Boeing jets, and erase duties on U.S. imports. Indonesia also agreed to eliminate some local content requirements. Now, this specifically refers to what happened late last year when the government banned sale of Apple's iPhone 16 because the company was seen as failing to comply with domestic manufacturing requirements. Now, the ban was eventually lifted in February after 5 months, as both sides agree on terms which include Apple setting up a plan to produce AirTags. Now, we tried to contact the U.S. officials, but they have not. They did not immediately respond to our request for comments. but we have yet to get any confirmation from the Indonesian side, which I'm hoping we will get shortly. So stay tuned.
I think you don't have to be worried as long as demand.
You've got to wonder what the chances are that Korea will be able to get that trade deal back on track. How much appetite is there? How much urgency is there on the Indonesian side?
So fantastic. Thank you for joining us.
Well, Indonesia
coming up,
is definitely trying to get a deal implemented as soon as possible. But there are a number of issues that the Indonesian government thinks need to be ironed out. That has to do with, you know, the national
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Soraya, thank you. Bloomberg executive producer Soraya Permatasari in Jakarta for us. Now, before we go, here's a look at our guests for tomorrow. It's Fed Day. We'll break down the decision and the market reaction, plus insight from Vantage Markets analyst Hibei Chen and Zuma Wealth CIO Terry Speth, and we discuss the outlook for the economy and the rupee with India's chief economic advisor V. Anantha Nageswaran. That is it for Insight. Horizons Middle East and Africa is next. This is Bloomberg.
Netflix bid $27.75, and Trump voicing concerns about that deal. For more on potential antitrust concerns, we're joined now by Jennifer Rees. She's a senior antitrust litigation analyst for Bloomberg Intelligence. Jen, a lot of things happening.
Yeah, a lot.
For one, Trump saying the big merger between them could be a problem. And Paramount, with their bid this morning, one of the things they explicitly said, one, we're offering more money. Two, we'd have an easier time when it comes to getting through antitrust hurdles. Would they have an easier time?
Absolutely. I mean, there's no doubt in my mind, not just from an antitrust perspective, but from a political perspective as well. You know, we've seen in the news that the president is much more behind this Paramount bid than the Netflix bid. But from an antitrust perspective, it's straight mathematics. When the Department of Justice looks at these deals, they look at these horizontal overlaps. We have streaming, we have production of original scripted content, and we have some vertical issues as well. They look at them and they sum the squares of the market shares. And if those numbers exceed a certain threshold, the deal's presumed unlawful. So just walking in, if you do that and you look at all the streaming options with Netflix, this is a deal that's presumed unlawful. You don't have that case with Paramount. So I think just from an antitrust perspective,
as the market stands now, right? Because you're looking at the market in a very narrow, through a very narrow lens. You're saying like Netflix, Prime, Hulu, Disney. But if you do what Ted Sarandos wants and say YouTube, by the way, I often click YouTube instead of those others, right? Or even TikTok. I never click TikTok ever, but a lot of people do, right?
A lot of people do.
If you look at it through that broader lens, then their market share is nothing.
You know, that's the classic antitrust defense. This is what is always argued because market definition, which is what you're talking about, is usually dispositive. The way the Department of Justice will look at this, and by the way, they almost always tend to look at these markets narrowly, is from a consumer demand perspective. What will consumers substitute if they don't like the price or the quality of some service that they're using? Now, you may switch to YouTube, and I think a lot of the younger generations might switch to YouTube, but I think there's a segment of you're in the younger generation, Matt.
One of the kids.
Thank you.
But I think there's a pretty large segment of the population that would not look at YouTube as a substitute for Netflix, especially if you're looking for an old movie or you want to, stream a series, an old series or something like that. And as long as there's some segment that would be harmed because of the market share created by that combination, wouldn't be willing to switch to YouTube, the Department of Justice is likely to look at that market more narrowly.
Are you maybe looking at the Department of Justice through the wrong lens? Because that's what they would do if they were technocratic and operating on precedent.
True.
But what if the president said, don't do it that way?
Well, I will say that Gail Slater, who's the Assistant Attorney General in charge of antitrust there, is really enforcement-minded. I think she is a straightforward, good antitrust lawyer. I think she wants to do things the right way. But you are right. She has been her decisions have been influenced by what the administration wants, and I think that would probably happen again. I don't know how the Department of Justice, honestly, with a straight face, clears the Netflix deal unless, and this is pretty radical, they were to divest HBO Max.
Yeah, but Trump doesn't want the Netflix deal, so maybe
they
can work in concert together and achieve the same goal.
How did this Department of Justice sue to block Time Warner AT&T?
Right, that was Trump. That was Trump 1.0, his first administration. He did not like CNN. So he wanted CNN to be the same asset. How odd, right? I think the third or fourth or fifth time it's been sold. He did not, he wanted to punish CNN. So there was, under Obama, there was a settlement. But what happened is when Trump came in, he said, no way, you've got to divest CNN. They wouldn't do it. But they won in court.
They won in court and on appeal as well. Jen, thanks so much for joining us. Jennifer Rhee covers legal stuff for us at Bloomberg Intelligence. Coming up in the next hour, Sitara Sundar joins us to react to private market FOMO over AI investments. We've been talking about that this hour. Stick with us for more. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Danny Berger. After 4 straight days of gains, equities struggling to hold on to a bid this morning.
Coming up, it's getting hostile as Paramount crashes the party, taking its bid for Warner Brothers public with a $30 a share all-cash offer, topping the offer from Netflix. Michael Wolff of Activate breaks it all down for us later this hour.
And major moves at JP Morgan. Jamie Dimon brings in Buffett insider Todd Combs to lead a $10 billion investment drive focused on U.S. economic security.
That's a big story we'll cover this hour. Plus, President Trump set to unleash $12 billion to ease farm fury as tariffs and low crop prices batter growers. So we'll talk about the effect that could have on farmers and the companies that they consult with.
Yeah, Deere, maybe some equipment buying. From farmers to AI, we're going to begin with a warning from Thoma Bravo founder Orlando Bravo, who I spoke with on Friday, who said that the rapid advancement of AI is stirring up enormous anxiety among investors, that the hype has triggered a fear of missing out among VCs specifically. He was worried about a bubble starting to form in that segment of the market. I spoke with him at Bloomberg New Voices in Miami.
Right now, there's a big difference between the private markets and the public markets. Public market investors are great, and they're trading these businesses on PE multiples. And if you're not making money, they're punishing your stock prices. And that happened again after 2021. We had that public market bubble in that time period. But the venture capital community in the private market, you see one round after another for very young companies, 5 billion valuation, 10 billion, 20 billion. And look, even if these companies have the right product market fit, the right technology, the right idea, the right customer base, think about what it takes to just double your money if you pay for $20 billion for a company. They have to produce about $2 billion of free cash flow in short order for a fundamental investor to say, hey, this is worth about a 2x, assuming no other rounds of financing, assuming no other dilution, including an IPO. That requires just incredible leadership. There are very few leaders in the world that can do that and that can create those kind of companies and that kind of value. So I think people are just right now in the private markets, they have this FOMO over AI that they need to get in, that they need to be part of it. And that's going to cause a lot of young people to make a lot of mistakes, just like I did in 1997, 98, and 99.
Does it look like the late 90s? Is that the inevitable path that this goes down, especially for VC, sort of a bubble that's forming that inevitably gets popped?
In the private market and the venture world, that is so obvious to us. I mean, this is very young technology. People that want to sell to corporations, we say technology in the corporate world is not revolutionary, it's evolutionary. It takes a lot of time, no matter how fast technology moves, for companies to absorb them into their processes, to change the way they work, to find budget, to use it correctly. Many, many years. Even software systems right now that do a 5-to-1 ROI, that is so obvious, that has been proven many times, the sales cycle on that is 2 to 3 years for a customer to really implement it. So these things in the corporate world where the real big money is, it takes a lot of time. So you have to just match that up with the realities of your customers and of business and fundamental values. Now, this time, of course, we're dealing with something really big that will be over time incredibly transformative. Where the existing companies have to not only hit their numbers now, but have to really invest in that future and position themselves right.
Thoma Bravo founder Orlando Bravo speaking with me at Bloomberg New Voices in Miami. Let's continue the conversation. Joining us now is Sitara Sundar, JP Morgan Private Bank Head of Alternative Investment Strategy. Sitara, great to see you.
Great to see you.
I actually wanted to talk to you about this because you obviously look at both alternative and public markets. And the argument that Orlando was making is that public markets are actually doing a better job discerning AI winners and losers. They're actually reacting to different developments. But specifically, he's calling out VC because he's in private equity and, maybe suits him. But saying VC has a problem, that there's FOMO, that there's chasing. And that's where the valuation problems are. How do you see it as the divide between the two?
Yeah, look, I think that the simplest way to look at it is how these kind of tech innovation cycles tend to progress, and then where you get exposure to that in public markets versus where you get exposure to that in private markets, and then assess valuations from there. Usually what we've seen in tech innovation cycles, whether it's what we saw in the internet cycle, cloud, and what we're seeing right now, is you have the infrastructure layers that are built first, whether that's physical infrastructure or digital infrastructure. In this case, it's like the power players, utilities, as well as semiconductor players. And then you have the platform technology and the application layer that's built after. Over the past 3 years, what we've seen is that the value has accrued to the infrastructure players. And that's primarily a public market play. Outside of power infrastructure we can talk about, but you've seen value accrue to the hyperscalers, to the semiconductors, and to the utility players, and on the power side it's a bit of a mix between public and privates. What I think I agree with is that when you think about the platform tech, like the foundational models and then the application layer, we're still in the early stages, and we are starting to see a little bit of concentration in where the valuations and funding is going to the VC space. It's only in a handful of players, but the biggest point to us is whether or not adoption is going to accelerate to justify those valuations. And what we think about moving forward is that adoption is going to continue to accelerate outside of just the tech companies, which is where a lot of value has accrued. We're already starting to see signs of AI actually impacting the bottom line of companies, which I think is a point that people miss. There are like early reports out there that are showing that revenue growth and margin expansion and even like patent creation of these like AI forward companies are actually far outpacing those that are not integrating AI into their ecosystem. So the biggest tagline for us is that we're 3 years into this cycle. There's going to be pockets of froth that are going to build. Part of that is happening in the VC space. I would argue some of that is happening in the public players too, especially on the software side. But there's still a meaningful opportunity set as we see adoption grow, as we start to see that impact to the bottom line.
Are you starting to see some froth in the private markets support of the infrastructure play? Because, we see such huge exposure to data centers in private credit.
Yeah, I think that there's two different things. One, on where we're seeing pockets of froth within the private market space. I would say one on the VC side, two on the infrastructure side. There's a little bit that's coming within the data centers from a real estate perspective, but we're not seeing as much actually on the power side. I think a lot of folks assume, given the amount of investment that's come to the power infrastructure side, that there's valuations that have been bid up. But what we're actually seeing is that there's likely still going to be a multi-year investment opportunity within the power infrastructure players specifically, because even if you just look at the United States, by 2029, the U.S. could actually reach a power shortfall, given the amount of AI-related demand that has pushed the need for a certain power capacity even higher. So we're seeing pockets of valuation, elevated valuations within the data center side, but we're not seeing it on the power side because we believe the earnings is going to justify that.
So one question that Matt likes to ask that I think is so important in this moment is where you put the incremental dollar to work in AI right now. Does it make sense to do what you're describing, more private, more power infrastructure, or can you still buy NVIDIA and Broadcom and some of the public names? What makes more sense for an investor who's trying to get more exposure to AI generally?
Yeah, I think that there's a barbell approach, if I can, which feels like a cop-out, but let me explain. I know, there's chuckling. I think that there's the infrastructure side. We're 3 years into it, but there's still going to be room to go. I think that you would be remiss and it's dangerous to not invest within the hyperscalers because there's still going to be meaningful earnings growth and opportunity there. Same thing on the power side. I would say, though, that the private markets, which I know sounds self-serving, but the private markets are likely going to be the dominant players within the application layer. So when I think about where to put that incremental dollar moving forward, you should continue to maintain exposure to the infrastructure side, but that application layer is where I would start. We're starting to get a little bit more excited because we're actually starting to see impact.
Ed Harrison writes Bloomberg's Macro View column, and today he said he thinks that U.S. rates are going to get pulled higher with global rates. In fact, after reading his column, I looked back at the last year, and the Fed has cut rates by 75 basis points, and yet the 10-year is exactly where it was last year. As inflation, heads higher. I made a chart showing all this stuff here.
Amazing.
And Joe helped me. Are you worried? The white line here is inflation. If that continues to go up, it's going to be much harder for the red line, which is Fed funds, to continue to go down. And the blue line, which is the 10-year, could well float higher.
Yeah, look, I think outside of talking about artificial intelligence, this new macro regime that we're in is probably the second biggest point of conversation and debate within our client conversations as well. We do expect that inflation is going to stay above the Fed's target over the next, not even just year, but in perpetuity. We expect that even if rates come down, that will likely still be in an environment where rates are going to be higher now than they were in the post-GFC to pre-2022 timeframe. So the biggest takeaway for us is that portfolio construction is going to need to evolve in lockstep. And the biggest tagline there is that the 40 part of your portfolio and the longer duration bond part of your portfolio is really good at protecting against economic growth scares, but not as good at protecting against inflation-oriented scares. So we're leaning a lot more into alternative sources of income, whether that's in pockets of direct lending or really real assets like real estate and infrastructure too. That the idea of the building blocks of a portfolio evolving in lockstep to a macro regime that is shifting.
What about the animal spirits that have been reawakened with an M&A boom, all the financing that's coming to market? How pinned is that to having inflation be at least under control and getting some size of rate cuts?
Yeah, I think there's a certain element of a boost in M&A activity being correlated to easing financial conditions. We've seen that historically. But I think even outside of that, we would still expect to see M&A activity and capital market activity pick up because a lot of the secular innovation that's taking place within this ecosystem, whether it's artificial intelligence, but even looking beyond just AI, we're starting to see a boom in healthcare M&A finally after so many years of kind of waiting. When we think about the next 5 years, the amount of patent cliffs that are going to take place by 2030, it's not just easing financial conditions and rate play, it's also a secular innovation play as well.
Very cool to have you in here, Sitara. Thank you so much for joining us. Great intel. Sitara Sundar there of JP Morgan. Let's get a check of what's going on in markets right now. We started higher, and the S&P has now drifted a little bit lower, just 0.1%. We're still at 68.61, so less than 30 points away from closing high.
but very far away from Stolfis's 8,100.
Well, that's for the end of 2026.
No, but that's still so punchy. Yeah. So punchy. Anyway, some single stock movers that we're looking at this hour. It's the drama, right, that continues between Paramount, Warner Brothers, Discovery, Netflix. Paramount, Skydance, they've taken their bid public. $30 a share in cash is what they're bidding, just days after the company agreed to a deal with Netflix. By the way, we're going to get more on this bidding war later this hour. We'll speak with Michael Wolff, Activate co-founder and CEO.
And IBM is buying data streaming platform Confluent for about $9.3 billion in one of its largest takeovers ever. IBM offered, I think, $31 a share. And Confluent is headed, I think it was headed there.
Yeah,
I didn't see it.
It was a little bit below that, but yeah, headed in that direction. Some more AI news. Google next year reaching a deal to develop data centers paired with electric plants in 3 undisclosed locations. But market sending both those shares lower this morning, Matt.
Coming up, another major departure at Berkshire Hathaway, and I think it's more, well, maybe equally important where he's going. We'll tell you Todd Combs' destination next. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
We don't see the robots taking over the jobs from humans. We try to make the job of the humans easier and to have more technical people that are really controlling the robots and especially improving the quality by utilizing those technologies. We have already deployed a first phase of robotics through Boston Dynamics, and we are working on the next phase on how can we facilitate the job of the workers.
Let's get to high interest now. Look at what's making headlines around the world. White House economist Kevin Hassett says it'd be irresponsible for the Fed to map out interest rate moves months ahead, insisting decisions must follow the data. A leading contender to replace Jerome Powell next year, Hassett praised Powell's consensus building and expects a cautious rate cut on Wednesday. He also says AI-driven productivity could give the economy room for lower long-term yields. Lando Norris clinched his first F1 World Championship with a controlled third-place finish in Abu Dhabi. McLaren's strategy kept him safely ahead of Charles Leclerc, avoiding a scenario that would have handed Max Verstappen the title. Norris, now a 7-time race winner this season, topped Verstappen by 2 points, completing a remarkable rise after years without a victory.
Nice to see it.
Verstappen had a pretty good comeback this season, too. JP Morgan has hired Berkshire Hathaway veteran Todd Combs to advise the CEO, Jamie Dimon, and lead a new $10 billion strategic investment effort aimed at strengthening U.S. economic security. Combs, a longtime Buffett lieutenant and Geico CEO, will join next year, leaving Berkshire as it prepares for its own leadership transition.
More on Todd Combs. We're joined now by Bloomberg managing editor Tom Metcalf. Tom, two sides to this. There's the Berkshire side and the JP Morgan side. Starting with JP Morgan, this hire for this, what is it, a security and resiliency initiative, what exactly are they throwing Todd Combs behind?
Yeah, it's really interesting from both sides. On the JP Morgan side, they basically picked him to effectively lead this 10 billion sort of direct equity investments that the bank is planning to do into stuff for areas like security, defense, critical minerals. And this is all part of that $1.5 trillion financing commitment that they've said, they're going to basically roll out over the coming years. There's about 50% more than they expected given the change in geopolitics. But it's a really intriguing hire. He's one of the sort of most influential people, I'd say, behind the scenes in finance, works for Buffett, obviously, basically ran the equity investments along with Buffett and another executive at Berkshire. And as well as that sort of specific role, he's going to be a senior advisor to Jamie Dimon and just generally, I guess, add to that sort of very strong bench of expertise at JP Morgan.
just to get to the Berkshire exodus for a moment, it does look like that's happening, doesn't it, Tom? I mean, we've had a lot more personnel changes than we normally do for Berkshire Hathaway.
Yeah, complete change. Obviously, you've got Buffett heading out the door at the end of the year, and that seems to be precipitating basically a changing of the guard, I suppose. So, as well as Todd, they're changing out their CFO. And, I think it's going to be really interesting. Like, that's, probably one of the momentous change any company will have to go through. And obviously under Greg Abel, they're looking to kind of maybe just start with a fresh set of characters.
Yeah, it does just raise questions, I guess, in general of what Berkshire actually looks like post Warren Buffett if a lot of his deputies are leaving. Tom, on this idea of JP Morgan, their plan, $1.5 trillion, pour that into sectors that are crucial for the security and national economy of the United States. How much of this is also a JP Morgan reading where the winds are going, reading a White House that has really tried to do the same and is looking to the private markets and private players to help fund some of it?
Oh, yeah, absolutely. In part, I'm sure it's done with one eye towards the White House. It's probably exactly what the Trump administration would like to see. Basically, before this recent announcement, it was going to be $750 billion, or that's what expected. So a significant uplift. But of course, it also just reflects the reality, right? Moving into a more turbulent, more geopolitical world. And this is the kind of thing, you've seen it in defense sector shares, particularly in Europe, where, this kind of commitment is probably going to be, gobbled up by the market. And as part of today's announcement, JP Morgan also said there's going to be this advisory board that's going to be helping out Todd Combs. And, you've got literally a who's who of finance politics in that business. You've got Jeff Bezos in there. You've got former Secretary of Defense Robert Gates. Basically, whoever's a big name in business seems to have been tapped for this thing, which just goes to show just generally how much Wall Street and the wider business world is lining up behind initiatives such as this.
So it's kind of exciting for JP Morgan, for Jamie and for Todd. When do we expect to start seeing action out of this group?
So Todd should join in January, according to the statement, and then obviously, it's how quickly do they want to deploy that particular, $10 billion. I mean, that's literally JP Morgan's capital. So I'd be curious to see, if it's, the sort of momentum, the kind of sort of metabolism of that is extremely quick, or if it's going to be quite steady, and particularly maybe we won't see any real world impact for a while. But if they're looking to get, in terms of the financing, 1.5 trillion. Out the door, you're going to expect to see that, starting, if not now, very, very soon.
Yeah, it turns the $10 billion slightly bigger. Tom, thanks so much for joining us. Bloomberg's Tom Metcalf covers finance for us out of London. Still ahead, Paramount making a hostile bid for Warner Brothers. We'll discuss that with Michael Wolff. He's the co-founder and CEO of Activate, used to run MTV. This is Bloomberg Open Interest. Let's get a check on the stock market right now. We kicked off the trading session slightly higher. As you can see, have fallen steadily. Now down 11 points, but the breadth has gotten better. More than 200 stocks are up and fewer than 300 are down right now.
In terms of some of the individual movers, you can see there Broadcom is one of the big gainers. It's done a deal with Microsoft, reportedly, that they're going to supply them with some custom chips. If you go over to the downside, because maybe that one's more interesting, Tesla over at Morgan Stanley has a new analyst coming in and has changed it from overweight to equal weight, saying that all the non-auto news is already priced in and therefore Tesla can't really rally much higher than that, Matt.
You know what I'm going to do? I'm going to walk over to the screen here because we can pull up the industry groups and something has changed. We've got another one gaining. So when Danny last showed you this screen, the GRR on the SPX L1 index, only IT was rising. Now we have industrials gaining as well. So the breadth is getting better. We have at least one more industry group doing a little bit better. So maybe a little bit of a turnaround in store for the close today. Remember, we were at 68.70, so just 20 points away from an all-time high. And now we're fewer than 30 points away with the drop that we've seen.
Yeah, it's been this slow melt up in the equity index over the past couple of days. We've been up for 4 straight sessions. This would end that if we were down 0.2%. But again, it's the individual movers that are more interesting, and we're going to talk about Paramount in a little bit. I think it's very notable that Paramount is rallying in today's session after they've made a bid for Warner Brothers Discovery. Netflix has fallen every time that they get closer to buying.
Yeah, I think it's fascinating as well. And Paramount, in its bid today, $30 a share in cash, also has a $5 billion breakup fee. But when I saw last week that Netflix had a $5.8 billion breakup fee, I thought, man, I would take that offer and then break it up and then go with another offer, because then free money.
Yeah, but President Trump might not allow them to go through with that offer. We're going to speak about this coming up. It's the $72 billion takeover deal from Netflix gets challenged. We're going to speak with Michael Wolff of Activate coming up after this break.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Paramount making a hostile bid for Warner Brothers just days after the company has already agreed to a deal with Netflix. Michael Wolff, Activate co-founder and CEO, says the proposed Netflix-Warner Brothers deal would be a huge win for Netflix, writing, quote, "The average person is subscribing to as many as 5 streaming services. Since Netflix is already the default service, adding HBO not only increases the programming on its own service, but gives it another to sell." He joins us now, I'm pleased to say, here on set, flown in from the West Coast. Michael, great having you here. I think in your point, I see another point, which is that most people who subscribe to Netflix already subscribe to HBO. So
not necessarily.
I think Ted Sarandos has said 75% of their subscribers.
That's not true. Our research shows it's roughly 30%.
I see. So it wouldn't exactly blow their market share up, or it would blow their market share up substantially.
Well, I mean, when we look at this from the perspective, it's how you look at market share. And so if we look at but streaming is about 46% of television viewing. And you start looking at the numbers, you've got 12%, roughly 12% is YouTube. You've got roughly 9% is Netflix. 4% is Disney. And then you go all the way down. HBO Max is less than 2%. So if you look at this, yes, it's additive, but at the same time, the bigger competitors are going to be Amazon and Tubi TV, and people aren't talking about them. And then when you look at the number of titles each of these services have, it's also a huge difference. I mean, Netflix has roughly 7,000. Disney has roughly 4,000. You've got 3,000 with 3,000 to 4,000 for Paramount, but you've got Amazon has 25,000 and Tubi has 70,000. So on all these different sides, it's not clear that this is going to be a massive share of the business.
It's interesting because when it comes to Warner Brothers, it's been framed as a must-do deal for them, or they need to figure something out. You frame it for Netflix that this is a must-do deal for Netflix. And I think that's interesting because many people would say it's healthy on its own. It is starting to come up with these various titles that are popular. Why does Netflix need this deal?
There are going to be a couple things that are going to drive success in streaming. One of them is really established IP, and then global franchises, and they have to be global. They can go everywhere. With Warner Brothers, they get Harry Potter, they get Lord of the Rings, they get all the DC comics, which I could argue are way underexploited. They get a whole set of shows, and even though if you look at what Netflix has been able to do with Bridgerton and Stranger Things, it's nowhere close. The second thing, by the way, what is missing here is live sports, and that's a case where Paramount has an enormous amount of live sports. Amazon has been going deep on live sports. Peacock probably has more sports than anybody. So I guess my point is that this game is not totally clear. And then YouTube is basically eating the internet. and YouTube for a lot of people is TV.
Right, because Netflix has been trying to argue that it won't have an outsized market share because you need to count YouTube and TikTok.
Because you should count it, but some people say that's not a streamer, right? Others say I choose that over streaming services quite a lot. I think the part that's most difficult to talk about is the role that President Trump plays in this. Netflix is seen as this sort of globalist bastion of liberalism, right? The programs you mentioned, I think, can confirm that. And then Paramount is run by David Ellison, owned by the Ellison family, which has very close ties to President Trump. Listen to what David Ellison told Lucas Shaw at our Screen Time event earlier this year.
We have a good relationship with the administration, and look, I think if you look to that, I do believe other things that have been rumored about, right, are very large-scale players that could potentially create monopolies, obviously, in the ecosystem. And again, I think when you look at the lens of consolidation, for us, I'll keep going back to it, it's always how do you create long-term value creation? How do you put yourself in the position to produce more content, not less? And how do you ultimately build something that is better for the consumer?
So you could read Netflix into that when he talks about monopolistic position. And I wonder how important the CNN aspect of this is, right? Because President Trump would surely love to have allies running CNN.
Well, I think that there are a couple other factors. One of them is the reception of the creative community, which is much more interested in a Paramount deal. The second is the
Why is that, Michael? Why is the creative community much more interested in a Paramount deal?
Because they look at Paramount as an established studio. Paramount has already said that they're going to increase the number of theatrical releases from what they have today to 30 by doing this. And they appear to be committed. They truly are today a movie studio as well as a TV studio. And they're clearly committed to the theatrical business. So there may be an outsized influence not just to the president, but also the creative community, as well as other businesses like the movie theater owners. It's hard to get.
It's a win-win-win.
Well, it's a win on their side. It's hard to guess what will happen and how much this. A lot of this is going to come down to not just Trump, but it's also going to come down to the shareholders. Paramount has a month to put this out for a shareholder bid. Winning those kind of bids is hard.
I was going to say, and I've been talking to Matt about this, when that Paramount hostile bid came out, you can see it there on the screen, shares go up 5%. Every time Netflix has talked about this deal, shares have fallen. Why do Netflix shareholders not like this deal? And to your point, if they need something like this, if they need the IP, if they need the movie studios, the different things that they have, why wouldn't Netflix be seen as more favorable in terms in the eyes of the shareholders to buy Warner Brothers Discovery?
Well, first of all, investors believe that Netflix doesn't need this. And it's a huge cash outlay and money that Netflix doesn't necessarily have, and they're not expecting that. And then, second of all, they're wondering whether or not it makes sense for Netflix. Not just do they need it, but whether or not it's really going to be additive.
By the way, Michael, I find it kind of a bummer, the whole IP thing of it all, that the entire slate, it's like Toy Story 5, another Super Mario movie, another Scream movie, and that Netflix wants part of that. It feels like creativity is all being sapped and it's just part twos of Toy Story for the rest of eternity.
Yeah, but I mean, that's been going on for the longest time. I mean, Disney, which has had for the longest time the largest market share in
But does this make it worse? If all of a sudden Netflix can lean on that too?
I don't think it makes it worse. I think this is just consistent. I mean, when you look at this is where this game is going to be played, and nobody's going to invest hundreds of millions of dollars in an unproven franchise.
I hear what you're saying, right? Like, these things just become made by AI and all about marketing, and there's no creative force. And I think, Michael, what you're saying is Paramount does want to bring that creative force. At least that's what I took from David Ellison. I thought that was a fantastic interview by Lucas Shaw. I listened to the whole thing. David Ellison seems genuinely interested in really making something special in terms of entertainment, not putting out Toy Story 7, you know?
That may be the case. But when you look at the biggest hits, we're talking about Top Gun. We're talking about things that are established franchises. And also, by the way, it's also the biggest stars. And so, once again, it's a huge risk in the film business. Of course, somebody who's much more creatively driven is going to be willing to take that risk on new IP, especially if it comes with established stars.
Yeah, I mean, Tom Cruise, the man could use a rest. He looked amazing in Top Gun, but
Top Gun 1.
And 2. He looked great, no?
I mean, yeah, he looked great.
Well, we should expect more Mission Impossibles and more Top Guns.
Poor Tom Cruise. All right, Michael, this has been
and more Star Treks.
I guess those are all good things. You know, the world could use that.
Yeah,
exactly.
Trek.
Michael, this has been so fantastic. Thank you for joining us.
Good
Michael Wolf of Activate. Coming up on the show, we're going to be speaking with Christina Minnis, Goldman Sachs head of global acquisition finance, as companies rush to the bond market for cheap M&A funding, a conversation you don't want to miss after this break.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Companies are rushing to the bond market for cheap M&A funding, making this quarter the biggest in 4 years for acquisition financing at $113 billion globally. That's according to data compiled by Bloomberg. Joining us now, I'm pleased to say, is Christina Minnis, Goldman Sachs Global Head of Credit and Asset Finance and Head of Global Acquisition Finance. Probably the busiest woman on Wall Street. Christina, wonderful to see you.
Thanks for having me.
I mean, it has been this huge revival. How much of it, though, is just down to fundamentals are really good, people like these deals, and things get funded very easily, versus just a lot of cash that's being put to work and the sheer demand that helps keep spreads tight?
I think we're in a position of everything seems to be working. Number one, there is a lot of liquidity in the markets. Number two, outlook on the economy looks very positive for 2026. We've revised our own GDP U.S. growth estimates to 2.5%. Credit spreads have come into a place that are very attractive. I think boardrooms have a little bit more confidence, and there's just a tremendous amount of pent-up demand for product. And then you also have the sponsor dynamic, which is extraordinary. M&A, as you know, is up meaningfully year over year, but sponsor M&A is up almost 45%. And the mega deals have returned. Mega deals, we define that $10 billion or more, are up almost 100%. So if you think about that dynamic, what that means is if those transactions are working, the credit markets have got to be able to support them. And we haven't even talked about what's going on with AI, infrastructure, energy transition. You know, investors are very, very interested in financing that. And if you take a look at the percent of the market that is supporting AI and infra right now, it's about 1 or 2%. It should be closer to 5%. And go back, look at other big technology moves around TMT and the internet. Even energy back in the day, that percent was almost 15, 20% of the markets. So we have a long way to go for investors to